Class, welcome to topic number. Hello class, welcome to topic number 5, where we are looking at share capital. So this is the first lesson of this topic, where we are going to look at the following issues. We are going to describe share capital. We are also going to look at the various types of share capital that we can have. We are also going to look at the alteration of share capital. Then in this lesson, we shall conclude by looking at the reduction of share capital. The reduction of share capital. So class, we can begin on the first item, where we are describing share capital of a company. The share capital of a company will be prescribed in the company's constitution, where they describe what the share capital of this company will be. Now, capital becomes share capital if the capital is divided into units that we have previously described as shares. So if the company's capital is divided into these units that we are referring to as shares, then we say our company has a share capital. That the capital of the company is divided into units that we are referring to shares, then that is the share capital of the company. Now, the company's share capital can be put into various categories, what we are considering as the types of share capital of the company. Types of share capital. The first type that we may have is what we refer to as the registered. The registered, also known as the authorized. Share capital. The registered or the authorized share capital. This, as the name registered suggests, this is the capital with which the company is registered with. The capital being divided into units that we are referring to as shares. It is also described as the maximum amount of capital that the company is allowed or authorized to issue. Hence the reference to authorized, the word authorized, meaning the amount which the company is allowed by law to issue. That authorized amount is the amount with which the company has been registered with. Just to make this note, the fact that we have been registered with a particular amount of share capital, it does not mean that in the future we may not alter, we may not change that amount of share capital. That it is possible that in the future, this company may be changing, either to increase or to reduce its registered or authorized share capital. Now, the company will be at liberty to either issue the whole or simply part of this amount that is their registered share capital. From this registered share capital, it is possible to have what we are calling the issued share capital. This is also known as the allotted share capital. It is the share capital that the company has issued to the members. It is the subscribed share capital of the company. It is the amount of shares that members have taken up from the company and they have undertaken to give a consideration for. So, out of the company's registered share capital, we noted that it is not compulsory for the company to issue the whole of it. So, that part that they have issued, that part that has been subscribed for, that part that members have taken up and have committed to pay for, then it is that part that we are referring to as the issued share capital. Now, where this is part of the registered share capital, there is a balance that remains, which we are referring to, number 3, as the unissued share capital. the unissued share capital. That this is that part of the company's registered capital that members have not taken up, that the company has not issued. So this can be the subject matter of future issuing of shares by this company. Now, I would want us now to concentrate more on this issued share capital in our fourth type. Out of the issued share capital, we can have what we call the called up. The called up share capital. The called up share capital. The called up share capital. It is usually a portion of the issued share capital. If class, you can recall from our previous topic where we talked about calls on shares, where the directors were empowered by the articles to make a demand that members pay part of the shares that they have taken up in the company. This is the subject matter, or rather this is the capital, the type of share capital on the basis of which calls have been made. That it is that part of the issued share capital that the company directors have made a call in respect of. It is a portion, or it could be the whole of the issued share capital that the company has already made a demand to the holders of those respective shares that they make a payment in respect of the shares they have taken up. Still on the calling of shares, we may also have a portion of the issued share capital that we are describing as uncalled up. Uncalled up share capital. Uncalled up share capital, where we are saying that this will be that portion of the issued share capital that the company directors have not demanded. The company directors have not requested members to make payment for. So if the issued share capital, in respect to the issued share capital, if the whole of the issued share capital has not been demanded for to be paid, then the balance will be the uncalled up share capital. Then on this called up share capital, we can have what we are referring to as the paid up share capital. The paid up share capital. If it is not paid up, then we have what we are referring to as the unpaid up. The unpaid up share capital. The unpaid up share capital. That in respect to the amount that the directors have called up, that which they have already received, then it is referred to as the paid up share capital of the company. This is actually what the company has. It is the money they have actually received in respect of the shares that they have issued. Then there is that part that we have already demanded that members pay, but we are yet to receive. The company is yet to receive that part that they have demanded that members pay in respect of the shares they have. That part not yet received but demanded is referred to as the unpaid up share capital of the company. Now, class, we have some very special category of the uncalled up share capital that we refer to as the reserve capital, also known as reserve liability, It is a portion of the uncalled up capital. It is a portion of the uncalled up capital that the company, by a special resolution, resolves that they will not be calling that part except in the case of a winding up. Now, the idea behind not calling up this amount of capital is seen as a way of securing creditors. It gives assurance to creditors that there is still some amount of capital that members are liable to pay towards their shares, that in the event of an insolvent winding up, then there is some faith to creditors that there is still some portion of capital that the members have not yet paid up and are committed by a special resolution that will not be capable of being called up except in the course of winding up a company. So if we could describe the interrelationship between these categories, then you could have something like this, that if this were to be considered to be the registered share capital of the company, then this registered share capital of the company can either be the issued or the unissued share capital of the company. Then in respect of this issued share capital, we may have this as the called up share capital. Then we have the uncalled. Then we have the uncalled up capital of the company. Then in respect of this called up, then we have what we are describing as the paid up capital. Then we also have that part that may be unpaid. That part that may be unpaid up. So this small diagram can be very helpful to describe the interrelationship between or amongst these various categories of share capital that we have described. And it is in respect of this part, that is the uncalled up capital, that we now create our reserve capital. That it is a portion or the whole of the uncalled up capital that the company resolves by a special resolution, that we will not call that part unless we have a winding up process going on, where that part is seen as securing the interest of any creditors who may have a claim against this company in case of an insolvent winding up of the company. So class, these are the various types of share capital that we may have. Now, I want to look at the possibilities of a change alteration of share capital. Alteration of share capital. Now, if a company would have this sort of scenario, that we have been registered with a capital of 1 million, let that be million Kenya shillings, and that 1 million Kenya shilling is divided into 100,000 shares, where the value of a share would be shillings 10, this being the capital, and these are the units that the capital is divided into, then this is the value per unit. Alteration of capital will refer to any transaction that will have the effect of increasing or reducing this capital. Any transaction that will have the effect of increasing or decreasing the units that the capital is divided into, or any transaction that has the effect of increasing or decreasing the value per unit. So these transactions could include the following. So ways of altering share capital. Ways of altering share capital. So the following transactions can be good examples of how capital can be altered. One of them would be redemption of preference shares. So these have to be the sort of preference shares that are redeemable that we have previously looked at and in our previous topic. We could also issuing of additional shares. Issuing of additional shares is a possibility. We also have possible transactions like a conversion issue, conversion of debt to shares, conversion of debt to shares. We can also possibly have consolidation of shares. The reverse is also possible, the subdivision. It is also possible to have a subdivision of shares. It is also possible to have a subdivision of shares. And other transactions like diminution of capital. Now, what is happening here? What nature of transactions do we have, and what effect are they going to have as far as alteration of capital is concerned? Now, if part of our share capital was represented by redeemable preference shares, where redemption is the aspect of the company buying back that proportion of shares that is the redeemable preference shares, then it would have an effect of ultimately reducing our capital and the number of units that we have as our issued share capital when the company buys back or redeems the redeemable preference shares. Now, we will have some conditions relating to the redemption of preference shares. For instance, the shares themselves have to be issued as redeemable, that they have to have that fact, that right given to the issuing company, that the company can buy them back. It will be a requirement that these shares should be fully paid, that no redemption will be done for partly paid preference shares, that companies may be issuing new shares so that the consideration they get for the issue of the new shares is applied to the redemption of the preference shares. Otherwise, where the redemption is not out of a fresh issue, then it can be redeemed out of reserves. We can have the redemption of preference shares being done out of the capital reserves of this company. We also have this second transaction that has the effect of altering the company's share capital, which is issuing of additional shares. So where our capital was presently 1 million divided into 100,000 shares, this company may choose to increase its share capital by issuing additional shares. So they could be issuing an additional 100,000 to take its share capital to 2 million. The transaction will have the effect of we now have an increased capital with increased units of shares. It is also possible that we can have this third transaction where debt is converted into equity or converted into shares. This will be in respect to particular debt instruments, let's say debentures, that they were issued carrying the right to convert into equity. So when such a transaction happens that we have debt converted into equity in respect of shares, then the effect is that we have added additional equity in respect of shares. It is also possible that we can have a consolidation of shares. The consolidation of shares would be where we take a cluster, a number of shares, and then convert them or add them up into a single share, resulting into a share of a bigger value. For instance, if this company were to consolidate all its shares to take up two shares to form one, then we will have our shares reducing from 100,000 to 50, where the value of a share would be 20. The company would have consolidated the shares, merged them up, 2 to become 1, where now the number of shares, the units drop by half to 50,000, then the value per share goes up from 10 to 20. Now that's a consolidation. The reverse is the subdivision of shares, where we have the present value of share being the present shares being divided into smaller units. For instance, if our shares were to have every share be divided into 2, then we will have our number of units increasing from the present 100,000 to 200, where the value per each unit now falls from 10 to 5. Now that's a subdivision of shares. All these transactions have to be authorized by the Articles of Association, and as you note, they are all resulting into a change or an alteration of the company's share capital. Let me discuss the last of the issues in this lesson, and that is the reduction of share capital. Reduction of share capital. To understand reduction of share capital, I prefer we begin by asking ourselves the question why we may need to reduce. Why would we want to reduce our share capital as a company? Now, if you could trace the basis from this equation where we say that the company's capital is the equivalent of its assets less its liabilities, assuming that our company had no liabilities, then it is true to say that the company's assets is the equivalent of its assets if L is equals to 0. If our company had no liabilities, then it is true to say that the company's capital is the equivalent of its asset. This equation should be seen or should be kept true, that with reference to our books, the capital amount of the company should at all times be the representation of the value of the assets that this company has. It so happens that sometimes the company's assets may fall in value. For instance, where we have had an accident for which we have not received any compensation, then the company's value of assets may fall. Imagine in the event of a fire, we have a company building which was previously represented as the company's assets that has now been burned and destroyed, and no compensation for the same. Then we would say C is no longer equivalent to A as a result of the decline or the fall of the value of A. So where the value of A has gone down, to maintain this equity between C and A, then it may also become necessary to take down the value of C, which we are referring to as the reduction of capital. Now, to the second question, how will we be reducing this capital? What particular transactions may we carry out to end up with a resulting C being reduced? Now, one of the possibilities that we may have, which is the easiest of all the possibilities, is where the company extinguishes. To extinguish or reduce the unpaid up capital, the unpaid up capital of the company. So that part of the company's share capital that is unpaid up, that we have made a demand to members to pay, but they are yet to pay, then we can extinguish or reduce that liability, where we are simply telling members that they no longer have to pay. They no longer have the obligation to make that payment to the company. The effect is that our C reduces. We also have other possibilities where the company cancelling part of the paid up capital. Cancelling part of the paid up capital. This would be in the event where we do not have unpaid up capital, that the company's called up capital has also been paid up. Then in that eventuality, then we may cancel out a portion of that part of the company's capital that is already paid up. Then finally, we have the last of the options available. It would rarely be an option for us, but it is possible, where we have a company paying off capital back to members. Paying off capital back to members. This would be an extreme case where the company is saying we are going to pay back what we have received from members as capital contributions. Anyway, as extreme as they sound, we are saying these are possibilities that are available to the company to execute a reduction of capital. Now, I want us to look at the process that we will follow if we will need, as a company, to reduce capital. The process of capital reduction. The process of capital reduction. First and foremost, this process has to be authorized by the Articles of Association. Must be authorized. It must be authorized by the Articles. That the Articles must permit. That unless we have the permission of the Articles, we may not reduce capital. So that in a case where we have a company whose Articles do not allow, and the company wishes to, then they would have to begin a further distance where they have to amend the Articles first to allow them to reduce their capital. Then they would now begin the process of reduction of capital. So once we have secured the permission of the Articles to reduce capital, then the company will convene a meeting of members to approve the reduction. So we have the approval of the reduction by members. Approval of the reduction by members. Now, members will be approving this reduction at a members' meeting by passing a special resolution. They pass a special resolution. The resolution is known as a resolution for reduction of capital. Special resolutions will always be supported by a 75% majority vote of all those members present and entitled to vote. So if we get this threshold of support at the members' meeting, then the resolution is rightfully passed and the reduction of capital is successfully approved by the members. Now, once we get this approval by members, then we begin a court approval process. Courts approval of the reduction. Court's approval of the reduction. So the company has to make an application through the directors to the courts to approve the intended reduction. Now, the reason why we involve the courts in the reduction process is that there are particular groups that may be adversely affected by the reduction of capital, that the courts have to confirm that the interests of these specific groups have been catered for. For instance, we are looking at the interests. We are looking at the interests of creditors. We are also looking at the interests. We are also looking at the interests of minorities. We are also looking at the interests of minorities. Remember, with a 75% majority approving the reduction, it does not mean everyone else is very happy about the reduction. There is still a balance of 25% that may be seriously affected by the reduction. So we afford them an opportunity to have their issues protected. So in protecting the interests of the creditor, the courts will be asking the company whether we have any creditors of the company that are objecting to the reduction. So if there is any objections we have from the creditors, the question is, what has the company done to secure the interests of that creditor? So the company could be saying that we have paid off all those objecting creditors, or we are providing a guarantee that all these creditors will be paid after the reduction. That is in a bid to ensure that no creditor will be compromised by the reduction of the capital. So the same will happen for the minorities. If any minorities are objecting to the reduction, then again the court confirms how the interest of such minorities has also been respected or observed by this company. So if the court is okay that the creditors' interests are not prejudiced and the minorities' interests will not be prejudiced by the reduction, the court will issue an order. The court issues an order. The court issues an order confirming. The court issues an order confirming the reduction. The court issues an order confirming the reduction. In some extreme cases, the courts will go to an extent of protecting the interest of third parties, members of the public, where they may require this company to change its name, to add to its name the words "unreduced." We may have an order that the company is to add these words "unreduced," so that if our name was previously AB Limited, the name of this company that has reduced capital may now become AB Limited and reduced. This order is to the effect that this is to be part of our name for a specified period of time, so that anybody who sees this, then they may know that we have previously reduced capital as a company. But it is not a very common order. The court will also be conscious of the adverse effects that the company may get by notice being sent that they have previously reduced their capital. So this may not be the usual case that companies will be ordered to put this or to have this as part of their name for a specified period of time. So we now have our court approval for the reduction. The next thing is that we will now have to give notice to the registrar. We will now have to give notice to the registrar that we have reduced our capital by a special resolution of members and receiving an approval of the court. So how will this registrar know that we had a meeting approving? we shall be giving them minutes of the meeting of members in which the special resolution was passed. How do they know that we received a court order approving the reduction? We shall be giving them a certified copy of the court order approving the reduction. So once the registrar has that, then they are convinced that the due process has been followed in reduction of capital. They will now finally be registering the reduction. Registration of the reduction. Registration of the reduction of capital. So, dear class, that is what we are covering in this first lesson on share capital, where we have defined what share capital is. We have also looked at the various types of share capital that we can have. Then we have looked at the various transactions that constitute an alteration of the company's share capital. Then we have also looked at the process of reduction of capital, where we began by asking ourselves why we were reducing capital and how we would reduce capital, and then finally the process to be followed. So thank you very much.
Welcome to the lesson. We're going to answer April 2024 Advanced Financial Management paper. Question 2A reads, two assets, A and B, are known to lie on the security market line. Asset A has a beta of 0.5 and a risk premium of 4%. Asset B has an expected rate of return of 20% and a beta of 1.75. You are considering the foreign securities which are available in the market. You have security A, B, C, D, E with expected returns and betas provided. Required, determine the risk-free rate of return. Determine the risk-free rate of return. That is Roman 1. Determine the risk-free rate return. Now, candidates, in the context of this question, you can see we have asset A has a beta of 0.5 and a risk-free rate of 4%. Asset B has an expected rate of return of 20% and a beta of 1.75. Now, before we get the risk-free rate, what is beta? What is the meaning of beta? Beta. Now, beta measures the sensitivity of an asset's returns to the overall market's returns. That is to say that beta indicates how much an asset's price is expected to move in relation to the market movements. And by now I know you know that beta of 1 indicates that the price is moving in tandem with the market. That is beta that is equal to 1. Because remember, I've just said that beta measures the sensitivity of an asset's returns to the overall market. So if you have a beta of 1, that means that the asset's price is moving in tandem. It is moving at the same rate with the market. But we may have beta being greater than 1, like is the case here. with the asset B. Asset B's beta is 1.75. So this 1.75 is greater than 1. What does that mean? Now, when you have an asset beta that is greater than 1, that tells you that the asset is more volatile than the market, and its price will move more than the market. The price will move more than the market. That tells you that that price is more volatile if it is greater than 1. You may also have an asset beta that is less than 1, like the one in asset A. Asset A has a beta of 0.5. 0.5 is less than 1. Now, this asset is less volatile than the market. That is to mean that for every 1% change in the market, asset A's return is expected to change by 0.5%. Is expected to change by 0.5%. And we've seen that asset B's beta is 1.75. Is 1.75, which is greater than 1. Asset B, I indicated, is more volatile than the market, meaning that for every 1% change in the market, asset B's return is expected to change by 1.75%. But we also read that these two assets lie on the same security line market. The two assets A and B are known to lie on the security market line. They both lie on the security market line. So what is a security market line? Now, a security market line is a graphical representation of the CAPM, which helps investors understand the relationship between risk and return for different assets. So asset A and B, all right, two assets A and B lie on the security market line. What does that mean? Now, since both assets lie on the security market line, their expected returns are directly proportional to their betas. That is what it entails. They are directly proportional to their betas. It is important for you to have that small knowledge, beta, because we have a column there for beta. Now, let's now work out the risk-free rate of return. The risk-free rate of return. I'll begin on page 1. This is April 2024, question 2A, Roman 1. We are to calculate the risk-free rate of return. The risk-free rate of return given the information. In the first sentence, we have asset B has an expected rate of return of 20% and a beta of 1.75. Then in the same question, the expected rate of return is 20%. Expected rate of return is 20% and the beta is 1.75. So, how do we determine the risk-free rate. Which formula are we going to use? We are going to use the CAPM formula, expected rate of return is equal to risk-free rate plus the premium. The premium is RM minus RF times beta. And we are going to use the beta for asset B because that is the information we have. Asset B, we have the beta of 1.75. The expected return is 20%. We do not know the risk-free rate. How about the risk-free rate? We do not have it, but we have the beta of 1.75. 1.75 is the beta. Okay. Then what other information do we have? Asset A has a beta of 0.5 and a risk premium. So we have the risk premium. Return on the market minus risk-free, that is the risk premium. So we have the risk premium of 4%. That clear? The risk premium, we have it. And therefore, this should be equal to, this is equal to. So you see, risk-free rate is the unknown, and we are going to calculate it. This is 20% risk-free rate plus 4% times 1.75. How much is it? Kevin says 7%. Is it 7%? 7%. 4% times 1.75. Is it 7%? Muhammad Hassan says 0.07. Convert it into percentage. That will be 7%. So you can see here, candidates' risk-free rate will be 13%. It's 20% minus 7%. 13%. Is that true? 13% is the risk-free rate. Kabasha, welcome. Then we are required to calculate the required rate of return. The required rate of return. There was a problem with the setting of the question here because that Roman 1 ought to have been part of what we have answered. Before you come to, you are considering the following securities which are available in the market. Roman 1, we are to calculate the risk-free rate. Roman 2 is independent of Roman 1. Roman 1, we were to determine the risk-free rate given the data before the table, the data before the securities shown in the table. Two securities A and B are known to lie on the security market line, are known to lie on the market security line. Asset A has a beta of 0.5 and a risk premium of 4%. Asset B has an expected rate of return of 20% and a beta of 1.7. The risk-free rate that we have computed in Roman 1, we're going to use it in determining the required rate of each security in Roman 2. Okay, so we need to make that correction in the question. The question was misplaced. Roman 1 was required to be inserted before the table. In Roman 2, we are to calculate the required rate of return. The required rate of return. Roman 2, required rate of the required rate of return. Now, the required rate of return, we still use CAPM to calculate the required rate of return, which is equal to risk-free rate plus market return minus risk-free rate times the beta. And we'll calculate for each security. We have a column for the security A, B, C, D, and E. And now the E. Okay, so that's the first column. Then, are we together? Hannah, we are answering April 2024. So for security A, the risk-free rate is 13%, and that will be constant for all the securities. 13%. We add the premium. Market return minus risk-free is the premium. The premium is also 4% for all the securities. Then we multiply by the beta for security A. The beta for security A is 2. That will give us the required rate of return. How much is it? For B, it will be 13 plus 4 times the beta of 0.75. C, 13% plus 4. The beta there is 1.25. D, 13% plus 4, beta negative 0.25. E, 13% plus 4, the beta there is 3.25. So these are the required rate of returns for each security. So can I have the answers? Kevin says 21. It's 21%. These are percentages. B, 16%. 16%. Security C, is it 18? Kevin says 18%. Security D, Kevin says 12%. The last security, 26. Required rate of return, 26. So that's it. How many marks? How many marks? 4 marks. 4 marks. That's 4 marks. 1, 2, 3, 4, 5. 4 marks. This was how many marks? 2 marks. 1, 2, 2 marks. Now let's answer the second part, this second or third. Identify which security is undervalued, overvalued, or correctly valued. Now, to calculate or to determine or identify which security is undervalued, overvalued, or correctly valued, we are going to compare the required rate of return and the expected return. So we're going to have another table for, this is 3. We have a table for security A, B, C, D, E. Then from the information given, we have expected return. We have a column for expected return. A, 20%, B, 14%, C, 15%, D, 12%, E, 31%. This you are going to compare with the required rate of return, required return that we've got determined here. It's 21, 16, 18, 12, and 26. So to determine whether a security is overvalued, undervalued, or correctly valued, we compare the required return against the expected return. Now someone tell me, is security A overvalued, undervalued, or correctly valued? Roger says undervalued, undervalued, undervalued. Roger says undervalued. Any other attempt? Anna says overvalued. It is above the expected. So it is overvalued, correct. Overvalued. Security A is overvalued. Now, candidates, you need to understand that expected return is the return an investor anticipates earning from a security. And required rate of return is the minimum return an investor expects to compensate for the risk of investing in the security. So when the expected return is higher, let me begin with that. When the expected return is higher than the required rate of return, it means the security is potentially offering more return than investors demand for its level of risk. And that suggests the security is undervalued. And it might be a good investment opportunity. But in this case, in the first case, the expected, in our case here, the expected return is lower. This expected return is lower than the required rate of return. That indicates that the security is not meeting investor expectations for its level of risk. It is therefore considered overvalued. And investors might be less inclined to invest in it unless the price drops. So security A is overvalued. Now, with that knowledge, what do you think of security B? Is it overvalued or undervalued, security B? If security A is overvalued, what of security B? I've seen many candidates confusing. That's why I'm taking time to explain, so that you don't just memorize, but you should have the understanding. Why is it overvalued? I've explained why it is overvalued and the implication of overvaluing it. B is overvalued. That is what Jackie says. Overvalued. Jackie says overvalued. That is correct. Security C. Overvalued. Security D. B is overvalued. D. 12. This one is correctly valued. Correctly valued. Correctly valued. Then the last one is definitely undervalued. Undervalued. It is undervalued. So that would earn you just 2 marks. 2 marks. 1, 2, 3, 4, 5. 2 marks.
Hello learner, welcome to Manifested e-learning platform. My name is FAM Lingwiri, and today, ladies and gentlemen, we are discussing about the financial modeling and data analytics paper, December 2023 sitting. The focus is on question 23, and you are presented with the following information right on the left of your screen here. You'll be given the stock name, Z-Term Kenya Limited, Car Assemblers, Ujenzi Centum, Cement, Kilimo Bora, Nairobi All Share Index, and you've been given the ticker symbol right over here. You've also been provided with the portfolio compositions, and all of these total to 100%. And how you can be able to just quickly check is by scrolling down over here, and you can see that the sum is 100% right here. You are presented with the weekly returns for all of those companies, or all of those 4 companies, including the Nairobi All Share Index. Now, you are required to calculate the weekly returns for each of the individual stocks and the Nairobi All Share Index, calculate the wage portfolio, the average portfolio return for the historical period. You're told to calculate the standard deviation for each of the individual stocks and the Nairobi All Share Index. Then you're told to calculate the standard deviation for the portfolio returns to assess its risk, and to calculate the beta each individual stock of the portfolio, which measures its sensitivity to the market movements. And you can see these are 20 marks. This is 20 marks question. So the way I've decided to arrange the information is to arrange it as you can see on the right of your screen over here, to calculate the weekly returns for each of the individual stocks of the Nairobi All Share Index. So we just pick average, not average A. You can see the average right over here, and the average of what? We want to pick the average for Z-Term Kenya, to pick the average values right here. Up to there. close the brackets, then you enter. So we're saying that the average return should be negative 0.2%. Let's put it to maybe say 2 decimal places. That 2 decimal places is up to there. And if we were to drag it moving towards the right, we wouldn't be wrong, because we're saying that it picks the average for car assemblers. You can see car assemblers, it picks it right there. So that's what they're saying, the average, the weekly returns is given to us right there. Escape. We move ahead and answer part B of the question. You are told to calculate the average portfolio return over the historical period. We have been given the portfolio composition, and the portfolio composition can be linked with this top part right here. The portfolio composition is there. Enter. And we link it with all of them towards the right, control R, like that, so that you can be able to pick the portfolio composition. Remember, we have computed the average weekly returns above here. So we just link it with up above there, and then we drag it, control R, like that, the same values, excluding the all share index. Because this, all of these portfolio composition total to 100%, as you can see down here, we cannot be able to include the all share index into our portfolio. How do we get the average portfolio return? Pick plus, we open the brackets, that value times the average weekly return plus that value times that value, close the bracket, the portfolio composition multiplied by the average weekly return, close the bracket, and then we add finally the portfolio composition for Kilimo Bora, and we multiply that with the average weekly returns, like that. Oops, that, close the bracket, and we enter. So I think I didn't put open a bracket here, that's why it's giving me those values there. So we open a bracket over here, and then once we close it like that and we decide to enter, it will actually be okay. So we only want it into the 2 decimal places, so we just sort of reduce it like so to 2 decimal places, like that, 0.35%. Now once we've gotten our portfolio return as 0.35%, we can move on to part C. Calculate the standard deviation for each of the individual stocks and the Nairobi All Share Index. That's 4 marks. So average standard deviation would be, we pick STD, stud dev, not P, because we're not picking for the entire population. We want stud dev, standard deviation for the sample. So we double click that, and we can be able to just pick the value for these values here. We highlight this value for Z term. So we highlight it down like that, and it picks to calculate for us the standard deviation for Z term. And we move up over here like this, we can be able to see we already have that given to us there. And if we were to drag it moving towards the right like so, up till all share index, it will actually pick the standard deviation. Remember, for example, this one is picking the standard deviation of the sample for the index, for the Nairobi All Share Index right here. Part D, we asked to calculate the standard deviation of the portfolio returns to assess the risk. And we're saying for us to be able to do that, we will need to consider the weights. And the weights would mean that we've already had the standard deviation over here, compared to us over here, but now we need to factor in the weights. And we're saying it's going to be, we pick that standard deviation times its corresponding weight over here, the corresponding weights were given to us over here. We can use that, or we can even use this portfolio composition right over here. So we close the bracket and we open another one over here so that it can actually pick the values as the way we want them. Then we add the standard deviation over here. I forgot to open the brackets, so we open it right above over here. You can see it on the formula bar here. So we open the brackets there, and then we multiply that with co-assemblers corresponding portfolio composition weight. We open the brackets, we pick Ujenzi Bora standard deviation, weekly standard deviation, times the Ujenzi cement over here. Then we close the brackets, plus we pick this value here and we multiply that against that value there. Open the brackets and we close the brackets like that, and we just click enter. So we can be able to put it in form of weights, and we can say it's about 06.02% standard deviation. So standard deviation of the portfolio is given to us there. So you pick the standard deviations of the individual securities and we multiply them by the corresponding weights. Then finally, we are asked to calculate the beta for each individual stock in the portfolio, which measures its sensitivity to market movements. The beta is given by covariance of the market and stock, so you can put it like so, covariance of the market and the stock. Then we divide that against the variance of the market, like that. And that's what we're saying we're going to do. Covariance of the market and stock, or covariance of the market. So we pick covar S, because we're looking at a sample, covariance, and we open it up right over here. Covariance of what? Covariance of the market. This is the market over here, so we highlight that part. Covariance of the market, and on the second array here we put the stock itself over here, bearing in mind like that, covariance of the market and stock like that, and you can see what we've done, covariance of the market and stock. So we can lock the one for the market, so we are saying this one for G is one that you can be able to decide to lock, F4 and F4. Why are we locking it? Because we want to ensure that the covariance of the market remains like that. And then we do what? We divide now, divide by, you can see the variance like this. We divide against variance, or we just put it like that, variance of the market. But now, before we do the variance like that, we can say okay like that, because that's just the covariance like that, because you can see from the formula by just the covariance. Then we continue and say divided by the variance, not var P but var S, sample, variance of the market, based by this variance of the market. So we pick the variance of these values here and we lock it. So press F4 like that and we close the brackets like that. There, that's our beta, 0.0932. And if we are to drag it moving towards the right, let's just confirm. Covariance, remember we have locked, that's the purpose of locking. This one, covariance of the market. Look, this one has moved from initially Z term to now car assemblies. You can check the previous one over here, escape, check the previous one, you see it is now currently at Z term over Z term here. Now we move on to the second one, it actually picks, but it remains, this one remains, the variance of the market remains, the covariance of the market remains. So we can be able to say that the model is foolproof. Control R. But let's see if we're actually doing this the correct thing. We want to try and prove if we were to pull it towards the right, if you're going to get a beta of 1. You can see we already have beta of 1. Beta of the market is always 1 because it's covariance of the market. It's covariance of the market against the market divided by variance of the market. We always have that value being 1 there. And so with that, ladies and gentlemen, we have come to the end of question 23. Thank you for being with Manifested Publishers. We always here for you. Be blessed.
Hi student, welcome to Manifested Online Classes. My name is Joseph Kemani. In this session, I want us to look on a subtopic number 2 in topic number 3. Topic number 3 relates to the preparation of financial statement of various different entities. And in this particular class here, I want us to look on how the professional firms prepare their financial statement. So first of all, what are professional firms? These are those particular firms which are formed in order to provide some professional services to their clients. And good examples of professional firms include what refer as the accounting firm, an auditing firm, law firm, and so on. Those are good examples of professional firms which provide certain professional services to their clients. Now, at the end of the year or once the year comes to an end, definitely the owners or the partners of such professional firm must determine how their firms are performing and also their financial their financial position. That's why it is important for these particular firms to be able to prepare their financial statement. And therefore, our main interest as far as this particular topic is concerned is to discuss, or basically we're going to look on the financial statement which the professional firms are or basically which professional firms do prepare. But before you do that, we can say that professional firms are those firms established to provide professional services to their clients. Professional services to their clients. So what are good examples of a professional firm? So examples include number 1, we have an accounting firm. Number 2, we have an audit firm. Number 3, we have a law firm, etc. So these are good examples of professional firms which are established to provide certain professional services to their clients. Now, what you have said is that the partners, or basically the owners of this particular professional firm, definitely they're interested with performance of their business and also the financial position of their firms. And that's why it is important for these particular professional firms now to prepare the financial statement. But before we look on the various financial statements which are prepared by professional firm, I want us to define some terms here. We look on the definition of various terms. Definition of terms. So some of the terms we need to define here. Number 1 is something called a profession. a profession. A profession. So when talk about a profession, generally, we say that this is a recognized field of study which involves some training and also some examination by a certain professional body. So therefore, a profession is a recognized field of study. So therefore, you can say that this is a recognized Yes, so therefore a profession here we are saying is that recognized field of study, and which involves some training and also some examination. In this particular examination we are saying it is administered by a professional body, e.g. what? A Kasneb. For instance, for you to be able to set up maybe something like an audit firm, to establish an audit firm or maybe an accounting firm, definitely you must be a qualified accountant. So for you to be a qualified accountant, you need to undergo through some training. You need to attend a college which is offering some professional courses such as CPA, such as ACCA. You go through that particular training, and by the end of the day you have now to sit and pass a certain exam which is administered by a professional body, e.g. Kasneb, e.g. ACCA, and so on. That's why we are saying that when talk about now a profession here, it is that particular recognized field of study. So the other term which we also need to define here, as far as the professional firms are concerned, is something called the cost charged to the client. Cost charged to the client. When talk about the cost which is charged to the client, in other terms, this can be referred to as the fees which has been earned. A professional firm, we are saying, by the end of the day, provides certain professional services to who? To the client. Once a professional firm has provided those particular services, the client will be charged. The client will be charged some amount because a professional firm incurred some cost in terms of providing those particular services. So therefore, you can say that this is the fees. This is the fees charged by a professional firm. Charged by a professional firm to its clients, for services rendered, for services which have been rendered. For services rendered. Anytime a professional firm provide certain services to the client, automatically those particular clients will be charged a certain fee. And actually, this particular fee which is charged by a professional firm, this is the main source of income as far as these particular firms are are concerned. So the other term we also need to define here is something called a client account. A client account. When talk about the client account, this is basically an account which is prepared by a professional firm to record all the transactions relating to the client. For instance, money which has been received on behalf of the client, and maybe any disbursement or any payment which has been made on behalf of the client. All those particular transactions which now relate to the client, they are recorded in this particular account. So this is an account which records all transactions relating to the client, relating to who? To the client. Any money which has been received on client behalf, and also any payment which has been made on client behalf, all those particular transactions will be recorded in that particular what? Account. So the other term we also need to define here is something known as WIP, work in progress. Work in progress. So what is work in progress? Work in progress basically refers to the services which are rendered to the client. These are those particular services which are rendered to the client, but when the year is coming to an end, those particular services will not have been completed, assuming you have a professional firm, like maybe an audit or an accounting firm. You have gotten a client, or maybe you have a client and you're providing certain services to that client, but when the year is coming to an end, you have not yet completed those particular services. So meaning that because you are yet to complete those particular services, it means that you have not invoiced your client, you have not sent an invoice to your client for the client to be able to pay for those particular what? Services. So therefore we say that this is still work in progress, work which is still going on when the year is coming to an end. So we can say these are services Yes, so therefore these are those particular services which are provided to a client but not completed at the end of the year. And therefore, because this work has not been completed, then we have said the professional firm will not have invoiced the client for the client to be able to do what? To pay. Meaning that this particular work in progress, when a professional firm is preparing a statement of financial position, it is treated as a current asset. Services which have been provided, but because they are not fully completed, the client has not paid for them. It is basically like an accrued income, which should be treated as what? As a current asset. So the other term we need to define here is something called disbursement. Disbursement on client behalf. Disbursement on client behalf. When talk about the disbursement on client behalf, this refers to any payment which has been made by a professional firm on behalf of the client. Any payment by a professional firm on behalf of the client. Yes, any payment by a professional firm on current what? Behalf. And therefore, this particular payment which has been made by a professional firm on current behalf, automatically the professional firm expects to recover the same from the client. So this amount is recovered from the client. Recovered from who? From the client. From the client. Yes. So therefore, these are basically some of the terms which you need to, or which you must be able to define as far as the professional firms are concerned. And think from there we can then proceed and look on the financial statement prepared by a professional firm. Financial statements prepared by a professional firm. A firm include what? We have two main financial statements which are prepared by professional firm, and those particular financial statements include: one, the income statement. We have the income statement. income statement. So the income statement, in other terms, is also known as statement of profit or loss. Statement of profit or loss. And number 2, we have the statement of financial position. Statement of financial position. So therefore, any professional firm at the end of the year must prepare those two financial statement, income statement or statement of profit or loss, and the statement of financial positions. Sorry, the statement of profit or loss, that is income statement and the statement of financial position. So let's start by looking on what is a statement of profit or loss. Statement of profit or loss, and why this financial statement is prepared. Now, a statement of profit or loss or an income statement, this one is prepared to determine the performance of a professional firm, to determine whether a professional firm operated at a profit or at a loss. And therefore, this income statement is prepared to compare the incomes of a professional firm with the expenses incurred by a professional firm during that particular financial year. So therefore, you can say that this is prepared to ascertain the performance, performance of a professional firm, firm. On the other hand, we have said it compares incomes and expenses. It compares incomes and expenses of a certain financial year, and automatically the difference between now the incomes and expenses here is a profit or a loss for the year. A profit or a loss for what? For the year. So let's look on the format, how we prepare the statement of profit or loss. Format of statement of profit or loss. And this one is prepared for a certain year, for the year which ended on a certain date. On a certain date. Remember, we have said that in preparing the income statement, generally what we do, we compare now the incomes of a certain financial year with what? With now the expenses for the same financial year. Equally, when preparing this statement of profit or loss, we prepare it using a vertical format. So here we start with the incomes. And for the incomes, first of all, we start with the cost, which was charged to client. Cost charged to client. Remember, in this case, we have said cost charged to the client is the same with the fees which was charged to the client. A professional firm, after providing certain services, it will charge a client some fee, which is basically the main source of income. And then now to this, there is something which we add here, which is known as the crossing work in progress. Crossing work in progress, this is like the accrued income at the end of the year. These are those particular services which will have been provided when the year is coming to an end, but because those services are not fully completed, the client has not paid. This is like an accrued income at the end of the year. Add it to that figure, and then to this you less opening work in what? In progress. Opening work in progress. So then whatever you get here is the net cost charged to client, net cost charged to client. And then now to this we add any other income. We add any other income, e.g. investment income. If a professional firm is having any other income, we come and we add it there. And then what we do, we get the total income, we get the total incomes of that financial year. To this now total incomes, we proceed and we less now the expenses. So some of the expenses which may be incurred by a professional firm will include things like the salary to staff, expenses, we record them in the first column, things like depreciation on PPE. These are tangible and current assets which are owned by a professional firm. Things like furniture and fittings, motor vehicles, and so on. Things like rent, ETCs, and maybe things like stationery and printing. These also are a common expense which may be incurred by a professional firm. So we get the total expenses, we take them to the last column, and we deduct this from the total incomes. Whatever you get here is the profit or the loss for the year. So automatically if you get a positive figure there is a profit, but a negative figure there is what? Is a loss. So that is how a statement of profit or loss or an income statement is prepared by a professional firm. Then let's look on how we prepare now a statement of financial position. Number 2, we have a statement of financial position. So when talk about the statement of financial position, this is a statement of asset, liabilities, and what? Capital. So we can say first of all that this yes, so it is a statement of assets, capital, and what? Liabilities. This statement of financial position will be prepared to record these items, to record this particular item. On the other hand, when a statement of financial position is to be prepared, it is prepared based on something known as the accounting equation. We can say it is prepared based on accounting equation. So the accounting equation basically is a fundamental equation in accounting. Is a very important equation in accounting. In fact, the concept of double entry is based on this particular equation there. So this equation states that assets are equal to capital plus liabilities are equal to capital and what? And liability. So let's look on the format. How do we prepare this statement of financial position of a professional firm? Statement of financial position. Is at the end of the year, because this one we have said is prepared at the end of the year to show the asset, the liabilities, and also the capital of a professional firm. Always we start by recording assets, and asset we classify them into two, non-current and current. So here we start by recording current assets, that is non-current assets, and in this case we just need to have a single column there. So some of the non-current assets which may be owned by a professional firm may include things like furniture and fittings, things like motor vehicles, things like maybe investment property, etc. You come and you record all those particular assets here It is also important to note that when recording the non-current assets there, we record them at their net book value. So to compute the net book value of this particular asset, we take their cost minus the accumulated depreciation at the end of the year. The cost minus the accumulated what? Depreciation at the end of the year. Then from there we proceed, record the current assets. So for the current assets, these include things like cash and bank balance, cash and bank balance. And this cash and bank balance will be the cash and bank balance in, first of all, something known as the current account. Mostly the professional firms operate two different accounts, an account or a bank account known as a current account. Current account is whereby money belonging to the current, any money which has been received on behalf of the current will be deposited, and then another account which is known as office account. Office account is a bank account whereby money belonging now to the professional firm is recorded. So we have cash and bank balance, and then we have things like the crossing work in progress. Crossing work in progress is still a current asset. We also have disbursement on current behalf. Remember, you have said disbursement on current behalf. This is any payment which is made on behalf of the client. A professional firm, by the end of the day, expect to recover that money from the client. And things like the receivables, any amount of money, maybe which is not yet paid by the client. And then we get the total asset here. We get the total asset. So after getting the total asset, we double underline that, because now we are through with the first part of our statement of financial position. And then from there we proceed and record capital and liabilities. So we start here by recording capital. Then to this capital we add or minus, plus or minus the profit or loss for the year. So a profit is added to that capital, whereas now a loss is deducted. Also, if you are given drawings basically refers to any amount of money which is taken by the partners of a professional firm for their personal use. And then what we get here is the net capital. Net capital basically is the capital at the end of what? Of the year, at the end of the year. So then from there we proceed, we record liabilities. But for liabilities here, we start by recording non-current liabilities. Non-current liabilities, these may include things like bank loan, those particular liabilities which are payable for a period exceeding 1 year. And then finally we record the current liabilities. So current liabilities are liabilities payable within 1 year. This will include things like payables, or basically trade payables. This is the amount of money which is owed to the suppliers. Things like what? Things like money held on client behalf. Money held on client behalf. Money held on client what? On client behalf, and so on. And then from there we get now the total capital and liabilities. Total capital and what? And liabilities. Total capital and liabilities. And whatever you get here is the total capital and liabilities. Always this one must be the same with the total asset. Because you are saying that this particular statement of financial position here is prepared based on this equation, which state that total asset here should be equal to capital plus what? Liability. So whatever you get here is the capital and liability. Total capital and liabilities must be the same with what? The total asset. So therefore, those are the financial statements which are prepared by the professional firm. We take a break, and then in our next session, we look on an illustration question as far as the preparation of these particular financial statements are concerned. So see you in the next lesson.
Hello Lana, welcome to Manifested e-learning platform. My name is F.A.M. Ningwiri and I am a practitioner within the financial services industry in Kenya. Ladies and gentlemen, today we are going to discuss about portfolio management. The focus is on contemporary issues and emerging trends. We are going to discuss about program trading, and we say the following, I can write the following, that it refers to volume trading, which is done by systems, executed by systems, usually automated, based on an underlying, let me write it properly, apologies for that, based on an underlying program or idea. Let's stop there for 1 second, guys. It refers to volume trading, which is done or executed by systems, usually automated, based on underlying program or idea. It is a wide range of portfolio strategies. It is a wide range of portfolio strategies, involving the purchase or sale, of stocks. We can say purchase or sale of 15 or more stocks, 15 or more stocks having a total market value, total market value of $1 million, $1 million, or even more, Stop there. It is a wide range of portfolio strategies involving the purchase or sale of 15, ladies and gentlemen, or more stocks having a total market value of $1 million or even more. Now, once we have introduced what program trading is, it can almost be referred to as algorithmic trading, high volume trading that involves the utilization of a given number of strategies, ladies and gentlemen. And we're also saying that the strategies could be, or the types could be either principal, they could be either basis or even contra-day strategies thereon. So we can continue and say that program traders are almost always, program, can come on this other side, traders are almost always, almost always program traders are almost always executed by computers. Executed by computers. Although there are instances, we can say although there are instances in program trading, there are instances when this isn't the case. When this is not the case, for example, institution X, institution X wants to sell a basket of 15 stocks. Wants to sell a basket of 15 stocks totaling $2 million. Totaling to $2 million. $2 million. $2 million. It would simply split up. It would simply split up the sale among different brokers. Among different brokers. In other words, you're saying that people plan the strategy and you're saying the computers are the ones that do the work. So traders are almost, I've written R twice, are almost always trades are almost always executed by computers. But although there are instances when this is not the case, for example, institution X wants to sell a basket of 15 stocks totaling $2 million. It would simply split up the sale among different brokers. So when people plan strategies and the computer does the work, this is how program trading looks like. So we have this computer right over here. Please forgive my drawing right over here. And I'm saying that here is where the coding or the codes are actually created. Of course, there has to be what you're calling the CPU right over there like that, and it's the one that actually does or processes or executes trades. Buy and sell. You can put it in a different color over here. Buy and sell. Buy and sell of securities. Buy and sell of securities. Then we are saying the types can be of 3 of them. Types of program trading can be where the principal over here, we are saying this is where replication of an index is actually ensued. So replication of an index, where the portfolio manager or the strategies try to copy the returns that have been generated by an index. And that is all done by the program trading or by the computer. So replication of an index. Then the second type of program trading is basis over here, and over here trying to identify price inefficiencies, strategy to identify price inefficiencies. So the computer tries to identify price inefficiencies, trying to identify undervalued stocks, or tries to identify undervalued stocks. Undervalued stocks is what the computer system actually buys those stocks, of course using an algorithm, and the overvalued stocks are actually sold. Then finally, the third type of program trading is contra trading, buying and selling through buying and selling consistently like that. So we're saying we buy in one market and sell in another market right there. So we're saying that's what happens in a contra. Buying and simultaneously selling the same security. Buying and selling the security simultaneously. So of course this uses futures or options, and that is actually executed using the computer system. So we're saying what? We're saying that the types of program trading include the principal, which involves replication of an index, and that is done by the system, by the computer system or algorithm. Basis trading, which involves a strategy to try and identify pricing inefficiencies, undervalued stocks and overvalued stocks. Then there is contra trading, where you buy and sell securities simultaneously in different markets using futures contracts. Let's move over on this other side. Let's look at the advantages. Advantages of program trading. We're saying it is quick to execute and implement. It is quick to execute and implement. Number two, over here we say places trades according to strategy. It places trades according to strategy. Number three, exploits opportunities without emotions. It exploits opportunities without emotions. So it is quick to execute and implement. Execute and implement are the keywords there. Second, it places trades according to strategy, either basis, principal, or contra, actually executed using algorithms. So you can be able to come up with an algorithm that actually executes principal strategies, basis strategies, and even contra strategies. Very simple. It exploits opportunities without emotions. That is very key. So having looked at the advantages, we move over and discuss the disadvantages. Disadvantages. We are saying that number one, it brings about extreme volatility. For example, in the 1990s, it brings about extreme volatility. And for example, in 1990s, there was a bit of a flurry of activity that took place as a result of program trading. Number two, it is expensive. It is costly to implement and trade. It is costly to implement. So these are the two main disadvantages over here, that it brings about extreme volatility, for example, in the 1990s, and it is costly to implement. So this brings us to the end of the lesson. We hope you have enjoyed it, and I will leave you the assignment. The assignment is as follows, right down here. Assignment. Explain what is meant by program trading. Explain what is meant by program trading. So thank you for being with Manifested Publishers. Continue being with us, and we are here for you.
Hello and welcome back to the lesson. Today we are going to distinguish between auditing and accounting. Auditing and accounting. These are both essential components of the financial reporting process, but they serve distinct purposes and have different roles. We all know that accounting is a process of identifying, summarizing, reporting, recording, and interpreting of economic information so as to allow the users to make informed decisions. Auditing, on the other hand, is the systematic and independent examination of the financial records of an organization to ascertain the accuracy, to ascertain their compliance with the laws and regulations, and to ascertain the reliability and fairness. Do you understand? So in distinguishing the two, one distinction can be on the basis of definition. Definition. Defining. Definition. You can distinguish auditing and accounting by just defining the terms. And you have said that these are both essential components of the financial reporting process. I've defined the two. Then another basis for distinction is the purpose. Purpose. What is the purpose of accounting? What is the purpose of auditing? Now, the primary goal of accounting is to identify, to record, to classify, summarize, and communicate financial information about a business or an organization. To account is to record, to identify, to classify. In accounting, we summarize information. Then that information is communicated so that the users can interpret it and make their own informed decisions. That is the purpose of accounting. Now, the purpose of auditing, the primary goal of auditing is to provide an independent and objective assessment of the fairness and reliability of an organization's financial statements. The primary goal of auditing is to provide an independent and objective assessment. So an auditor, after the records have been prepared by the accountant, the auditor is required to carry out an independent assessment of such records in order to ascertain their fairness and ability. So that is another distinction based on purpose. The two can be distinguished based on the process. Process. Accounting or accountants maintain financial records. They prepare financial statements such as income statements, such as balance sheets, such as cash flow statements. and then analyze financial data to provide insights to management and the stakeholders. Accounting is a process of identifying, summarizing, recording, classifying, and then interpretation of financial data. You understand? Whereas auditors examine the financial statements and the underlying records, because every financial statements must have supporting records like the invoices, the receipts, the notes, the delivery notes, the bank statements. Those are the underlying records or information. So the auditors examine the financial statements like the balance sheet, the income statement, as well as the financial information or the supporting documents, the underlying documents. They examine the financial statements and underlying records. They also assess the effectiveness of internal controls. They test the accuracy of financial information in order to ensure that it complies with accounting standards and regulations. You understand? That is the difference in terms of the process. The two have different stages in carrying out their functions. The auditors and the accountants, their stages are different. The processes are different. The fourth distinction can be on the basis of focus. Focus. Accountants focus on day-to-day operations. The day-to-day operations. They give an account of every transaction on day-to-day basis. When purchases are made, they record. When a sale is made, they record. When they pay expenses, they record. When they pay workers, there is a record. So every transaction that is carried out, every transaction, financial transaction that is done, accountants do so. They record such transactions on day-to-day basis. Accountants focus on the day-to-day operations of the accounting system, ensuring that financial transactions are recorded accurately and they are in compliance with accounting standards. That's a focus day-to-day, all right? Auditors, on the other hand, focus on verifying the accuracy and reliability of financial information, identifying potential errors or fraud. They also assess the effectiveness of internal controls. So their work is not on daily basis like the accountants. The focus is different. They do not record transactions on day-to-day basis, but they examine, they verify the accuracy and the reliability of financial information that is provided by the accountants. You understand? The fifth output. The output of accounting is the presentation of financial statements, which present a picture of an organization's financial position and performance. That is the output of the accounting process. It is a process which begins with the preparation of source documents. It goes on to the recording of the journals, the ledgers. The trial balance is then extracted from the ledgers. Then the financial statements are prepared and presented. So the output of the accounting process is the preparation of financial statements, which present a picture of an organization's financial position and performance. Financial position is depicted in the balance sheet, and the performance is depicted in the income statement. Do you understand? That is the output. Now, for auditing, the output of auditing is the audit report, which includes the auditor's opinion on the fairness of the financial statements and any recommendations for improvement. So the output for accounting process is just the financial statements, the income statement, the cash flow statement, the balance sheets. As for the audit process, the output is the auditor's report, which contains the auditor's opinion. The auditor may also have recommendations to the company where maybe is identified areas of weakness. So candidates, that is the distinction between accounting and auditing. These two can be distinguished on the basis of the definition, the purpose, the process, the focus, and the output. Okay? So accounting is the process of recording and reporting financial information, while auditing is the process of verifying and assessing the accuracy and reliability of that information. So the accountants do the recording and presenting the financial information. The auditors then come after to assess, to examine, to verify the accuracy and reliability of the information that is provided by the accountants. So both functions are essential for ensuring the transparency and credibility of financial reporting. The auditors cannot perform any task unless they rely on the work that is done by the accountants. And auditors are primarily accountants. For one to be an auditor, then one has, first of all, to be an accountant. So auditors are accountants, because you cannot verify and ascertain the accuracy of a process that you do not understand. So auditors essentially are accountants, and both functions are essential for ensuring the transparency and also the credibility of financial reporting. So that is the end of the lesson. Assignment 1. What are the fundamental differences between auditing and accounting in terms of their purpose and focus? 2. How do the outputs of accounting and auditing differ? 3. Describe the relationship between accountants and auditors in the financial reporting process. 4. What are the different skills and knowledge required for accounting and auditing professionals? Thank you for attending the lesson. In our next session, we are going to study the types and classification of audits. Bye.
Hello class, welcome to lesson number 2 of our topic number 5. In this lesson, I will be considering the raising of capital. The raising of capital by companies. Now, you will notice that companies will have two options in the raising of their capital, that they can either raise capital from the members of the public, where they are looking at external sources of capital, particularly share capital. Then they also have an internal, internal options where they can be raising additional capital from within their existing membership. So I want to list a number of ways by which companies will be raising capital, which we shall subsequently be discussing. So we have methods such as a direct invitation available to the company, offer for sale is also an available option to the company. The company could also do placing We could also have a bonus issue of shares. It is also possible that we have a rights issue. It is also possible that we have a rights issue. We can also look at the possibilities of a conversion issue. It is also possible that we can have a scrip issue. So these are some of the ways that are available for this company to raising share capital. We shall see some of them are external sources, while others will be internal sources. So where this capital is being raised from an external source, we shall be looking at this process known as the flotation process or floating of shares, which is the legal process by which by which a company avails its securities to the public, by which a company avails its securities to the public. You notice, the moment we talk about availing securities to the public, then we are particularly referring to only public companies. Private companies may not have this option available to them. They will not be approaching the publics to subscribe to their securities. So some of these methods involve a public invitation in a flotation process. Others will not be involving a flotation process. So we want to look at them one by one and see which ones of them, which of these methods will be involving the flotation process and which ones will not be involving the flotation process. So beginning with the first of those methods, which is the direct invitation, the direct invitation. In a direct invitation, the company intending to raise capital prepares a prospectus. They will be preparing a prospectus, which is an information tool, a document by which the company will be giving information to possible subscribers, to the members of the public about itself. So in this document, the company will tell the members of the public about how long they have been in business, who are the managers of this company, what kind of business they are involved in, how much capital they wish to raise, what number of shares are they issuing, value per share, rights of these shares, a lot of information that is supposed to give the potential subscribers enough information on which they are to base their decision on whether they are going to buy these shares or not. So once the company has prepared prospectuses inviting the public to subscribe for these shares, there is a risk that the members of the public may not respond to this prospectus issue overwhelmingly. For instance, if through a direct invitation where we are issuing a prospectus inviting members of the public to buy securities, let's imagine we want to raise 100 million worth of share capital by way of a prospectus issue. There is a risk that the subscriptions we get from the members of the public could only maybe be at 70 million. Sometimes it could be worse. We may be falling at 70. So that we have a serious deficit with respect to the target of 100 million. Then it therefore becomes necessary that this company doing a direct invitation to raise share capital may now be required to do what we call underwriting the issue. In underwriting the issue, the company gets into contact with an underwriter. Underwriters will usually be investment banks or insurance companies, which will be giving a commitment to the company issuing shares that for some commission, we refer to as the underwriting commission, that they will take up a percentage or the whole of the capital or the whole number of shares that will not be taken up by the public. So possibly they are saying, we will take up everything else that is not taken up in the issue. So if this company invites the members of the public to subscribe to a share capital worth 100 million and the public only take up 70, the underwriting arrangement could be such that the underwriter is to take up the balance of 30 million that has not been taken up. So the underwriting gives the issuing company some confidence that at the end of the day, once we invite the public, even if they do not subscribe to the entire amount of share capital that we wish to raise, then the underwriter can come in and provide the whole of the balance or part of the balance as will be agreed in the underwriting contract between the issuing company and the underwriter. So something that should come out very clearly in the direct invitation, this company that wishes to raise capital by way of a direct invitation will have to go into the details of preparing and issuing a prospectus. Now, in the prospectus issue, there is a lot of publicity that this company has to create, that they have to do a lot of advertisements through TV, through radio, through newspapers, just to sensitize the public. Let the public be aware that we are in the process of raising our capital, that we're in the process of issuing additional shares. Let the public know that there are shares that are available for them to subscribe. And then, of course, with the risk that we run, that all these shares may not be taken up, the issuing company may also have to arrange for underwriting, where they get an underwriter to commit to them that any portion or part of any portion of this share capital that may not be taken up by the public, then the underwriter will provide consideration for such amounts. So that is the direct invitation. We have another option that is available to these companies, which is the offer for sale, an offer for sale. In the offer for sale, the company that wishes to raise capital involves a second company that we shall refer to as the issuing house. So what happens is that the company raising capital will allot, they will allot all the shares, to the issuing house. They will allot all shares to the issuing house, so that this issuing house now goes on to take up what the company raising capital would have done. So the issuing house takes up responsibilities such as preparation of the prospectus. They will also be arranging any underwriting if necessary to underwrite the issue. So in a way, in the offer for sale, the company wishing to raise capital gets another company to do the work for them. So this second company is the issuing house. It is the second company that now takes up the responsibility of preparing prospectuses on behalf of the company that wishes to raise capital. If underwriting is necessary, it is the second company that also takes up the responsibility of ensuring that the issue is underwritten by an underwriter. So that when we now have applications made for shares of this company, then the issuing house will be renouncing their allotment in favor of any applicants who apply for these shares. So the main difference we notice between these two processes, in the direct invitation, the company raising capital goes directly to the public, prepares the prospectuses by themselves, and if any underwriting is necessary, they also underwrite by themselves. In the offer for sale, they get assistance. They transfer the responsibility of the issue to a second company known as the issuing house. How so? That they are allotting all the shares to the issuing house, which in turn now issues them to the public. By preparing a prospectus on behalf of them, they also arrange underwriting if necessary on behalf of them. And should we be receiving any applications for the shares of this company, which had been previously allotted to the issuing house renounces their allotment in favor of the applicant that they receive in respect of these shares. Then we have the third option that we may have, which is the placing option. In the placing option, we still have our company that wishes to raise capital by way of issuing shares. But something different you will notice this time round, this company will not be going to the public directly, but still they will be using an intermediary. The issuing house will still be involved. So in the placing option, the company allots the shares, the company allots the shares to an issuing house which then offers them to specific persons, or institutions or organizations. Now, in this case, because we are not inviting the publics directly, then we are saved from the inconveniences and all the costs of doing a prospectus. Then we shall also not be faced with the risks of doing an underwriting. That what the company that wishes to raise capital is doing is, they are allotting all these shares to an issuing house, and then they give them the responsibility of having these shares offered to possible or willing investors. So the issuing company approaches individuals who maybe they have a relationship with, who maybe they are sure that if they pitch to them the idea of buying the shares of this company, then they will. Because of the fact that they are not going to the publics directly, then in this placing process, we are excused from preparing prospectuses. We only prepare prospectuses when the issue is a public issue, when the issue is targeting the public or a section of the public. But in this case, because we are attending to individual institutions, individual organizations, individual persons, then we are excused from the preparation of prospectuses. Now, these two methods will be the preserve of public companies because the public is involved. As you will already be aware of, private companies by their articles restrict the invitation, actually they prohibit the invitation of the public to subscribe to their securities. So they cannot be doing a direct invitation, they cannot be doing an offer for sale. But a placing option is available for them because the publics are not being invited directly. Now, we have these other options available. If you look at these three options, the companies were targeting outside sources to increase their share capital. In the remaining of the sources, then the company will be targeting internal sources to increase its share capital. For instance, a bonus issue. A bonus issue. What will be a bonus issue? This is the issue. This is the issue of additional shares. The issue of additional shares to existing members in proportion to their current holding, for no direct consideration. We are issuing additional shares to existing members in a proportion. We are getting as much as we have, depending on the number we have. So we are issuing these shares in proportion to their existing shareholding. And most importantly, what makes it a bonus is that they are not giving us any consideration directly. So the question should be, how do we finance a bonus? Now that we are not getting anything directly from the receiving members, where do we get the money to finance a bonus? Bonuses are financed. Bonuses are financed by reserves. E.g. retained earnings. A reserve such as retained earnings could be a possible reserve from which we could be financing a bonus issue. It is because of this reason that a bonus issue is also referred to as a capitalization issue. Bonus issues are also known as a capitalization issue because they present to us an option through which we can capitalize our reserves. For instance, when we plow back our retained earnings and make them part of our capital by issuing or by executing a bonus issue, then we capitalize. The result is that we have capitalized that reserve. Now, for a bonus to be effected by a company, there are some conditions. There are some conditions that are necessary. Conditions for a bonus issue. Conditions for a bonus issue. That there will be some conditions that the issuing company must meet before they proceed on to effect a bonus issue. One of those conditions is that it must be allowed by the articles. We must get the permission of the articles. So the articles must allow. So if the articles of our company do not anticipate a bonus issue being executed by the company, then the bonus cannot be issued. Once we have the articles of the company allowing, then the bonus must be recommended. The bonus must be recommended by the board. The bonus must be recommended by the board. So it comes out of a recommendation of the board that we can increase our share capital by capitalizing a reserve such as the retained earnings. Then with the recommendations, it must be approved. It must be approved by members. It must be approved by members by a vote of the members. So we're imagining a meeting of members where the members are presented with a motion to capitalize reserves such as the retained earnings on the recommendation on the board so that they approve such transaction. Beyond the approval of the members, we're also saying that the company must have sufficient capital. The company must have sufficient capital so that the capitalization should not be a way of creating enough capital for us to work with. This should be seen as extra always. Not that we were already suffering capital crisis or one of the sources of capital we are looking into is a capitalization issue. No. It should always be we are capitalizing to go over and above our present requirements. That we are already not lacking. So when we are in capital problems or capital deficits, then a capitalization issue will not be effected or cannot be effected. The other conditions that we must also be meeting is that it must be within the ratio, allowed by the articles. It must be within the ratio allowed by the articles. So the articles will also go on to tell us how many shares per existing share can be issued as a bonus. So can we get a bonus of 1 share for every 10 existing shares we have? Do we get a bonus of 1 for every 20 shares we have? So the bonus must always again be paid within that ratio that the articles are allowing. Then we are saying that if this company effects the bonus issue, then notice must be given to the registrar. Notice must be given to the registrar. If it so happens that this is a public listed company, then notice has also to be given, or we also have to seek the approval of the markets regulator. In our specific case, we are talking about the Capital Markets Authority. That if the company, in this case, executing a bonus issue, is a public company quoted in the Nairobi Stock Exchange, for them to effect a bonus issue, they will need the approval of the Capital Markets Authority, which is the regulator of the publicly traded companies. So that is the bonus issue and the conditions that we must observe to effect a bonus. The other option we have is the rights issue. In a rights issue, the company is issuing additional shares. The company is issuing additional shares, to existing members, in proportion to their current holding at preferential terms, in proportion to their current holding at preferential terms. So one of the differences you would see between a rights issue and a bonus issue is that in the bonus issue, we were not paying anything, so to speak. We were not giving any consideration for the shares we were receiving in respect of our current shareholding. In a rights issue, we are giving something, but this thing that we are giving, the consideration that we are giving, is at preferential terms. Usually, for companies that are traded, listed companies, the rights issue will be executed at a price lower than the market value. So that if the company in question is a listed company and the current market price at the stock exchange is 50, maybe we could be doing a bonus issue at 45. The idea is we are giving an opportunity to existing members to take up more shares at a lower price. That if these members were to buy these additional shares in the market, they would be paying the 50 shillings. We are now giving them an option to take up more at a lower price, say 45, say 46. Anything lower than the market price would be considered to be a preferential term, would be considered to be a better term offered to these members. So rights issue will have the effect of, again, increasing the company's share capital, but being more so a special opportunity given to existing members to increase their shareholding in the company, that this option is given to the members of the company, that they can take up additional shares at preferential terms by paying less than they would be paying in the market. Now, when the rights issues are being effected by a company, the members will be given 3 options that they can exercise. That members will have 3 options in respect to the rights. That the first option is that they can exercise the rights. In exercising the rights is that they can actually buy those additional shares that the company is offering them in respect to their current shareholding at that preferential rate that they are being given. The second option they have is where they transfer the rights, or simply selling these rights. Now that I have an opportunity to buy these shares at a lower price, it could be the case that I have no money to buy, or I am not interested in taking up any additional shares, but they can transfer that right to another member or a non-member to buy such shares that are being offered as part of the rights issue. Then the third option they have is to ignore the rights. That is the third option. It appears to be the worst of the options that the members can exercise, where the members are simply doing nothing about the rights. That they are not going to buy additional shares that are being offered at preferential terms. They are also not going to transfer their rights to anybody. So the rights simply expire, and those members forego the option to take up these additional shares at the preferential terms that had been given by the company. So if this is a publicly traded company, that is, it is listed in the stock exchange, then to execute a rights issue, this company will require the approval of the Capital Markets Authority, which is the regulator of publicly traded companies. So that's the rights issue. The other option we have is doing a conversion issue. The conversion issue results out of securities, usually of debt nature, that have the right to be converted into equity. That we have issued debt securities maybe in the form of debentures, and we create rights on these instruments, on these securities, that they are convertible at the option of the holder into equity. In such cases, then we are talking about the converting of debt securities, into equity. Converting of debt securities into equity. So the holders of these debt securities, once they exercise this option that debt has been converted into equity, then the result is that we have an option of having raised our share capital, that our share capital is increased as a result of this new equity created as a result of the converted debt. The point is, for this conversion issue to be effected, the articles must be allowing for such conversion, and the particular debt instrument being converted must have the rights of conversion into equity. Then finally, we have the scrip issue. In a scrip issue, this is an option. This is an option to members. This is an option to members to receive dividend by way of additional shares in the company. So at the year end, once we have declared our dividends that we shall be paying this much per share held, the company can give options to its members via its articles that in our company, we have afforded members the option of taking up dividend by way of additional shares. So for mathematical representation, if we have shares valued at shillings 5, and the dividend payable to an individual member for mathematics purposes being 5,000, then we can be giving an option to this shareholder. Instead of receiving your 5,000 Kenya shillings in the form of cash dividend, we are giving you the option of taking up additional shares. So where the value of a share is now currently 5, then this 5,000 is affording this shareholder some additional 1,000 shares. So in this case, this member is being given this option that instead of taking up in cash form the 5,000 dividend, you have the option of taking up 1,000 additional shares in this company. This is a scrip issue. The effect is that we have given ourselves an option of raising share capital as a company. So, dear class, this is the issues that we wanted to consider in this lesson regarding to raising of capital. We have looked at the various options available to the company, particularly the direct invitation, where the company was targeting the public, issuing a prospectus as well as underwriting if necessary. We have looked at the offer for sale, where the company was transferring the responsibility of the issue to a second company. We have also looked at the placing option, where again the company transfers the responsibility to a second company, but this company does not go to the public directly. It goes to specific persons or specific investors and offers those shares to them. Then we have seen these other methods where we are looking inwards. We are looking at internal sources, where the company can possibly do a bonus issue by offering members additional shares for no direct consideration. We have also seen a rights issue being a possibility where we are offering more shares or additional shares to members, but this time round at a preferential rate. Then the possibilities of a conversion issue where the company is offering holders of debt securities the right to convert them into debt. The net effect being that our share capital, equity capital, is increasing. And finally, a scrip issue to those members who are receiving dividends, that we are giving them an option to take up additional shares instead of cash dividend. The result being, again, increasing the company's share capital. So class, that brings us to the end of our lesson 2 on matters raising capital. Thank you.
Hello and welcome back to the lesson. In our today's class, we are going to discuss the development of audit. And in studying the development of audit, we will consider early audit and modern audit, because we all know that the concept of auditing has existed for centuries, with its roots dating back to the ancient civilizations. And in this lesson, we're going to identify some of the early forms of auditing that are primarily focused on the ancient civilizations, the ancient Greece and Rome, the medieval Europe, and so on. So welcome to the lesson. We begin with early audit. Early audit, and the early forms of auditing during the ancient times, the ancient times or the ancient civilizations like Mesopotamia, and Egypt. Early civilization, a good example is Mesopotamia and Egypt. Now, these civilizations developed early forms of auditing to verify the accuracy of government records and tax collections. And that ensured accountability and transparency in the use of public funds. The second example is the ancient Greece and Rome. Ancient Greece and Rome. We have seen, first of all, that the ancient civilizations like the Mesopotamia and Egypt, there was the auditing was developed during that time, and the purpose was to verify government records and to verify tax collections. And in ancient Greece and Rome, in these civilizations, auditing played the role in ensuring proper management of public finances and preventing corruption. For example, in Athens, public officials were required to submit accounts for audit at the end of their term. So during ancient Greece and Rome, the purpose of auditing was to help reduce corruption. In ancient civilizations like Egypt, auditing was used to help account for the government records, financial records, and also to account for the tax collections. That is B. Then C, we have the medieval Europe. Auditing during the medieval Europe. Now, the concept of auditing further evolved with the development of merchant guilds, with the development of merchant guilds. Okay, and these guilds often appointed auditors to review the financial statements of their members in order to ensure solvency and to prevent fraud. And this practice helped to maintain the integrity of the guild and also to protect its members' interests. Now, these are just examples of early audits. And while these audits were not as comprehensive as the modern audits, they laid the foundation for the development of auditing as a profession. And the underlying principles of accountability, transparency, and independent verification remain essential to the auditing profession today. So it is after this medieval Europe period, then we move towards the Industrial Revolution, which came with the rise of joint stock companies in the 19th century. And that marked a turning point in the development of modern auditing. The development of joint companies during the Industrial Revolution. During that period, many companies came into existence, and there was a question or the problem with the separation of ownership and management. Because when you have a joint company, then there is that agency problem, which comes as a result of the separation of ownership and management in the companies, which led to increase the need, which led to the need to have independent verification of financial statements to protect the interests of the investors. And that leads us to modern audit. We are studying development of audit as a profession. So we have modern audit. And I've said that modern audit, as we know today, evolved based on the early audit, the ancient civilization, the ancient Greece and Rome, the medieval Europe. The practice during this time laid the basis or the foundation for modern audit. And during the Industrial Revolution, there was the emergence of many joint companies, and it is because of this rise in joint companies that auditing became a necessity, because of the separation of ownership and management in the companies that led to an increased need for independent verification of financial statements to protect the interests of the investors. And that demand then fueled the development of professional accounting bodies and the establishment of standardized auditing practices. So let's discuss briefly modern audit. Modern audit. You want to briefly discuss the development of modern audit. Modern audit. Now, the modern form of auditing emerged, as I said earlier, in the 19th century with the rise of joint stock companies and the Industrial Revolution. And candidates, the development of modern audit can be attributed to several factors. One is the industrial revolution and the rise of joint stock companies. Industrial revolution and joint stock companies. Industrial revolution and the joint stock companies. Now, the 19th century saw the emergence of large corporations with dispersed ownership. And the separation of ownership and management created a need for independent verification of financial statements. And the purpose was to protect the interests of the shareholders. Because once you have the ownership and control being separated, then the managers may act in a way that jeopardizes the interests of the shareholders. And therefore, there is need to have an independent auditor who then examines the financial statements, examines and also verifies and ascertains the accuracy, the fairness, and compliance with the accounting standards and regulations. So that is a key factor, okay, that contributed to the development of modern audit. Another factor is the formation of professional accounting bodies. Formation of professional accounting bodies is a factor that led to the development of modern audit. The establishment of professional organizations, particularly in the United States, like the Institute of Certified Public Accountants in the United States, and also the Institute of Chartered Accountants in England and Wales, led to the development of professional standards and ethical guidelines for auditors. And that increased the credibility and reliability of audits. That is the second factor. Now, the third factor is the standardization of accounting principles. Standardization of accounting principles. The development of the gaps, or what we call the generally accepted accounting principles, provided a common framework for preparation of financial statements, making them more consistent and comparable across different companies, across different industries, and across different jurisdictions. So that is a factor that contributed to the development of modern audit. Then we also have government regulations. Government regulations. Government regulations. Government regulations. Now, the enactment of regulations like the Companies Act, the one country may have other countries calling it maybe Securities Act, the Securities Exchange Act, particularly or especially in the United States. Such regulations mandated independent audits. It mandated independent audits for publicly traded companies, and that further strengthened the role. It strengthened the role of auditors and ensured the accuracy and reliability of financial information. So government regulations like the ones I've mentioned, the Securities Exchange, the security exchanges, we have the Companies Act, right? The Securities Act, for example, the one in 1933 in the United States. They helped develop modern audit. 5, technological advancements. Advancements in technology. The advent of computers, the advent of data analytics tools has also revolutionized the audit process. And modern auditors now have access to sophisticated software that can analyze large volumes of data quickly and also efficiently, enabling them to identify potential risks, enabling them to identify potential anomalies more effectively. So technology has helped develop modern audit. Then lastly, we have factor. The other factor is globalization. Globalization and complex business environment. Globalization and complex business environment. Now, the increasing complexity of business transactions and the rise of multinational corporations have led to the development of international standards on auditing, which provide globally recognized framework for conducting audits. And that ensures consistency, it ensures comparability of audit practices across different countries. So currently, these are 6 factors that have contributed to the evolution of modern auditing into a highly specialized profession that plays a critical role in ensuring the integrity and the transparency of financial information. And modern auditors are not just number crunchers. No, they are trusted advisors who provide valuable insights, who provide valuable recommendations to management and the stakeholders. So in this lesson, we've studied briefly the development of early audit and development of modern audit. We've identified ancient civilizations like Mesopotamia and Egypt, where auditing helped in reviewing government records and tax collections. We saw that in ancient Greece and Rome, auditing continued to develop until the medieval Europe, where there was the auditing was used in ancient guilds. Then we've gone ahead to discuss the factors that have led to the development of modern audit, beginning with the Industrial Revolution and joint stock companies. The emergence of joint stock companies is a factor that has led to the development of modern audit. The second factor is formation of professional accounting bodies. Number 3, standardization of accounting principles, government regulations, technological advancements, and globalization and complex business environments. Here's your today's assignment. 1, how did early forms of auditing differ from modern auditing in terms of their primary focus? 2, what historical events and developments contributed to the emergence of modern auditing? 3, explain the impact of the separation of ownership and management on the development of modern auditing. 4, describe the role of professional accounting bodies in shaping modern auditing practice. In our next lesson, we will study uses of audited financial statements. Bye.
Hi there, my name is Patrick Kamau Kamure. You are a lecturer in public finance and taxation. Welcome to today's lesson. Today, we continue from where we stopped last time. Remember, the topic we are looking at the moment is called the taxation of the business income. And we said that there are 3 businesses that we need to look at how they are usually taxed: the sole proprietorship, partnership, and the limited company. So far, we have looked at the sole proprietorship. Last lesson, we did look at we started looking at the partnership, whereby after looking at how partnership is usually taxed, we went ahead and we used the net profit method to get the taxable income of the partnership. So today we continue with the same lesson, but we look at another question where we used a different approach to answer the same question, a different question using now the gross profit method. Welcome to today's lesson. So we are going to start by reading the question. After reading the question, then I'm going to help you solve the question. So here is the question. This is what the question says. Karimu and Shika commenced trading in partnership as Kashi on January 2019. They share profits and losses in the ratio of 2:1 for Karimu Shika respectively. The partners were to receive monthly salaries of 18,000 and 22,000 for Karimu Shika respectively. The partnership did not maintain complete set of accounting records. The following summary of the bank statement for that year has been presented to you. So we have the receipts consisting of capital introduced, Karimu and Shika, cash sales, receipts from debtors, sale of a van. We go to the payment side, equipment of office, rent for go down, salaries and wages, purchase of for resale, repair and maintenance, insurance, interest expense, motor vehicle expenses, sundry expenses, motor van purchased, tax penalty, electricity, medical expenses, balance carried forward. Additional information number 1. The following payments were made in cash from the cash sales before banking. We have the motor vehicle expenses per annum, wages per annum, sundry expenses per annum, weekly drawings for Karimu and Shika. During the year, discount received from the supplier amounted to 132,500, while the discount allowed to customers amounted to 118,000. As at that 1st December 2019, electricity and insurance prepaid were 25,000 and 12,800 respectively. Depreciation was to be provided on equipment at 10% on a straight line basis. As at that 1st December 2019, the amount owed to supplier was 780, while the amount owed by the customer amounted to 1420. An amount of it 2,000 owed by Jamila Mamba, a customer, proved irrecoverable and is to be written off as bad debt. This amount was excluded from the total amount owed by a customer as at that 1st December 2019. Salaries and wages include the salaries to the partners. The go down had been occupied since 1st November 2019 at an annual rent of 450,000. Included in the interest expense is the interest on partners' capital contribution at the rate of 5% per annum. The wear and tear allowance, and it's good to note that wear and tear allowance is the same as the capital allowance. So wear and tear capital allowance was agreed with the revenue authority to be 112,000 for the year ended at 1st December 2019. So number 11, closing inventory was valued at 620,000 on 31st December 2019. Assume that year of income had 52 weeks. Required 1. Adjusted partnership profit or loss for the year 2019, and number 2. Distribution schedule of the profit or loss calculated in C1 above. So the first question is to get the taxable income, and we say that whenever you are told to get the taxable income of any business, you either use the gross profit approach or the net profit approach. Net profit approach, we said, is when you have been given net accounting profit or loss or income somewhere. If you haven't been given, you use the gross profit method. So this question, we are not given the net profit or loss or income. So automatically we use the gross profit method. Now gross profit method, we said, we usually start with the sales. We less the cost of sales. Cost of sales, we take the opening stock plus purchases, less closing stock minus any item that reduce the stock. And then we get the cost of sales. We less from the sales, we get gross profit. And the reason why we call it gross profit, we said. And then you add other taxable operating income, and then you less the allowable expenses. So, but we said before you start, always confirm. Do you have the sales? Do you have the total purchases? If you don't have, or you haven't been given, then in that case you have to determine them first. So in this question, we take note that we're starting with the sales. We are given only one, the cash sales. But the cash sales does not represent the total sales. We have to look for the credit sales. We add to the cash, we get the total. So now, we are not given the sales, so we have to look for it. The other one is the purchases. Have we been given the purchases? Yes, in the payment, in the statement of bank statement, there is a purchase for resale, but that is a cash purchase. Now, how about the credit? So in this case, we have to determine the credit purchase so that we can add to that cash, we get the total purchases. So this is what we said you normally do. To get the total sales, you do it this way. You say total sales is equals to credit sales plus cash sales. We said for the cash sales you'll be given, it is there, like we have seen it's already there. The issue is about the credit sales, where you have to determine it. Now, the best way to approach the question, we said, leave a space like 2 lines, where now you'll be able to open the debtors or receivable account to determine the credit sales. So you'll come here and have the debtors stock receivable. You start with balance brought down here, that's what we said, for the debtors. And then jump 4 or 5 lines here, where you'll be posting those items that affect the debtors. And then balance at the end here for the debtors. And then totals would be here. Same case on the purchases, we say total purchases is as a result of credit purchase plus cash purchases. For the credit purchase, we jump a space of 2 or 1 line, and then we have the creditors or payables account, where we will be able to get the credit purchase. Then for the creditors, you start with balance brought down here for the creditors, and then jump 4 or 5 lines, then have the balance carried down for the same creditors. And then you'll be able to post everything and the totals there. Once you have done that, now go through the whole question. If you come across some cash sales here, something affecting the debtors here, cash purchase here, anything affecting the creditors here. So we start. From the first paragraph, the only figures that we have are 18,022, which were monthly salaries to the partners. So those do not affect, so we ignore. We go to the receipt. Capital, introduced, that's not. Cash sales, yes, here. So we post it here, 12,700,000. And then receipts from debtors. Receipts from debtors, we said it reduces the debtors. Here, receipts, which we have 5,200,000. Then sale of motor van, that doesn't affect. We go to the payment side. Equipment for the office, that does not affect. Rent for the go down doesn't. Salaries and wages, no. Purchase for resale, yes. Here, that's a cash purchase, of which case we have 9,900,000. The other one is the repair and maintenance doesn't affect. Insurance, interest, motor vehicle, sundry expense. Motor vehicle purchase, that's a fixed asset, not goods. Remember, what we are looking for are for the goods. Tax penalties, electricity, medical expense, balance carried forward, those do not. Then we go to the additional information number 1. The following payments were made in cash from cash sales before banking, meaning what went to the bank, as we can see, the bank statement was this. But before that figure was posted, not really this one, but the one in the bank statement, we had 12,700, this one. But before they banked the 12,700, they had paid some expenses, meaning our cash sales was more than what was banked. So to get the how much it was, we need to add the one that was sold on the one that was sold on cash and then used to pay the expenses. Which one? Motor vehicle expense. So the key thing there was from cash sales, were paid from the cash sales. Motor vehicle expense per annum, that we had 138,000. The other one is wages, 162, plus sundry expenses per annum, 35. Then weekly drawings by Karimu and Shika. So weekly drawings for the whole year, it has to be for the 52 weeks. So 52 weeks times now weekly for the total, which is 7,200 plus 6,400, and that ends there. From there we go to number 2. During the year, discount received from the supplier amounted to 132,500. Discount received reduces the creditors, so we'll have it here. Discount received, which we had 132,500. The other one, where discount allowed to customers amounted to 118,000. Discount allowed, which reduces the debtors. Discount allowed, which we have 118,000. I want to bring this one a little bit up here, but I haven't changed anything. It's just this. And so we had said the balance carried down for the creditors. We leave it there. So we continue. After that, we go to the point number 3. As at 31st December 2019, electricity and insurance prepaid were 25,000 and 12,800 respectively. That doesn't affect. Depreciation was to be provided on equipment at 10% straight line. No. As at 31st December 2019, the amount owed to supplier was 780. Now this at the end of the year, what the supplier are owing is 780,000. And then while the amount owed by customer 1420. What is owed by the customer is 1420 at the end there. We continue. An amount of 82,000 owed by Jamila Mamba, a customer, proved irrecoverable and is to be written off as bad. This amount was excluded in the total amount owed by the customer as at 31st December 2019. So that's a bad debt written off. Bad debt written off reduces the debtors written off, which we have 82,000. 82,000. The other one is number 7. Salaries and wages include salaries to the partners. That doesn't affect. Number 8, go down had been occupied since 1st November 2019 at an annual rent of that. Doesn't affect. Included in the interest expense is the interest on partners' capital contribution at the rate of 5% per annum. Doesn't affect. The wear and tear allowance was agreed with the Revenue Authority to be 112,000 for the year 2019. Doesn't affect. Closing inventory was valued at 620 on that 1st December 2019. Doesn't affect. So we are done. So from there we do the computation. So we are going to add the totals on this side and compare to the total on this side. Actually, we have seen the balance brew down is 0 and also balance brew down here because they started the business at the beginning of the current year. So there was no balances from last year. So it's all about the total on this side would be now the credit sales here. Credit sales. So we add them 5,200,000 plus 118,000 plus 82,000 plus 1420, which gives us 6820,000. And this one 6820 should be the totals. 6820 because we now have written the balancing figure. So then this one we transfer it here 6820,000, which we should be able to add now the cash. So we'll start by taking 7,200 plus 6,400 times 52. So it will be 7,200 plus 6,400 times 52 weeks because that was per week. That becomes 707,200 plus 35,000 plus 162,000 plus 138,000 plus total 700,000. Then now we add this one plus 6820,000. 6820,000 giving us 20,562,200. That is the total. We come here, we add this plus this. This is 0, so that will be the credit purchases. So this plus this 132,500 plus 780,000. So that will be 912,500, which will be here 912,500. 912,500. We transfer that one here 912,500, and then now we add the cash purchase. So plus 9,900, which give us 10,812,500 there. With that one now we can prepare the statement of determining the taxable income. So we'll come here, the name of the partnership is Kashi Enterprise Partnership. We get the taxable income for the year ended 31st of December 2019. So we start with the sales, which we had determined 20,562,500. Then we less cost of sales. Cost of sales, which we take the opening stock. But here you'll note that we were not given the opening stock because we started the business at the start of this year. So there were no opening stock from last year. So 0 plus the purchases. Purchases is what we have determined here. 10,812,500. Then we minus the closing stock. Closing stock is the one given in point number 11, 620,000. So minus 620,000. And then we also minus any item that could have reduced the stock during the year. Damaged, withdrawn stock, stolen, of which case the whole of this question, we didn't have any stock that was stolen, damaged, or withdrawn by the partners. There was none. Let me confirm properly. There wasn't any. The drawings that we are given in additional information, number 1 was cash drawings, not goods. So in this case, we cross to get the cost of sales. Cost of sales, which will be the 10,812,500, you minus 620,000, and that gives us 10,192,500. And then we can be able to get the gross profit. Gross profit will be, we minus that from 20,562,500. And that gives us 10,370,000. Then we said this, after getting gross profit, and the reason why we call it gross profit method is to add other taxable operating income. Other taxable operating incomes. Other taxable operating incomes. of which case we said you jump a space of like 3 lines and then you less. I want to bring this one here, 1,000. So you less allowable expense after jumping around 3 lines, allowable expenses. So what we do now, we go through the whole question. If we come across a taxable operating income, an allowable expense, we post here. We start from the top. The first paragraph was about the salaries to the partner. We said anything to the partner we don't allow. It's an expense yet, but not allowable, so we cannot post. We go to the summary of the bank statement. On the receipt side, capital is not an income or an expense. Cash sales, we used it to get the sales. Receipts from debtors, we used it to get the sales. Sales from the van, we said income from selling fixed assets, we don't tax, so we cannot post here. We go to the payment. Equipment. Equipment is a fixed asset, which we should claim capital allowance at the rate of 10%. But we won't do that. Why? If you look at additional information number 10, we are told the wear and tear allowance, which we said is the same as capital allowance, was agreed with the revenue authority to be 112,000. So that's the one that we use. Anywhere we require to compute capital allowance, we use that. So we can even post it now, the capital allowance, also called WTA or wear and tear allowance for the year. It was agreed to be 112,000. From there, we go back to where we found that in the bank statement. After equipment, rent for go down. That's an allowable expense, rent expense. But we have an additional information to that rent. If something has an additional information, check it out. In additional information number 8, the go down has been occupied since 1st November 2019 at an annual rent of 450. So annual is per year. And now it was occupied from 1st November. Those are 2 months. So forget about the one that you are given. Use the one that you can get for this particular year. So in this case, we are going to take 2/12 times the 450 because it was only occupied for 2 months to the end of the year in this particular year. So this is going to be 2/12 times 450. That will be 75,000. That is the one that we allow. Any other, we forget. Then we go back. After the rent for the go down, salaries and wages. That is allowable. But we have to check whether it is mentioned somewhere else. Salaries and wages. Yes, it had been mentioned in additional information number 7. The salaries and wages include the salaries paid to the partners. Salaries. And here they have made it very clear that it is salaries and wages. Another place that we have wages now mentioned is number 1. The following payment made through the cash from the banking. So we have the wages. So what do? We'll come here and have the salaries and wages. So we open a bracket. Remember, we want to know the allowable salaries and wages for this year. 890,000. And then now we have to add the one that was paid through the cash. This was through the bank. The cash was 162. And then number 7, it includes the one paid to the partners. So we have to remove because we said anything to the partners we don't allow. To the partners was how much? In the first paragraph is where we were told the monthly salaries to the partner was 18 and 22,000. Monthly, underline monthly. So meaning to get the whole year, we have to take minus 12 times 18,000 plus 22,000. So that we can get, and since it is not mentioned somewhere else, we do the computation. So we take first of all the 18,000 plus 22,000, and then you multiply by 12 months because it was monthly. We get for 80,000. Then we remove them from this. So we take 890 plus 162 minus 480. That gives us 572. That's the one that we should be allowing there. After that, we go back to where we found the salaries and wages. After salaries and wages in the bank statement, purchases for resale that we use to get the purchases up there. Repair and maintenance, that is another allowable expense. Repair and maintenance. So we check if it is mentioned somewhere else. There isn't. So we just pick the figure as it is, 860,000. After that, we go back. After the repair and maintenance, there is insurance. Insurance is also a allowable expense. So we have insurance. Is it mentioned somewhere else? Yes. Additional information number 3. As at 31st December 2019, electricity and insurance prepaid. So this was prepaid, and it's at the end of the year. We said prepaid at the end of the year is for next year, not for this. Anything that is not for this year, we minus. So we are going to take the insurance of 62.5, and then we minus the prepayment which we have, 12,800. That will give us how much? This will be 62,500. We minus 12,800. That gives us 49,700. After that, we go back to where we found the insurance. After the insurance, there is interest expense. Interest, we said, is allowable. So interest expense. But it is mentioned somewhere else. In additional information number 9, included in the interest expense is the interest on partner's capital contribution at the rate of 5%. Included in interest. Anything to the partner we don't allow. So we will take this interest, which is 612,000, and then we minus the one that was paid to the partners, which was 5% of the capital. The capital is in the bank statement, where we have for the two partners 3,500 plus we have the 2,500, that is 2,500,000. That. So we add the capitals, which are 35 plus 25 times 5%, which give us 300,000, and we minus from 612, that give us 312,000. That's the one that is allowable, the one paid to the partners. Then we go back after the salary, after the interest, after the interest. Motor vehicle expense. Motor vehicle expense is allowable, and we say that is not the cost of motor vehicle. It's the vehicle expense incurred to run the motor vehicle, fuel, repair. So in this case, that is allowable, not a fixed asset. Motor vehicle expenses, where we are told the motor vehicle expense is 186,500. After that, we have sundry expense. Maybe there is something that I should have confirmed. In additional information number 1, there is more motor vehicle expense. The one that was paid in cash, 138. We forgot about that, so we should add it. So it will be 186,500 plus the one that was paid cash, which we have 138,000. 138,000. We check if it is mentioned somewhere else, but the motor vehicle is not mentioned anywhere else. So what does that mean? Then that means that we do the computation. 186,500 plus 138,000, which we get that 245,000. That 245,100. Then we go back after the motor vehicle expense. We have sundry expense. Sundry expense is an allowable expense, so we continue. Sundry expenses. And this one again, it is mentioned somewhere else in additional information number 1, the one that was paid through the cash. So we'll have 218,000, And then we add the one that was paid through cash, which we have 35,000. Which we have 218 plus 35,000, which give us 253,000. Then we go back after the sundry expenses, motor van purchased. That's a fixed asset which we should claim capital allowance. But remember, we were already given the capital allowance, so we ignore. Tax penalties, we said any expense relating to tax we don't allow. Electricity expense, that is allowable. So electricity expense, but we check for the additional information. If you go to the additional information number 3, we had electricity prepaid, and we said prepaid is for next year. So that one we need to remove. We need to minus, because of what was paid this year of the electricity, 45,800. Part of it is for next year, and so we should minus from here, where we have the 25,000. That gives us 2,800. Then we go back to where we found that. After the electricity, there is medical expense. Medical expense are allowable unless we are told it was relating to the partner, which we haven't been told. So medical expense. Medical expenses 630,000. Then now we go to the additional information for any taxable, operating, or allowable expense. Additional information number 1, the following payments were made in cash from cashes. Motor vehicle expense we have considered, wages we have, sundry expense we did, weekly drawings, those are not allowable expenses. Additional information number 2, those are the figures for the balances of debtors and creditors at the end of the year. So they are not incomes or expenses. Number 3, we have already adjusted for them. Number 4, depreciation. Remember, we said depreciation is not allowable. We claim capital allowance instead, which we have been given. Then number 5, as at 31st December 2019, the amount owed to supplier was 780, while the amount owed by customer was 1420,000. That we had said actually, there's something, there's additional information we jumped. We jumped number 2. During the year, discount received from the supplier amounted to 132,500, while the discount allowed to customers amounted to 118. Discount received, that we know is a taxable operating income, so it should come here. Discount received, that is a taxable operating income. And we have the discount received of 132,500. And then we have the discount allowed. Discount allowed is an expense and it's allowable. Discount allowed. Discount allowed, which we have been given as 118,000. There. From there we continue. We were actually in point number 5. That's where we were saying that we had the balances at the beginning and also at the end. And then from there, number 6. An amount of 82,000 owed by Jamira Mamba, a customer proved irrecoverable, and it is to be written off as bad debt. This amount was excluded in the total amount owed by the customer as at 31st December 2019. That is a bad debt written off, which we said is allowable expense. So we'll have bad debt written off. Bad debt written off, which we have an amount of 82,000. After that, we go to number 7 now. Salaries and wages include the salaries paid to the partner. Now that we had adjusted in the salary here, if we had forgotten, now you should be able to adjust. Number 8, we had adjusted on the rent. Number 9, we had adjusted in the interest. Number 10, capital allowance we had posted. Closing inventory that we used to get the cost of sales here. There is nowhere else it's supposed to be used. Now that is the end. What remains, and this being a partnership, it should end here, is to get the net taxable operating income. So how do you get the net taxable operating income? It is the gross profit plus discount received minus these expenses. So we do the computation. So we start with the 10. 370,000 plus 1, that's 2,500, minus 112,000 minus 75,000 minus 572,000 minus 860 minus 49,700. Remember this was 7. 49,700 minus 312 minus 324.5 minus 253 minus 2,800 minus 630 minus 118 minus 82,000. That gives us 7,093,500. And that answers required 1, where we are supposed to get the taxable profit of the partnership. With that one, we are supposed to go to the required number 2, where we do the income distribution. So the income distribution schedule, this is what we said or how it is supposed to look like. So income distribution schedule. We start by distributing the operating income. So we will start with taxable operating incomes, which is the one that we have determined here, 70,93,500. And then now we list the partners that we have, which we have Karimu, Shika, and now the totals. So we go through the question. Remember, we start by looking for the first 4 items that we said: the salary, interest on capital, commission or bonus, less interest on drawings. Those 4. So if you look at the first paragraph, we had the salary to the partner, salary, which we were told it was per month. So the first one was to get 18,000 times 12. The other one was to get 22,000 times 12. Because they were monthly amounts. So we have 18 times 12, which give us 216,000. So 216,000. The other one is 22,000 times 12, giving us 264,000. And now we have the total plus 216. 480 for 80,000. Then we go to the capital, to the cash bank statement. In the bank statement on the receipt, we had capital, which is not one of the item we are posting. You go to the payment side, there is none. You go to the additional information, number 1, drawings we said we ignore. Number 2, no. 3, no. 4, no. 5, no. 6, no. 7, we have posted. 8, no. 9, there is interest on capital. So interest on capital, which is supposed to be 5%. 5% of the capital. How much is the capital? In the bank statement, we have capital of 35. And also, the other one is 25 for each. So we start with 5% of 35, which gives us 175,000. The other one is 25 times 5%, giving us 125,000, and the total gives us 300,000. Then after that, point number 10, none, and 11, there is none. So the only remaining one is the fifth one, profit share. How do you get the profit share? We said you take the taxable operating income we have, like in this case we have 70, 93, 500, and then you minus what has been shared already. We have shared the 480,000 and also shared the 300,000. So whatever remains you share according to the profit sharing ratio. And what was the profit sharing ratio? In the first paragraph, they were sharing 2 to 1. So the first one will get 2 out of 3, the other one 1 out of 3. So let's minus 70, 93, 500, we minus 480, and also we minus 300,000. 480,000 and 300,000 give us 6313. So 6313, 500. Then the first one will get 2 over 3. That give us 4209. 4209, 900. 1,000, sorry. And there now, the other one, we can take the 6313, 500 minus what we have given this. 63, 13, 500. That will give us 2104, 500. And now we can get the total taxable operating income. Total taxable operating income. So for Karimu, it will be 216,000. We add 175,000. We add 4209, which we get 4,600,000. The other one will be 264,000. We add 125,000, and then we add 2104, 500, which gives us 2493, 500. And now the total, which would be 480,000 plus 300, and then we add 63, 13,500, which give us 1793, 500, and which is the same as the operating income we had determined. Remember, if we had an investment income that is taxable for this question, after getting the operating income, we add taxable investment income, and we share and then get total. But the whole of this question didn't have an investment income. So meaning our question then should end here. So this one will give us now the total taxable income, which should end there. That is how we tax partnership when you have not been given the net accounting profit. So for this question ends here. And now what is remaining is the taxation of the limited company, which we are going to look at in our next lesson. For now, we stop there until we meet in the next lesson. After this video, there is some assignments, questions that you can attempt. Kindly do attempt and then see if you can be able to do the way we have done it. Thank you very much.
Greetings and welcome to the lesson. Today we are going to discuss the nature and objectives of an audit. And in our last session, we defined an audit as an independent examination of an organization's financial statements, records, and operations. And this examination is conducted by a qualified professional known as an auditor, who possesses or who assesses the financial information that is presented by the management. So an audit, first of all, is an independent examination. Independent examination means that this examination is done by a third party in a corporate setup, because in the corporate world, we have the ownership and control, the owners and the managers. Those are the owners being the first party, managers the second party. The owners delegate the responsibility of running the company to the managers, and therefore the ownership and management is separate, which in our last session we saw poses the agency problem. And to mitigate the agency problem, there is need to have independent examination of an organization's financial statements, records, and operations, which I'm now saying is conducted by a qualified professional who is known as an auditor, who may be an individual or an audit firm. And this auditor assesses whether the financial information presented is fair, accurate, and whether it complies with applicable accounting standards and regulations. So auditing or audits are typically conducted on an annual basis for most organizations, although we may have some that may require more frequent audits due to their size, due to industry, or due to regulatory requirements. So the primary objectives of an audit include, we are studying the objectives of an audit. The primary objective, one primary objective of an audit is to provide reasonable assurance. This is one primary objective of an audit, to provide reasonable assurance. The auditor's main goal is to provide a high but not absolute level of assurance, because absolute assurance may not be possible due to other factors that we are going to study later on. But one primary objective of an audit is to provide reasonable assurance, to provide a high but not absolute level of assurance that the financial statements are free from material misstatements. And that means that the auditor has conducted sufficient testing and analysis to conclude that the financial information presented is reliable and can be trusted by the stakeholders. So an auditor is required to examine the records, supposed to carry out tests, is required to carry out analysis of the financial statements, to conduct sufficient testing in order to gather sufficient evidence upon which he can make his opinion as to whether the financial statements that are presented are reliable, are fair, and can be trusted by the stakeholders. So that is one primary objective of an audit, to provide reasonable assurance. The second objective is to enhance credibility. Enhance credibility. To enhance credibility. An audit enhances the credibility of the financial statements by providing an independent, unbiased assessment of their accuracy and reliability. And that is crucial for investors, that is crucial for creditors, that is crucial for other stakeholders who rely on the financial information to make sound decisions. For example, before investing, before buying the shares of a company, one may want to know if the company is doing well, if the company is worthy of investing in. And to be able to know the performance of an organization, the financial position of an organization, then it is necessary that one relies on the work that has been done by an independent person, because you cannot rely on the report of the management. One has to rely on audited financial statements, which are carried out by a qualified professional who assesses whether the financial statements presented are fair, accurate, or they comply with regulations. So statements, financial information that has been audited is credible. Why? Because such information is examined by a qualified professional who gives an opinion as to whether the financial statements as presented are accurate, credible, and reliable. Do you understand? Auditing enhances credibility of the financial statements. Auditing may also identify weaknesses and recommend improvements. Identify Auditing can help to identify weaknesses and recommend improvements. Auditors can, in the process of carrying out their work, they assess the effectiveness of an organization's internal controls, which are the policies and procedures that are put in place to safeguard assets and to ensure the accuracy of financial information. These internal controls are also put in place by an organization to promote operational efficiency. So in the process of examining these internal controls, the auditor may come across weaknesses within that system. The auditor may identify weaknesses. Then upon the identification of the weaknesses, the auditor recommends improvements to strengthen the internal control system. So that is another objective of an audit, is to identify weaknesses and then recommend improvements, because auditors are qualified professionals. 4, deter fraud and error. An audit can deter fraud, it can deter error. The audit process acts as a deterrent. It acts as a deterrent to fraud and error by increasing the likelihood of detection. Now, while an audit is not designed to uncover all instances of fraud, it can help to identify potential risks and weaknesses that could be exploited by fraudsters. So in the process of examining the financial statements, in the processes of examining the internal control system, the auditor may help identify those loopholes that may be used to commit fraud or errors in the accounting system of a company. Then the last objective is in relation to compliance with regulations. Compliance with regulations. Now, in some cases, audits are required by law or regulation to ensure that organizations are complying with specific financial reporting requirements. And I know all of you are students of financial reporting. I know you are conversant with the international financial reporting standards, the international accounting standards, and you know by now that financial statements are required to be presented in accordance to the provisions of these standards. So when carrying out an examination of the financial statements, an auditor also checks if the company complied with the requirements of international financial reporting standards, international accounting standards, and so on. You understand? So these are 5 objectives of an audit. 1, provides reasonable assurance. 2, enhances credibility. 3, can help identify and recommend improvements, identify weaknesses in the internal control system and recommend improvements, can deter fraud and error, then compliance with regulations. Now, it's important to note that an audit does not guarantee that the financial statements are completely error-free. That is not the objective. The objective of the auditor is not to give a guarantee that the financial statements are completely error-free or that they have errors, nor does it guarantee the future viability of an organization. Instead, it provides an independent assessment of the financial information based on the evidence available at the time of the audit. And we'll be studying how that is done as we look. We'll be going through the process of auditing and the process of gathering evidence and how, based on the evidence, the auditor is required to make a report. We shall also be looking at different types of reports that may be generated by an auditor based on his examination of the financial statements. For now, we are going to take a break. But before then, here is your today's assignment. Number 1, what is the primary objectives of an audit and how does it differ from absolute assurance? Number 2, explain the concept of reasonable assurance in the context of an audit. Number 3, how does an audit contribute to enhancing the credibility of financial statements? Number 4, describe the role of an auditor in identifying weaknesses in internal controls and recommending improvements. In our next session, we're going to study the development of audit, that is the early audit and modern audit. Bye.
Hey there, my name is Patrick Kamau. You are a lecturer in public finance and taxation. Welcome to today's lesson where we learn more about the taxation of the business income and which we started some times back in few lessons, past lessons, where we say that we are supposed to look at the taxation of the business income, and we had 3 businesses we are supposed to look at: the sole proprietorship, partnership, and the limited company. In our previous lessons, we have covered the sole proprietorship and the partnership. So what is remaining is the taxation of the limited company, and it is the one that I want us to look at how it is usually taxed. So this is what you need to know about the limited company. That limited company is considered to be a separate legal entity from the owners, and therefore taxed on its own income at corporate tax rate. That is the first thing that you need to know, that a company is considered to be separate from the people who forms it. So when you're taxing a company, you tax the company itself. You don't tax the owners. Unlike the case of sole proprietorship, which you tax the owner, the partnership where you tax the partners, here you tax the company itself. So the following points are considered when you are taxing the company. So points considered in taxation of a limited company. This is determined using either number one, gross profit method. Number two, net profit method. So what we are saying here is that when you are determining the taxable income of a company, you just determine it in the same way as any other business, the way we have been using. Either gross profit method, if you have not been given net accounting profit. If you have been given the net accounting profit, then you use the net profit method. It's the same thing. Point B to consider is that taxable income of company is taxed at the following tax rate. One, resident company, 30%. Number two, non-resident company, 37.5%. But note, so what we are saying is that when you determine the taxable income of a company, if it is a resident company, you tax it at 30% to get the tax to be paid. If it is a non-resident company, that's 7.5%, then you get the tax to be paid. But not from 1st of January 2024, non-residents will be taxed at 30%. Yeah. So there was a change of the law on 1st of July 2023, which stated that come January 2024, the non-resident corporate tax rate will be reduced from that 7.5% to 30%. So it's good to know when you are taxing a company, which year is it rating to? Any year before 2024, that is 7.5% for non-resident only. And now beyond 2024 or 24 and beyond, then it's supposed to be, that is 30%. That is all that you need to know. Otherwise, everything else that we have been talking about taxation of a business, in terms of the method, in terms of the taxable operating income, non-taxable operating income, allowable expenses, and non-allowable expenses remain the same. So now we look at a question. This is what the question says. Zahari Processors Limited presented the following statement of profit or loss for the year ended 31st December 2022. We have the turnover, cost of sales, gross profit, other incomes, provision for foreign exchange gain, gain on sale of motor vehicle, release of liability, refund of excess duty, investment income gross, total income, less expenses, purchase of trademark, a design of company website, director's fee, donation to charitable institutions, depreciation expense, marketing expense, management and professional fees, general expenses, legal costs, loan repayment, allowance for doubtful debts, impairment loss of property, a net profit for the year. Additional information number one. On 1st April 2022, the company acquired the following assets: factory building, warehouse, processing machinery, rolling 4 tons, drainage system, saloon car. Number two, management and professional fee comprised development of strategic plan, tax consultancy fee, audit fee, environmental assessment fee. General expenses include installation of neon sign, car grant to a director, installation of processing machine, staff Christmas party, retrenchment costs. Number four, legal fee comprised defense against claim for breach of trade agreement, renewal of Kenya Association of Manufacturers membership fee, negotiating a bank loan, a preparation of employment contract, drafting lease agreement 60 years. Number five, Release of liability was in respect of a loan obtained from one director who decided to write off the loan as it was due for over 4 years. So we are required compute the total taxable profit or loss for Zahari Processors Limited for the year ending that 1st December 2022. So we want to get the taxable income. First thing that we need to ask ourselves, which method are we supposed to use? It's obvious that for this question we are supposed to use the net profit method because we have been given the income statement with net profit, but the key we have been given the net profit, or if we are given the net loss or net income, is the same. So we'll start. So we'll start with the net profit that has been provided to us. Which we have, note that the items have been given shillings 1,000. So we have 527, 614. And then we add non-allowable expenses. In P&L and taxable operating income, not in P&L. So, as we have been doing any question that we use the net profit method, we just need to go to the P&L, look for the non-allowable expenses there. The first expense in the P&L, purchase of trademark. Trademark is not allowable. The first expense in the P&L is trademark, which is not allowable. So we add it. Then we continue. The next one is design of company website. Website is a fixed asset which we should claim capital allowance later. It's not allowable. So we add it, which we have 12,400. The other one is director's fee. Director's fee is allowed if you look at what we had said among the allowable expense initially. Donation to charity, that's allowable, we said. Depreciation, no, that is not allowable. Depreciation, which we have that 240. After the depreciation, marketing expense. Marketing is allowable. A management and professional fee, that is also allowable, we say, because it's for the business. General expenses, they are allowable because they are for business. Legal costs, unless it is stated what it is, it's allowed, which we had already looked at the non-allowable legal cost. Loan repayment, no, that isn't allowable. Loan repayment, which you have 2,600. Then the next one is allowance for doubtful debt. Allowance for doubtful debt is not allowed. It's a provision. Unless they say specific allowance, it's not allowable. Which we have 2,250. The next one is impairment loss of property. We don't allow impairment loss. We don't. So impairment loss, which we have 1,500. Seems we are done with non-allowable expense in P&L, but we need to go to the additional information, check if there is further analysis of expense in the P&L, and if there is a part that is not allowable. At the same time, in the additional information, we look for taxable operating income not in P&L. An income that is taxable and is operating but has not been included in the P&L up here. So let's see. Additional information number 1. On 1st April 2022, the company acquired the following assets. Now, those are fixed assets. First, they are not in the P&L. If you go to the P&L expenses, they are not there. So ignore. Number 2, management and professional fee comprised. Now, that is in the P&L. We have to look for non-allowables. Higher. Development of strategic plan. that is an allowable expense because when you plan for your business, it's income generating, it's allowable. How about tax consultancy fee? No, anything to do with tax we don't allow. Tax consultancy fee, which you have 208. The next one is audit fee. Audit fee is allowed. Environmental assessment fee, that is supposed to be an allowable expense. Why? It is not income generating. We said any expense that is not income generating is not allowable. So environmental assessment, which we have 256. After that, we go to number 3. General expenses include. Now, general expenses is in the P&L. When you go to the P&L, you find the general expenses there. They include installation of neon sign. Neon sign installation is a fixed asset. Expense incurred before you start using the neon sign, the fixed asset. Those we don't allow. So, we disallow. Which we have 820. The other one is car grant to a director, also not allowed because a grant to a director is a private, for private use. We don't allow. Which we have 2800. The other one is installation of processing machine. We don't allow installation of the process. They are fixed asset. Expense incurred before you start using fixed asset. We don't allow them. Which we have 1560. The other one is staff Christmas party. That is now allowed because we said expense for the welfare of workers. They are allowable. That's for welfare. The other one is retrenchment cost. We don't allow retrenchment cost. Expense that is not income generating. We don't allow. Retrenchment costs. Which we have 580. After that, we go to additional information number 4. Legal fee complies. Now, legal fee is an expense and it is in the P&L. We look for the non-allowable in it. Defense against breach of trade agreement. We don't allow breach of trade agreement. Breach of contract. We don't. Which we have 1450. How about renewal of Kenya Association of Manufacturers membership fee? That's a trade association. We said anything paid to a trade association is allowable. Negotiating a bank loan, no. Bank loan cost, not allowed. Which we have 1168. 68. The other one is preparation of employment contract. That is allowed. We said so. Drafting at least 60 years. We said up to 99 years this is allowed. So we are done with legal. Number 5. Release of liability was in respect of a loan obtained from one director who decided to write off the loan as it was due over 4 years. Here we said, that's an income. The income you are interested with is the one not in P&L for now. For that one, if you go to the P&L, you'll find it as one of the income in the P&L, in the income statement. So we ignore because we want the one not in P&L. Now that we are done with the addition, we come to the deduction now, less. And we list 3 items as we said. 1, non-taxable operating income. In P&L, that is 1, or in investment incomes, in P&L, and allowable expenses, not in P&L. So what we do, or we said, we start with the first two items, non-taxable operating income in P&L and all the investment income in the P&L. So let's go to the P&L, look for an income that is there that is not taxable, or an investment income that is there. Like, the first income we have is the turnover. Turnover is a taxable income. It's a taxable. After that, there is, because it involves sales, it's sales actually, or revenue, what they do. Cost of sales, that's not an income. Right now, we are interested with the incomes. Non-taxable investment. Gross profit is as a result of turnover and cost of sales. Other incomes, which we have, provision for foreign exchange gain. Provision is actually unrealized. If it was just any foreign exchange gain or realized, then that's taxable. But provision is unrealized. So it's not taxable. We remove provision for foreign exchange gain, which we have 84,000. We deduct. The other one is gain on sale of motor vehicle. Income from selling fixed assets we don't tax. Deduct. So gain on sale of motor vehicle. Fixed assets income we don't tax. 28,000. The next one is release of liability. What was the liability about? We were told in additional information number 5, release of liability was in respect of a loan obtained from one director who decided to write off the loan as it was due over 4 years. But that is not an operating income. So we remove. It's not an operating, it's not even an income, an operating income. So release of liability. Release of liability, which you have, that's 2,000. Next, refund of excess duty. Excess duty is not an income. You know, you are just being refunded the tax you had paid. It's not an income. So remove. Which we have 16,000. Last three, investment income. Here we are saying that all investment income in P&L we remove. So we remove that. Investment incomes. So investment income, which we have 24,000, we deduct. For now, up to this point, we are done. So what remains is for us to look for allowable expense not in P&L. An expense that is allowable, but if you go to the P&L, it isn't there. If it is not in the P&L, where is it? It must be in the additional information. So let's go to the additional information and check. Number 1, on 1st April 2022, the company acquired the following assets. Well, those assets were not in the P&L, but themselves they are not allowable. What we allow in them is capital allowance or investment allowance. And there is nowhere we are told that this is the capital allowance to use. If you are not told, we said you compute yourself. So we start with, the first one is factory building. Factory building you claim at the rate of 50%. So capital allowance on factory building. In short, I'll write FB, factory building, which we said this being used for manufacturing, factory building, it is 50% of 28,800. That will be 14,400, the capital allowance. And we say that whenever you are claiming 50%, you don't consider the time. You claim for the full year, even if it is 1 day. The other rates, 25, 10, are the one that you consider time. Warehouse, that's supposed to be capital allowance at the rate of 10%. So we'll have here warehouse, which is supposed to be 10%. And then this we said we consider time from 1st April. Those are 9 months to the end of the year. So times 9 over 12 of 28,000. That we will compute in a while. The other one is processing machine. Processing machine is supposed to be done at the rate of 50%. That's what we said. So we come here and say processing machine. So this is supposed to be 50% without considering time of 16,000. But we said all the expenses that are incurred before you start using a fixed asset, we add them together and then we claim capital allowance together. What I'm saying is this: we had an installation of processing machine here, which we disallowed because it was relating to a fixed asset. Now, because they are the same, now we add it here, which we have 1560. And then we'll claim capital allowance on the total. All the cost incurred before using, like this installation was before use. Lorry, that is supposed to be 25%. This we consider time, 9/12 of 3,500. The other one is drainage system. If you look at the capital allowance, we say that should be 50%. So we'll have drainage system, which is supposed to be 50% of 2,600. For the Sarunka, we said it's 25%, and we consider time. However, we had said if a Sarunka or sport utility vehicle exceed 3 million, we only give capital allowance to 3 million. This one is already exceeding, it's 4,840,000, so we only give 3 million. So we have Sarunka, so 25% times 9/12 times 3. Now, those being the only fixed asset in number one, we do the computation now. The first one is, we had already done, is 50% of 28,800. The warehouse now, 10%. And then 10% times 9 divided by 12. And then times 2,800. That gives us 210. The other one, we add the 16,000. We add 1,560. And then we take 50%, 8,780. The other one is 25% times 9 divided by 12, and then times 3,500, giving us 656.25. I want us to round off to whole numbers, so we just have 656. Then the other one is 50% of 2,600, that will be 1,300. 25% of 9/12 times 3, which gives us 562.5. So we round off to whole numbers, 563. Yeah. So we have been looking for allowable expenses not in P&L, and we were in number one. We found fixed assets that were not in the P&L, and so we claim capital allowance. Let's check for any other fixed allowable expense not in P&L. Number two, management fee complies of the following. Now, all those ones are in the P&L, including the audit fee, development of strategic plan. All those were in the P&L through management and professional fee. We said if the heading is in the P&L, ignore. 3 general expenses is in the P&L. Legal fee are in the P&L. Number 5 is not an expense, it's an income. So what did we say? We said if you have not been given capital allowance, we now come back here. Of the expenses that we have added back, if there is a fixed asset, claim capital allowance. We disallow the fixed asset, you claim capital allowance. So in this case, we had a website. Trademark does not qualify for capital allowance. It's an intangible asset. Website is supposed to be at the rate of 25%. And then the other one that we had was neon sign installation. And then the one installation of machine, which we had considered there. And there was no any other. So we'll come here, website, which we have 25%. Now this we haven't been told when it was acquired or utilized from. So we take 25% of 12,400. 12,400. For the neon sign, that is supposed to be 10%. Neon sign, 10%. We haven't been told when it was started being used in the business. And here we had 820. So this will be 82. Now we do the website, which is supposed to be 25% of 12,400. which give us that 100. Yeah, that 100. Now, with nothing else to deduct because we are done with incomes in the P&L, allowable expense not in P&L, we now get net taxable operating income. So we'll start from the net profit we add, and then we minus those ones. So 527,614, and then 527,614 plus 48,800 plus 12,400 plus that 240 plus 2,600 plus 2,250 plus 1,500 plus 208 plus 256 plus 820 plus 2,800 plus 1,560 plus 580 plus 1,450 plus 1,168. Then this figure we minus the 84,000 minus 28,000 minus 32,000 minus 16,000 minus 24,000 minus 14,400 minus 210 minus 8780 minus 656, we minus 1,300, we minus 563, and we minus 100, and then we minus 82. That gives us 394, 155. Now, we said this, because this is a company and you tax the company itself, once you get the operating income, you add taxable investment income. Investment income. We add the taxable investment income. In this question, incomes are in the income statement. There was only one investment income, the last one, a general investment income. We said if it is not indicated where an investment income is coming from, tax it. So this one is not indicated, so tax. So add investment income which here we have been told it's 24,000. And since there isn't any other, this will give us the total taxable incomes. So we take the operating plus the investment incomes, which 394, 155, and then we add 24,000. That gives us 418, 155. Now, if you go to the required, we were supposed to get what? Compute the total taxable profit or loss of Zahari Processors Limited, and it ends there. There's no other question. But sometimes you can be asked to get the tax. Unless it is indicated it's an unresident or a foreign company, we said you tax at the rate of 30%. Because it's considered to be a resident. So tax, if tax was required, that is if it was a requirement that we get the tax, so tax will be 30% of 418, 155,000. Now we add the zeros, the one that we had quoted here, because now we are outside of these zeros we had quoted. So we'll get 30% of 418 155,000, which gives us 125, 446,500. And so if you are asked to get the tax, that's what you do. So the taxation of the business ends there. And which case, in case you are told to use the gross profit method, or in case you have not been given the net accounting profit and you use the gross profit method, you just have the same. You just start with the sales, cost of sales, and other income, less allowable expense. Then at the end of it, you get the taxable operating income, add the investment, and then if you are asked to get the tax, you do the same. So it's all about whether you have been given the net accounting profit or not, then you know the method that you're supposed to use. So for now, we are going to stop there until our next lesson. So kindly below this video, there is some assignment question, attempt, and then you see if you can be able to do it the way we have done it. Thank you very much.
Hello and welcome back to the lesson. Today we're going to study authority, power, and influence in the context of public administration. Now, administrative theory candidates encompasses various concepts and frameworks that guide the effective functioning of organizations. And among such concepts are authority, power, and influence, which are central to understanding how decisions are made, to understand how decisions are implemented. In this lesson, we just do an overview of authority, power, and influence. So by the end of this lesson, you should be able to explain the meaning of authority, power, and influence. We begin with authority. What is authority? Authority refers to the legitimate right to make decisions, legitimate right to issue orders, and also to allocate resources within an organization. Authority, I repeat, refers to the legitimate right to make decisions. Legitimate right refers to the right to make decisions, the right to issue orders, and the right to allocate resources. So if there is one person in an organization who makes decisions or issues orders or allocates resources, then that person can be said to be having authority. And it is conferred by a formal position. It is done what? It is conferred on a formal position. For example, an accountant may have the legitimate right to spend money within an organization. Okay? That's an example. A human resource manager may have the legitimate right or the authority to advertise for a vacancy in an organization. A procurement officer may have the authority in an organization to purchase items within an organization. So authority is conferred on a formal position. I've given an example of a position of an accountant, a position of a procurement officer, and a position of a human resource manager. And there are different types of authority. For example, we have the traditional authority, we have the charismatic authority, there is the rational or legal authority, and so on. So what is the importance of authority in administration. Importance of authority in administration. One is decision making. Decision making. Authority ensures that decisions are made and enforced and that are enforced in a structured manner. Authority helps people understand how decisions are made. Authority ensures that decisions are predictable, and it ensures that decisions are made and enforced in a structured and in a predictable manner. The second reason why authority is important is in relation to coordination. Coordination. Authority facilitates coordination by clearly defining who has the right to make specific decisions. For example, in an organization, we may have an accountant, we may have a human resource manager, we may have another position. So each and every formal position has its own level of authority, and that makes it easy to coordinate the efforts and the decisions that are made by different authorities within an organization. Accountability. Number 3, accountability. Accountability. Authority establishes a clear line of accountability as individuals in positions of authority are responsible for their decisions, because it is known who makes the purchases, who hires, who tenders. So that makes it easy to hold individuals accountable for their decisions, such that if an accountant spent money in purchasing items that were not meant to be spent, then such an accountant can be held accountable. That decision cannot, the accountability may not be expected from a different position. So it helps members of an organization to be accountable. Accountability. The second concept, power. Power. We have defined authority as the right to make decisions, issue orders, and allocate resources. How about power? Now, power, on the other hand, is the ability to influence or control the behavior of others. Power is the ability to influence, the ability to influence or control the behavior of others. Power is the ability to influence or control the behavior of others, and power may go beyond the confines of authority. It is exercised through various means and can come from different sources, like legitimate power is a source which is derived from formal position or a role within an organization. Another source of power is reward power, which is based on the ability to provide rewards and incentives to others. If one has the ability to provide incentives, then such a person can influence or control the behavior of others, because people are motivated by incentives. Another source of power is coercive power. Now, based on the ability to punish or to provide rewards, or based on the ability to punish or let me say to punish or impose negative consequences, based on that, to that extent, individuals can be seen as being powerful. If an individual can punish, if an individual can impose negative consequences, then that is what we are referring to as coercive power. Another source of power is reverent power, which is based on personal traits or relationship that inspire loyalty, that inspire admiration, and so on. So those are 4 sources of power. In fact, 5. Legitimate power, reward power, coercive power, expert power. We may also have reverent power. Now, expert power is derived from possessing specialized knowledge or expertise. A person who has expert power is one who has knowledge that others do not have. If you have knowledge that others do not have, then you have expert power, and that is a source of power. So power is the ability to influence or control the behavior of others. An expert can control the behavior of others. An expert can influence the behavior of others. So power is the ability to influence or to control the behavior of others. You understand? Yes, you do. So what is the importance of power in the context of public administration? Importance of power. 1 is influence and control. Influence and control. Influence and control. Power enables leaders to influence the actions and attitudes of subordinates. Power helps the supervisors to influence and control subordinates. Power, the ability to influence. 2, conflict resolution. Effective use of power can help resolve conflicts and maintain harmony within an organization. It is important in conflict resolution. 3, motivation. Motivation. Now, different forms of power can be used to motivate. They can be used to enhance productivity and so on. Employees can be motivated through different forms of power, like expert power. Expert can motivate employees. Coercive power can also motivate when you know that you may be punished for your actions by your superior, then that can motivate you to work towards excellence. So these are 3 reasons why power is important in the context of public administration. The last aspect, influence. Influence is the 3rd concept we are going to learn in today's lesson. Influence. What is influence? Now, influence is the ability to affect the behavior of others. Influence is the ability to affect the behavior, to affect the attitudes and opinions of others. It is the ability to affect the attitudes, opinions. It is the ability to affect the attitudes, the ability to affect the actions, the ability to affect the behavior of others and behavior of others. If a person can influence your attitude, if a person can affect your opinion, if a person can make you change your behavior, then such a person has influence over you. And it often involves persuasion. Influence involves negotiation. It involves building relationships and so on. So influence is the ability to affect the attitudes, the behavior, and opinions of others. And I've said there are various techniques that can be used to influence others. Techniques: persuasion. 1, persuasion. One can affect your attitude, opinions, or behavior through persuasion. That means using logical arguments, using facts, and emotional appeals to convince others. Another technique is negotiation. Negotiation is a technique that can be used to affect the attitudes, opinions, and behavior of others. Negotiation. Engaging, that means engaging in dialogue to reach a mutually beneficial agreement. Negotiation can affect attitudes, opinions, and behavior of others. Then building alliances. Building alliances. That is to say, forming coalitions, forming partnerships, forming networks in order to strengthen one's position and also to achieve objectives. So these are three techniques that one can use to influence the attitudes, opinions, and behavior of others. So that is the end of the lesson. We have briefly discussed three important concepts in public administration: authority, power, and influence. Authority, power, and influence. Assignment 1. Differentiate between the concepts of authority, power, and influence in public administration. How are they exercised, and what are the sources of each? 2. Discuss the challenges faced by public administrators in balancing their professional expertise with political considerations. How can they navigate these tensions effectively? 3. What are the different leadership styles observed in public administration? Which styles are most effective in different contexts and why? 4. Explain the concept of organizational culture in public agencies. Explain, I repeat, the concept of organizational culture in public agencies. How does it influence the behavior and decision-making of public servants? Thank you for attending the lesson. In our next session, we are going to study the relationship between public administration and politics. Bye.
Hello learner, welcome to Manifested e-learning platform. My name is FAM Lengwiri and I practice within the financial services industry in Kenya. Today we are discussing on the financial modeling and data analytics paper. The focus is on the December 2023 sitting. We are going to discuss on question 21. The question reads as follows. Eugene Shahira has been provided with a set of historical data by one of his clients, which include a set of assumptions, statement of comprehensive income, statement of financial position, statement of cash flows, and supporting schedules as presented below. And so you can see down here the assumptions. These are the assumptions that have been given to us here, and you can see they're presented in blue for the forecast period, and this is the historical results. We have the income statement, the balance sheet given to us down here, and the cash flow statement just under it. Finally, we have what is called the supporting schedules. We are required using the assumptions presented in the assumptions table, assist Eugene to complete the following statements of forecast period for the forecast period. A, the statement of comprehensive income, the statement of financial position, the statement of cash flows, and the supporting schedules. All of these total to 30 marks. So we go back up and start filling out the income statement based on this forecast period right over here. So the forecast period is from 2017. And we are going to start with the income statement. So the revenue, to model revenue, we have been given the revenue growth rate over here. And so we are saying that we are going to assume that the revenue is going to grow at 5% initially, 4.5%, 4%, 3.5%, and 3% in 2021. So we will increase this 150,772 by a factor initially of 5%, 4.5, and so on and so forth like that. So let's do that together. So the first thing is to link it with that, and then we multiply by that factor 1 plus now this growth rate right over here, and we close the bracket so that now the model can be complete, or the formula can be complete. You can see in 2017 we expect it to be like that. So we drag it, Control R, and it picks the formula like that. Else we can do the following. If we don't prefer to do it like that, we just focus it like that, and we wait for that plus sign over here like so, and then we drag it like that. So we drag the formulas, and you'll still see the answers are the same. How do we model cost of goods sold? Now we are told that the cost of goods sold is provided as a percentage of revenue. Meaning what? We get the cost of goods sold over revenue gives us 37.5%. I can do it right above, right beside it here. So you can say COGS over revenue will give us the COGS percent, which is this one right here. But how then can we use the COGS percent to be able to model the cost of goods sold? We just get the revenue and multiply it with the cost of goods sold percent, so that now we can be able to model the cost of goods sold, because that is what we're going to remain with over here. Because cost of goods sold over revenue is cost of goods sold percent. So we cross multiply the revenue multiplied by the cost of goods sold percent, then we should be able to have the COGS. And that's what exactly what we are supposed to do. We take that and we multiply, or the revenue, we multiply that with what is called the cost of goods sold percent as a percentage of revenue. Enter there. And like the same way we've done before, we just drag it, Control R. The gross profit, because it's a formula, we just drag it, Control R. Now we move on to the expenses down here. So the salaries and benefits, what are we told as far as the assumptions are concerned? We are told that the salaries and benefits are given to us in terms of shillings, 25,000 all through like that. And here we're saying it's going to remain as 10,000 in terms of the depreciation component. So because they're following each other like that, and these are considered to be fixed costs, we just pick them from above. There, just pick it up from there. And also because they're following each other, just drag it like that, put it like that. And then now, we fill it out like that. What I've just done, I've just picked this one from here. And you can see from here, this is I32. Like that. So it's I32, which is this cell over here. But now, where do we pick it from? We pick it from I13. This is I13. I13 is this one here. So we're picking it just from there. And then also this one is going to be I14, which is down there. Now we move ahead and try and model the depreciation and amortization. In real life, trying to model depreciation and amortization will prove to be a bit of a challenge. Determining will be a bit of a challenge because we need to know whether it's going to be reducing balance or whether we're going to use straight line method. For simplicity's sake, the way I've seen it right over here, depreciation as a percentage of PPE, it's just based on straight line method like that, for simplicity's sake. So the depreciation and amortization is driven by percentage of opening balance of PPE. So we will initially leave it over here because we do not have the values of PPE given to us directly, and we'll model it a little later on. As well, the interest right here. The interest right over here is based on opening balance. We do not have the opening debt balance given to us here. So what do? We first of all leave those two alone like that, and we will be able to try and model them a little later on. So we put maybe say a faint color there on them, like so. to show that we're going to come back to it a little later on. Because these are totals, the ones in black are always totals, the ones in blue are hard coded values. We just drag them. That. Remember that this value here is bound to change, as well as this value is bound to change because of we've not filled out the depreciation, neither have we filled out the interest. Now the taxes over here, we have been told something about the tax rate right above here. You can see the tax rate is as a percentage of earnings before tax, and you can see it's 28% all through. So what does that mean? That this tax rate will be based on that value times the taxation rate which is given to us right here. So we link it with that one there. And because this is also going to change based on these values given to us there, we just drag it, and because Excel is very wonderful, is a very wonderful tool, it will just pick everything, or it will pick the formulas based on the values that are inserted right at this point here. This is a formula, so we just drag it like that, moving towards the right. So we have partially filled in the income statement with the exception of depreciation and interest expense. We move over to the balance sheet and try and model it and see if you can be able to model some items. Cash will be the very final part that you're going to fill out, and it will be like what is called the balancing figure as we approach the end of the model itself. How do we model accounts receivable? The accounts receivable, if we can go back to the assumptions section over here, this is the assumption section right above here, you can see we've been given accounts receivable days. We've been given 18. And accounts receivable days is driven by revenue. So it is accounts receivable over revenue times 365. We can get this from these black formulas over here. So if you double click, you can see it is the revenue, or it is rather the accounts receivable, yes, if you said before, accounts receivable. We divide that with the revenue, and then we multiply it by 365 to enable us get the days. Now that we've assumed that the days are going to be 18 over here for the forecast period, and you can see this is the forecast period here, 2017, how do we model the accounts receivable here? We are going to move ahead and say that it is accounts receivable, like that, is given as how we're going to model it over here. We'll pick the revenue, because we've said that we already have the accounts receivable days, and then we divide that, or rather, let me just tell you what you're going to do, because the formula is given to us right over here. You can see this is it over here. We are saying we're going to get the revenue, or rather the accounts receivable over the revenue times 365. So we're just going to do this. We are going to pick the days over here, accounts receivable days. So accounts receivable is going to be given as the days, and then we multiply that with the revenue, and we divide this, all of this, by 365, by 365 over here, 365, that. So days times revenue over 365. We've just adjusted the days. Initially, for us to get the days, we are saying we get the accounts receivable times 365 over revenue, just rearranging this formula. And that's exactly what we're going to do over here. We get the days are here, see where they are, just a second, accounts receivable days there, and then we multiply that with the revenue, then we divide over 365. And we have that value given to us there. So So shift control R, we model that. Inventory is driven by cost of goods sold. So in a similar fashion over here, the formula here, we'll get inventory is given as, or given by, the inventory days times COGS, not times revenue, and here we're dividing against 365. That. So that's what we expect over 365. So that's what we are going to do. We pick the cost of goods sold there, just to double check, cost of goods sold times the days, which days? The inventory days right here, 73, divide by 365. Once we divide that by 365, then we should be able to get the 11,715. We drag it. PPE, or property, plant and equipment. Remember, this is the one that is going to drive our depreciation component over here. But since we don't have it yet over here, we leave it out for now. The second time coming down, we will be able to fill it out, because this is a formula. So shift control R. We can proceed on to the liabilities. Obviously, these values are bound to change because we've not filled out the cash, neither have we filled out the PPE. So the accounts payable is driven by cost of goods sold. The same formula over here, only that we're going to put now accounts payable. Now over here, payable. Payable for revenue 365. So we look for the accounts payable days. Accounts payable days, you can see the accounts payable days are here, 37, and then we multiply that with the cost of goods sold and then divide by 365. That's what we get. The debt, we will be able to fill out the debt and link it with the debt component from the supporting schedules. So here we drag it like that, because this is a formula here, it's just the total. So this one I'll put it in a different color, so that for consistency's sake, to maintain to show that this is the part you're going to come to later on and fill it out. In terms of the equity capital, we are going to link it. So we're going to drive it previous equity capital, then we add any new issuance and repayment of equity. So we come back up over here to the assumption section, this assumption section. Was there any issuance and repayment of equity from 2017? There is what we link it with over here, and we enter. The retained earnings is driven by the previous retained earnings plus the net earnings for the current year, which is this one here. Remember, this value is going to change because of these two, depreciation and interest. Enter. We drag them towards the right, and this one remains like so. So shift control R, because it picks the formulas as the way they are. Remember, in a balance sheet we always have a check. This check, with your permission, it will obviously not balance, because we are saying that here we have got some missing items. You can see it's not balancing at all. But it's up to our responsibility, based on what the examiners asked us, to fill and ensure that this one balances off, the balance sheet balances off based on the forecast. Now, as far as the cash flow statement is concerned, we will first of all ignore it for now. We ignore the cash flow statement, and we will be able to also do a check for the cash flow statement and write down over here to determine if we're actually cooking figures or not. We jump on to the supporting schedules. These supporting schedules are broken down into three: the working capital schedule, the depreciation schedule, and the debt and interest schedule. These schedules, these three of them, are instrumental towards filling in the missing items in the balance sheet, income statement, and the cash flow statement. So from here, the accounts receivable, you remember we had modeled it just above there in the balance sheet. So we just fill it out, link it with the one accounts receivable here, and you can see the accounts receivable is here, so we link it right over there and we put enter. Because they are following each other with the inventory, I can just drag this sort of down like that, and it picks from above. The accounts payable, we also had filled it out or computed it above from the balance sheet here. The accounts payable, as you can see right over here, is 5938. You see, it's okay. Link it like so. Then these are black. It means that they are formulae. To get the net working capital, we get the accounts receivable, we add the inventory, and then we less the accounts payable. That's how we get the net, the change, the net working capital component. So just put it like that, and it picks. The change in net working capital is the difference between changes in this year from last year's. You can see the formula there. This value subtracting that value there. So I'll initially fill it like that, then now I can drag it moving down like that, Shift, Control R. So once we have those values given to us there, we are saying that now the working capital schedule is complete. The change in net working capital is going to be useful in computing some items in the balance sheet or in the in the cash flow statement, pardon me. So we move down to the next supporting schedule, depreciation schedule. Now we can see something that is very unique from the historical values here. This value, which is the opening PPE, is there picked from the closing value here. This value has been picked from the closing value here. This one has been picked from there. So it goes without saying that this value here will be picked from the value there. How much is our capex? Our capital expenditure is representative of how much money we are going to spend out within the year. Outflow of cash, maybe to invest in new machines, new equipment, so forth. And we will link this with the supporting schedule up from, rather not the supporting schedule, the assumptions section. This one here. And we are saying that the capex, capital expenditures over here, is given to us there. So we link it with that and we press enter. The depreciation is based on the opening PPE always. So pick the opening value of PPE and multiply that with the depreciation rate. Remember, we are saying that we are assuming it for simplicity's sake is going to be straight line method. So depreciation, and we are saying we are going to multiply it with that. And we get that. To get the closing PPE, we are saying we are going to get the opening PPE, we add the capex and less the depreciation on the machines. So we drag the formula moving to the right like that, and we can sort of pull the formula towards the right or drag it. Now the final supporting schedule is the debt and interest schedule here. How do we model it? The debt opening, just like the way we are done in the opening in the depreciation schedule, this value is that value, that value is that value. So it goes without saying this value is going to be that value. So pick it from there. And the issuance and repayment of debt can be gotten from the assumptions section, which is up above over here. So debt and issuance repayment right now here, you link it with that. So here, because it's a formula, we just drag it. So we drag it over here, it's like that. We wait for the plus sign that looks black like that, which is over here like this, and then we sort of drag it. We just drag it moving towards the right. How do you get the interest expense? The interest expense is based on the opening value times interest on the assumptions section. Interest as a percentage of opening balance here is 3%. Now our schedule, or our supporting schedule rather, is complete. That's what we're saying we're going to do. We drag it. These values over here are going to be instrumental towards filling out the cash flow statement. But first, let's go back up and start all over again from the income statement here and fill out what is missing. We have the depreciation component, so we link it with the ones in the supporting schedule. So we go down on here, and you can see the depreciation is given to us over here. There, enter. The interest expense right here, interest expense is linked to the supporting schedule here, right here, enter. Then we can be able to just drag it towards the right there, to R. And in a good account or analyst format, we just make sure that this part is the same color because we've already filled out the missing items and our income statement is complete. Now, like I said before, that the cash is going to be filled out at the last, at the tail end. It's like the balancing figure. We can fill out the property, plant and equipment. So we're saying it's going to be from the supporting schedules down. So we are saying it's going to be this value here, the closing. You're reporting at the end of the financial year. So we pick the closing balance there, and we drag it towards the right. Remember, it's just the sum of all of them. As well, the debt, we pick the closing debt, which is right here. Closing debt should be that. We can just drag it, Control R. So we can then, of course, now remove the theme color, put it here like so, with the exception of the cash. Now let's fill out the cash flow statement. Net earnings is picked up from above here. Here 35 is here, the net earnings, you can see the net earnings is there. Here we have the depreciation and amortization over here. Right here, so we pick that. And then we are saying changes in working capital. Where do we pick it from? We pick it from the supporting schedules right here. Change in net working capital, and we are saying we are going to pick that value. So because this is black and it's a formula, I can just drag it like so. Now We're almost there, but we're not there quite there yet. The investments in PPE represent the capital expenditures. So the capital expenditures down here, capex. Capex, you can see the capex is here. Link it with that. And this one, sort of pull it towards the right, and it's complete. As far as the financing cash flow is concerned here, issuance and repayment of debt, we link it with the supporting schedules, rather with the assumptions tab, sorry, up, debt, here. And remember, they are following each other with equity. So, like that. And this can be dragged like so, because it's a formula, and we can complete this by doing that, by dragging the formulas moving the right. The net increase or decrease in cash is a formula, because you can see it right above over here. We're going to add cash from operations. We subtract cash from investing, because that's money going out, and then we add cash from financing, so that we can be able to get the decrease in or increase in cash. Drag that towards the right. And we're saying that we can then pick the opening cash balance. Remember, this opening cash balance is the closing cash balance here. This one is that one, and that one is that one. So we are saying that we can then link that with that value. This one is a formula like so. So we can then drag these values moving towards the right, and we have the values like so. Now, to try and test and see whether this is actually going to balance, because we are through, answered the statement of comprehensive income, statement of financial position, statement of cash flows, and the supporting schedules, we can see that it's still not balancing. Remember one thing, what I had mentioned, that the cash balance is the one that is the balancing figure right here. So let's try and see if you're going to link it, if it's going to balance. So we link this cash value with the closing cash balance right here, this one here, and you can see it has balanced. But dragging the rest towards the right is the one that's going to tell us whether we are on the right path. And you can see it has balanced very well. The cash flow statement has also balanced as well, meaning that we have successfully answered the question presented to us by Kasneb. We hope that you've enjoyed this session of ours, but before we part, there is one thing that I want to try and see and to ask you, whether even if we change these assumptions here, whether it will still balance. It will still balance. That may be the question. So even if I put this to 25 million like that and leaving the rest the way they are, look at the balance sheet. It still balances. If I put this to maybe 50%, that it still balances. So this issue or this idea of cooking figures cannot arise, because Excel is truthful, and being a true financial analyst means that you need to know how to model all of the three statements: the income statement, the balance sheet, statement of cash flows, very well. Thank you for being with Manifested Publishers, and God bless you.
Greetings and welcome to the auditing class. Today we are going to discuss the features of audits or characteristics of audits or attributes of audit. Now, the key features of audits include, one, that audits are, an audit is a systematic process. Systematic process. That is the first feature. One, systematic process. Okay? You recall we defined audit or auditing as a systematic and independent. It is a systematic and independent examination of the financial records to ascertain their accuracy, fairness, and if they comply with the regulatory requirements. So auditing is a systematic process. Audits flow, there are various stages. When you say systematic, it means areas, the auditing process follows a structured and organized approach guided by professional standards and methodologies. And later on, we shall be studying the international standards on auditing. So auditing is a process that follows a structured and organized approach that is guided by professional standards and methodologies. And that ensures that the audit is conducted in a consistent and thorough manner. We will be looking into the audit process as we progress. We'll learn that auditing it takes a certain approach, process, systematic process. That's the first feature. The second feature is that audits are independent. An audit is an independent examination of the financial information or records of an organization. Independence is a feature. Auditors are independent. Auditors maintain independence from the organization they are auditing. That's why auditors are appointed by the owners and not the managers. And that independence is very important to ensure objectivity and impartiality in the assessment. And that is crucial for maintaining credibility and the reliability of their audit reports. An auditor ought to be independent of the management. And to ensure the auditor's independence, the auditors are appointed by the owners and not the management of the company. So independence is a key feature of audits. The third feature is that audits are evidence-based. Evidence-based. They are based on evidence. Auditors have to gather sufficient and appropriate audit evidence to support their conclusions. And this evidence may include financial records, may include documentations. They may have to carry out interviews. Auditors, in seeking evidence, they can interview the workers, they can interview the management, they can interview the suppliers, they can interview the data, they can carry out interview. In order to gather this evidence, they may also gather evidence through observation. They may observe processes within the company in order to understand the company better and make appropriate conclusions. They may also carry out analytical procedures to gather evidence. So before the auditor gives his opinion on the fairness and the accuracy of the financial statements, an auditor has to gather appropriate, sufficient audit evidence. Opinion is based on evidence. The fourth feature is professional judgment. Professional judgment. professional judgment. Auditors use their professional judgment to interpret evidence, to assess risks, and also make informed decisions throughout the audit process. And that requires combination of technical expertise, it requires combination of experience and also ethical considerations. So in carrying out their function, auditors have to rely on their professional judgment, which is derived from their experience, from their technical expertise, and ethical considerations. 5, risk assessment is a feature of audits. Auditors assess the risks of material misstatements in the financial statements, and that helps them to focus their efforts on areas where there are risks of errors or fraud and so on. So auditors have to carry out assessment of risk in different areas. It could be the internal controls, they could assess risks in, say, assets or any other aspect of the organization in order to know where they should focus more in the process of auditing, such that if there are areas that are not prone to risk, then they will not focus on such areas, but they may likely to carry out more tests in aspects like inventories and management of cash, where risks are likely to be higher. So auditing involves risk assessment. 6, internal control. There is an aspect of internal control evaluation of internal controls. Auditors evaluate the effectiveness of an organization's internal control system, which is designed to prevent and deter errors and fraud. The internal controls are put in place by the management, and the purpose for having internal controls in management in the company is so that the assets of the company can be safeguarded. So when auditing, an audit will have to evaluate the internal control system of an organization. Auditors have to evaluate the effectiveness of the internal control system. The internal control system is developed by the management, but the auditors have to evaluate if the internal control system is effective. And an effective internal control system is one that prevents errors, the one that prevents fraud, the one that ensures that the company's assets are safeguarded. And that helps them to assess the reliability of financial statements and also identify potential weaknesses in the system. 7, reporting is a feature of audits. Auditors communicate their findings and conclusions in an audit report, which includes an opinion on the fairness of the financial statements. Auditors, after examining the financial statements, they have to do a report within which they express an opinion as to the fairness of the financial statements. And the report may include recommendations for improving internal controls. It may also include aspects of the organization's operation. So reporting is a feature of audits. An audit must have a report at the end of the process. Another feature is that audits must comply with standards. Compliance with standards. Auditors have to comply with standards. Audits are conducted in accordance with professional standards, such as the international standards on auditing. Auditors do not carry out audits based on what they think. No, they are guided by standards. To conduct an audit of a company, there are standards that have to be adhered to by the auditor. such as the International Standards on Auditing, which provide guidance on audit procedures. They provide guidance on quality control. They provide guidance on ethical considerations. Remember, we say that, first of all, auditing is a systematic process. This process is provided by the standards. The standards dictate how an audit is to be conducted. Compliance with standards. You understand? So these are the key features. There are more other features which can be cited, like the continuous improvement. Auditors strive for continuous improvement in their work, both individually and as a profession. And that involves staying up to date with changes in accounting standards, staying up to date in changes in regulations, changes in technology, and so on. Another additional feature is in relation to value addition. And because candidates, while the primary objective of an audit is to provide assurance on the financial statements, auditors also aim to add value to the organization by identifying areas of improvement and providing recommendations for enhancing efficiency and enhancing effectiveness. So these are key features of audits. One, an audit is a systematic process. Number two, independence. Number three, evidence-based. Number four, professional judgment. Number five, risk assessment. Six, internal control evaluation, reporting, and compliance with standards. Assignment one. What are the key characteristics of a systematic audit process? Two, explain the importance of independence in auditing and how it is maintained. Three, describe the role of professional judgment in the audit process. What is the purpose of risk assessment in an audit and how does it influence the audit process? How does it influence the audit procedure? Thank you for attending the lesson. In our next session, we are going to discuss the distinction between auditing and accounting. Bye.
Hello class, welcome to lesson 3 of topic number 5, which is share capital. Share capital. In this lesson 3, we will look at the prospectus. We shall look at the company's prospectus or prospectuses. And in respect of the prospectus, we will define the prospectus, look at the essentials of a prospectus. Then we will look at the contents of a prospectus. Then we will look at criminal liability arising out of the issue of prospectuses. Then I will also look at the civil liability arising out of the issue of prospectuses. Then I also intend to look at the purchase of shares, the purchase of own shares by a company. Then finally, we shall look at payment of dividend and the dividend rules or rules relating to the payment of dividends by a company. So let's begin by where we want to describe or define a prospectus. Now, when you look at our act, that is the Companies Act of 2015, it does not give a very clear prescription or description of what a prospectus is. It talks about a prospectus, being a notice, being a circular, or any advertisement advertisement issued by a company, offering securities to the public, for subscription. So quite a number of words have been used to describe this document, that it is a prospectus, that it is a notice, it is a circular, it is an advertisement. Should be an R there. It is an advertisement issued by a company offering securities to the public for subscription. Now, what we conclude is that there will be no specific format that this document, that is the prospectus, may take. That it could be in the form of a notice, it could be in the form of a circular, form of an advertisement. Simply put, no specific format that we expect of prospectuses to be taking, provided that it is a document containing those specific contents as we shall be discussing later on today. And then what it is doing, that this document is inviting for subscription. It is inviting the members of the public to subscribe for the securities of the company. So the test of what the prospectus is not much on the format of the document, but specifically what the document does. That it is a document inviting for subscription, inviting the public to subscribe for the company shares, and that of its contents. That the contents and what the document does is the test of what a prospectus shall be. Now, there is this term that we are using here, the term offering securities of the company, offering securities of the company to the public for subscription. Now, the term offering, as used in this description, is not in its strict legal sense. In the strict legal sense, when you talk about the prospectus offering for subscription, you would imagine the issue of the shares or the prospectus being an offer for the company shares. It is actually not. It is an invitation to treat. It is inviting, the prospectus invites potential subscribers to make offers by making an application for the company shares. It is until when these applications are received, when the company makes an allotment, the offer by way of application is accepted by the company by allotting shares. So the prospectus in itself is an invitation to treat, not an offer. Though in this description, we are talking about the prospectus offering. So that use of this term offering is not in its strict sense. We are also making reference to this word public. And the question would be, does a prospectus have to make an invitation to the entire republic? Does it have to make an invitation to each and every person? Now, common law, by way of courts' decisions that we have received from courts, the suggestion is that the reference to the word public does not have to include everyone. That the invitation to the public will be sufficient even where a section of the public is targeted. So if we have a company issuing shares and the only places where this prospectus has been circulated is Nairobi, now the question will be, was that a public issue? And the idea is, since Nairobi is part of the general public in Kenya, then that is a public issue of the prospectus. Even a section of Nairobi residents receiving the prospectus, it would still qualify to be an issue targeting the public. So this document is taking no specific form. We are judging what it is by what it does and its contents, that it is issued inviting members of the public to subscribe for the company's securities such as shares. And then we look at the contents as we shall be discussing them later. Now, let's go to the essentials. When a prospectus is issued, there are specific things that it must come along with. There are specific things that the prospectus must demonstrate. The essentials of a prospectus. For instance, we are saying that all prospectuses must be dated. they must contain a date. They must indicate a date. And the idea is this date that shall be contained in the prospectus shall be assumed, shall be considered to be the date of issue of the prospectus. All prospectuses must be signed. All prospectuses must be signed. Now, one of the persons to sign the prospectus will be any person named as a director. Any person named as a director by that prospectus must be signing the prospectus. The idea of them signing is considered to be them giving an authority or giving their consent for the prospectus to be issued, which is important. Any person or any expert who was issued a statement, So sometimes when you're issuing prospectuses, you may want to get some experts to give their opinion on certain matters. It could be about the valuation of the company's assets. It could be about the prospects of the company's business. So when you get such experts giving statements about this prospectus, then you also get them to sign the prospectus, and particularly a copy of the opinion or the statement that they have endorsed. This endorsement or this signing is seen as giving consent to that statement being issued to the public for consumption. The other thing that will also be part of these prospectuses would be endorsements or attachments. Attachments to the prospectus. This could be any expert opinions or expert statements that have been given in relation to the issue of the prospectus. It could also be financial statements of this company issuing the prospectus. Then finally, we must also have a statement. We must have a statement issued. To the effect that a copy of the prospectus has been issued to the registrar. That a copy of the prospectus has been issued to the registrar. Now, this is the issuing of the copy of a prospectus to the registrar is a protective measure that the registrar's office is a public office that should receive this document for purposes of confirming, for purposes of ensuring that this document is compliant to the provisions of the law. So that if you are issuing a copy of the prospectus to the public, and we have a statement in the prospectus that says, we have also given this copy to the registrar, that the registrar has authorized the issuing or the sharing of this document to the public, then it inspires confidence to the public that this document that is being issued by this company in respect of the subscription of particular securities that they are issuing is a compliant document. So this should be some of the essentials we are expecting this prospectus to manifest. Now, I want to discuss the contents of the prospectus. Contents of the prospectus. Contents of the prospectus. Now, if you know why this document is being issued, then it becomes very easy to anticipate some of the contents or the contents that you expect to find in this document. We are issuing a document to the public to share with them all the necessary information that they need to enable them to make a decision on whether they are going to buy, they are going to invest, they are going to subscribe for the shares of this company or any other form of security that this company could be issuing. So imagine yourself as the investor, and we are issuing a document that should give you information sufficient enough to base your decision on whether you're investing or not. So question would be, what kind of information do you expect that we should share in that document? Now, part of the contents or part of the information that we should be sharing in this document will be information relating to the company itself. We shall also be sharing information relating to the management of the company. We shall also be sharing information relating to the securities that we are issuing, so that all these pieces of relevant information will be enough or will be consumed by the potential investor in determining whether they are going to invest in the securities that are issued by this company. So what are some of the things we're expecting to find? You expect that the prospectus will tell you something about the company's preliminary expenses. The prospectus will also talk to you about the remuneration of promoters. This prospectus should also tell you about any founders' shares that have been issued to management. It should also tell you about the particulars. It should also tell you about the particulars of directors. So what are the names of these directors, addresses, including occupation. So what else do they do when they are not directing this company? This could be a good test for the experience and the exposure these directors have. You would also need information to do with the director's remuneration. The director's remuneration. So how much are they paid to manage this company? You would also give information about directors' share qualification. So does this company require their directors to take up some minimum number of shares as part of their directors' share qualification? It makes the directors part of the membership of the company. You may also have requirements relating to the securities themselves. So the rights conferred by the shares. So we are going to buy shares. What rights do these shares that you are issuing grant us? Opening and closing of subscription lists. So when can we start applying for these shares, and when will they close? They should also tell us about the minimum subscription. The minimum subscription. This is an amount out of the total amount of capital that the company wishes to raise. They will indicate the minimum amount that they must or they consider should be raised in this issue. That is the amount that the company is thinking would be good enough to have some working capital, good enough to meet any costs of this issue may have come with, any pre-incorporation, any preliminary expenses that may have been incurred. So they should also be stating this, the minimum subscription expected from this issue. It will also be important to be told about the auditors of the company, if any have been appointed, auditors of the company. We can also be told about any material contracts. Entered into matters relating to shares that have been issued otherwise than on a cash basis. Basically, what we are saying that this prospectus should be giving us information relating to who manages this company. What kind of shares are we buying? What prices? When do we start buying? What kind of rights are they giving us? Then the company itself, how long have you been doing business if less than 3 years? Have you entered into any material contracts that you think we should be disclosed in this prospectus that we should consider when investing, when purchasing the securities of this company? Basically, it is information good enough to enable a potential investor to base their decision on whether they are subscribing or not subscribing for the shares of this company. Now, the issuing of a prospectus, actually the preparation and the issuing of a prospectus is subject to very strict rules, such that we have a lot of liability that has been created in relation to the preparation and the issuing of prospectuses to ensure that companies comply with these rules. There will actually be liability on the part of directors, part of experts, or any persons who have been named as directors in this prospectus for non-compliance with some of the requirements of the Act relating to the issue of the prospectus. It is that liability that I now want to discuss in relation to the issue of prospectuses. Let me begin with the criminal liability. Criminal liability relating to prospectus. Criminal liability relating to prospectuses, where we are saying that it is an offense to do what? So for certain things that we shall do relating to the issuing of prospectuses, the Companies Act considers them criminal, considers them an offense for which a fine shall be imposed on the defaulting officer of the company. For certain things that we may omit during the preparation and the issuing of the prospectus, the Companies Act considers them an offense by way of an omission for which a fine shall be imposed on the liable officer of the company. So I want us to consider some of these things that under the Companies Act are considered a criminal offense, either when done by the company or the company's responsible officers, or when not done in relation to the preparation and issuing of prospectuses. Now, we are talking about one, it being an offense to issue a prospectus, a copy of which has not been presented, to the registrar, a copy of which has not been presented to the registrar. This is just a legal expression to say you are not supposed to issue prospectuses when you have not given a copy of that prospectus to the registrar. So when the company's officers proceed on to issue prospectuses to the public, when a copy of that prospectus has not been received by the registrar, then that is going to be an offense for which the company officers responsible are going to be liable to pay a fine. It shall also be an offense to invite for subscriptions, of company securities, to invite for subscription of company securities unaccompanied by a prospectus, So this rule or this offense is simply prohibiting any invitation to the public for which no prospectuses should be issued. So if you are targeting any public invitation, then that invitation must be accompanied by the issuing of a prospectus, where we are saying it is going to be an offense to the responsible company officers where they are inviting for subscription of the company securities where a prospectus has not been issued, where a prospectus is not accompanying the invitation for the subscription. To further offenses, where we're saying it is also going to be an offense to, it is going to be an offense to issue a prospectus, containing an expert statement without their consent, without their consent. Now, what this offense is prohibiting is the issuing of prospectuses that purport to contain opinions or statements given by experts, where the consent of that expert has also not been obtained. So if you are to issue a prospectus with an opinion of an expert accompanying it, then also get the consent, the endorsement of that expert to go along with the prospectus, so that this offense says or prescribes that it is going to be criminal to issue a prospectus containing a purported statement of an expert whose consent does not accompany the prospectus. The other offense is that it is going to be an offense to issue a prospectus. It is going to be an offense to issue a prospectus without the necessary attachments or endorsements or annexures, as we call them. An attachment is also known as an endorsement or an annexure. So what kind of attachments are we thinking about? So those prospectuses that have expert statements must also be accompanied by the written consent of such expert, such that it is criminal not to have that attached. Prospectuses that are carrying with them financial statements, those financial statements will be an annexure, will be an attachment to the prospectus, such that it shall be an offense not to have those financial statements attached to the prospectus if this company is to issue that prospectus. To more of those offenses, we have some more. Should be number, this is 4, should be number 5. It is an offense to issue a prospectus. It is an offense to issue a prospectus containing an untrue statement. It is an offense to issue a prospectus containing an untrue statement. That it shall be criminal to issue a statement or to issue a prospectus containing false, incorrect, wrong statements. This is intended to protect the consumers of the information from misrepresentations, that you are not going to make prospectuses and issue with it misrepresentative statements, statements whose truthfulness you cannot account for. Now, this liability shall be to the person issuing the statement. That the person issuing the statement that turns out to be untrue shall be the person to whom criminal liability in respect of the untrue statement goes to. Now, we have some special circumstances where these persons issuing untrue statements could also have some reasonable defenses against any action brought under this offense, where we are saying a statement was issued in the prospectus and this statement turned out to be untrue. The statement turned out to be a false statement. Now, the person issuing the statement could come in with some very good defenses, such as where they are saying they had all reasonable grounds to believe that the statement was true, and actually they believed the statement to be true. In that case, their liability for the untrue statement would be extinguished. We also have circumstances where an untrue statement has been issued and the person issuing the untrue statement has also withdrawn such statement and given reasonable public notice, so that their defense is, at the time when they issued the statement, they believed it to be true. When they realized that the statement was not true, they withdrew the untrue statement and issued reasonable public notice of their withdrawal of the untrue statement. So class, for all this conduct or omissions, there is going to be criminal liability imposed on the responsible persons by the law relating to the prospectuses. I now want to discuss civil liability. Civil liability. Under civil liability, we are looking at third parties. Any third party who suffers loss, by reason of relying on an untrue statement contained in the prospectus. Any third party who suffers loss by reason of relying on an untrue statement contained in the prospectus. So they have received the prospectus, they have read the prospectus. The prospectus did contain a statement that was untrue, that they relied on to make a decision to subscribe for the shares of this company. It is as a result of that subscription that they are saying or claiming that they have suffered loss. They have civil liability both as at statute and at common law. They can claim both under statute and at common law. At statute, they are claiming for compensation. They will be claiming compensation for loss suffered, where under common law, they shall be suing for damages. They shall be claiming damages for misrepresentation. They shall be claiming damages for misrepresentation. It is also possible that they can claim rescission of contract. This is rescinding the contract of the purchase of the shares. That at common law, I bought shares on the faith of a statement that was contained in the prospectus, and this statement has now turned to be untrue. The innocent party, the suffering third party, may be claiming rescission of contract. I want to rescind the contract of purchase of shares on the basis of the misrepresentative statement, on the basis of the misleading statement contained in the prospectus. They could also be claiming damages, monetary compensation for any particular loss, monetary loss suffered. That is under common law. Then we are saying, as far as the Companies Act is concerned, it provides for a possible compensation that can be claimed by the suffering third party from specific persons. So who are these persons that we could be claiming compensations from? Persons liable for untrue statements for untrue statements contained in the prospectus. Persons liable for untrue statements contained in the prospectus. Now, we could be claiming compensation from every person who was a director, every person who was a director at the time of issue, every person who was a director at the time of the issue. We could also be claiming from every person who allowed themselves, every person who allowed themselves to be named as directors, who allowed themselves to be named as directors. We could also be claiming from every person who had agreed to become a director, after some time. We could also be claiming from every person who authorized the issue, of the prospectus, every person who authorized the issue of the prospectus. So that is the spectrum of all persons on which this civil liability is lying on them. And these are persons under the statute that we can be claiming compensation from. So class, that is the story of the prospectus. It should be bringing us to the end of this third class. Just to recap what we have done, we have looked at what the prospectus is. We have also looked at the essentials of a prospectus. We have looked at the contents of the prospectus, which are primarily supposed to give the potential investor all the relevant information they need in order to base their decision on whether they are going to buy the shares or not. Then we have also looked at the liability in respect of prospectuses, criminal and civil liability. This liability is for the purposes of ensuring the requirements of the Act in relation to the preparation and the issuing of the prospectuses have been complied with. Thank you very much.
Hello and welcome to the lesson. The subject is Introduction to Law and Governance. We continue with the topic Introduction to Corporate Governance. In our previous sessions, we defined corporate governance as the way in which corporations are controlled and managed and also directed. In today's lesson, we will study the role of stakeholders in corporate governance, the role of stakeholders in corporate governance. Candidates, we know that organizations cannot achieve their intended objectives without involvement of various stakeholders. For a company to achieve its objectives, then it requires the input of various stakeholders like the shareholders, the management, the employees, the suppliers, the customers, the government, and so on. In today's session, we are going to study roles of stakeholders, specifically the shareholders, the directors, and the government. We will restrict our study to three stakeholders. Number one, the shareholders. Number two, the board of directors, and the government. Let's begin with the shareholders. What is the role of shareholders in corporate governance? What is the role of shareholders in corporate governance? Now, candidates, shareholders of a company, both jointly and severally, are expected to protect, preserve, and actively exercise the supreme authority of the company in general meetings. The voice of the shareholders, as far as corporate matters are concerned, is to be expressed in the general meetings. They have a duty jointly and severally to exercise supreme authority, because shareholders are the owners of the company. Shareholders appoint the directors to run the affairs of the company on their behalf. So they have certain duties to perform in relation to corporate governance, which is said corporate governance is a way in which corporations are managed and directed. So what is the role of the shareholders in directing and managing a corporation? Number one, shareholders have a role to ensure that the directors who are appointed are persons that are competent and reliable, persons who can add value to the company when elected or appointed. So directors or the board of directors is a group of individuals who are appointed by the shareholders. So that is the first important role of the shareholders, to appoint the board of directors. And when appointing board of directors, the board should comprise of individuals who are competent and reliable. So when appointing the directors, the shareholders ought to ensure that the individuals who they are putting in office are people who will discharge their functions as required. They ensure that only competent and reliable persons are appointed. So their role is to ensure only competent and reliable persons or individuals are appointed to the board. To ensure only competent and reliable persons are appointed to the board. That is a supreme authority of the shareholders, to ensure only competent. Competent means persons who have the required skills, persons who have the required experience. So when appointing these board of directors, they should be persons that have the relevant skills, relevant traits to discharge the functions of a director on a board. Now, the second role of shareholders in corporate governance is to ensure that the board of directors is constantly held accountable. To ensure that the board of directors are constantly held accountable, because they ought to account their responsibilities to the board. So the shareholders should ensure that the board of directors are constantly held accountable. They are constantly held responsible for the efficient and effective governance of the company. All right? Held accountable and responsible for the effective and efficient governance, right, of the company. Efficient corporate governance of the company. Corporate governance of the company. So the shareholders should ensure the board of directors are constantly held accountable and responsible for the efficient and effective corporate governance of the company. All right? What is the third role of shareholders in corporate governance? Is to change the composition of the board of directors that do not perform to expectation, where the shareholders have appointed the board and the board is not discharging its functions as required, then the shareholders have a role to change the composition of the board of directors, to change the composition of the board of directors, to change the composition of the board of directors that does not perform to expectation. All right? That does not perform, because when the board of directors are appointed, there are certain expectations. They have certain duties that they need to perform. They have certain responsibilities. When they do not perform to the expectation of the company or the board of directors, or to the expectation or in accordance with the mandate of the corporation, then the shareholders have a duty to ensure that they are removed from the board. Where directors are not performing or discharging their functions as they ought to discharge their functions, the shareholders have the duty to ensure that they are removed from the board, so that more competent and reliable directors are appointed. Confidentiality is another role. Confidentiality. Shareholders, candidates in a limited liability company are obligated to protect and maintain the confidentiality of company secrets. Shareholders of a company, by virtue of their position, may or will come into contact, will have access to certain information that may be considered secret, company secret. And such information should not be disclosed to third parties. And therefore, the shareholders have a role to maintain confidentiality. They are obligated to protect and maintain the confidentiality of company secrets. Now let's move on to the second stakeholder. The first stakeholder is the shareholders. The second stakeholder is the board of directors. 2, what is the role of board of directors in corporate governance? Now, the board of directors exercise all the powers of the company subject to the limitations contained in the law and the memorandum and articles of association. That means that the powers or the duties or the responsibilities of the board of directors is limited to what the law says, is limited to what is contained in the memorandum and articles of association. And therefore, one of the roles of directors in relation to corporate governance, number 1, is that they exercise leadership enterprise. Exercise leadership. Board of directors exercise leadership. They do what? They exercise leadership. They are also expected to make sound judgments in directing the corporation so as to achieve continuing prosperity and to act in the best interest of the enterprise while respecting the principles of transparency and accountability. They exercise leadership, they act, they make sound judgments, and when exercising leadership, they're supposed to exhibit high levels of integrity, because these are individuals who've been entrusted with the duty to steer the company to prosperity. So exercise leadership. The second role of board of directors in corporate governance is to ensure that through a managed and effective process, board appointments are made that provide a mix of proficient directors, each of whom is able to add value and bring independent judgment to bear on the decision of the company. Independent judgment. They have a role to bring independent judgment. The board of directors exercises its functions through board meetings. When decisions are to be made, the board sits, and therefore, the directors who sit on the board are expected to bring independent judgment, which is expected to bear on the decision-making process. Independent judgment is a judgment that should be objective. Judgment should not be biased. Judgment that is in the best interest of the company. Judgment that is free of conflict of interest. The third role of board of directors in relation to corporate governance is to determine the corporation's purpose and values. Determine the corporation's purposes and value. To determine the corporation's purpose and value, to determine the strategy to achieve its purpose and also to implement its values in order to ensure it to ensure that it survives and thrives, and ensures that procedures and practices are in place that protect the corporation's assets and the reputation of the corporation. To determine the corporation's value, to determine the corporation's purposes, and to ensure that there is a strategy in place for implementation of the purposes and the values of the company. To monitor and do what? And implement. To monitor and implement. To monitor and evaluate the implementation of strategies. Monitor and evaluate implementation of strategies. First of all, the board envisions. The board envisions or comes up with the what we call a picture of what the company should be in future. The board determines the strategic direction of the company. The board develops strategies, and then the strategies are to be implemented by the management on day-to-day basis. So they come up with a vision of the company, where the company ought to be and all that. They come up with strategies, but the implementation is carried out by the management. And therefore, the board of directors has a role to monitor and evaluate the implementation of strategies. Okay? To do what? To monitor and evaluate the implementation of strategies, the implementation of policies, and management performance. Policies and management performance. These directors are monitored by shareholders. And these directors monitor the management. So it's a very key role that the board of directors plays in corporate management, that one of evaluating the implementing of strategies, policies, and also evaluating the performance of management. Number 5, the board of directors should also ensure that the company complies with various laws to ensure compliance to various laws, regulations, and so on. Ensure that the corporation complies with all relevant laws, regulations, codes of best practices, and so on. Regulations, codes of best practice, like the one we are studying. We are studying the code of corporate governance, which is a set of guidelines on how corporations are to be managed. So the board of directors should ensure that the company complies with the laws. These are laws that are put in place by the government, the acts of parliament, the taxation laws. There are also regulations that are put in place, like authorities like the capital markets authorities, the securities exchanges, and also the codes of best practice. The board ensures compliance to such laws. The next role of directors in corporate governance is to ensure that the corporation communicates with shareholders. The corporation communicates. Is to ensure the corporation communicates with stakeholders. To ensure that the corporation communicates with the stakeholders and the shareholders and stakeholders effectively. Effectively. There ought to be communication. The company is required to communicate with all the stakeholders. The government, the shareholders, the financiers, the customers, and all that. There has to be proper communication, because candidates, we know that the company cannot achieve or attain its objectives without the input of different stakeholders. Number 7, the board of directors serves the legal interests of the shareholders. That's another role of the board of directors, to serve the legal or the legitimate interest of the shareholders and the corporation, and also to account to them fully. Serves the legitimate, let me use the word legitimate, to serve the legitimate interest of the shareholders. They have a role to do what? To serve the legitimate interest of the shareholders. So these are 7 roles. Let me add another one, 8. regularly review processes and procedures. Board of directors have a role to regularly review processes and procedures. And why should the board regularly review and review processes and procedures? So that the board can ensure effectiveness of its internal systems of control, so that decision-making capability and the accuracy of its reporting and financial results are maintained at a high level at all times. So the processes and procedures of the company ought to be regularly reviewed by the board of directors. Number 9, appoint the CEO, Chief Executive Officer. It is the role of the board of directors to do what? To appoint the Chief Executive Officer of the company. And they should at least also participate in the appointment of senior management to ensure the motivation and protection of intellectual capital intrinsic to the corporation. Remember, candidates, corporate governance refers to the way in which an organization is managed and directed. The chief executive officer of a company plays a key role in proper management of a company. The chief executive officer is the one who is in charge of the day-to-day operations of a company. Then, if that be the case, then the board of directors should be responsible for the appointment of such an individual. Of course, we have seen here that the board of directors develops strategy, policies that the company ought to be guided with in the process of discharging its function. They develop strategies. They give strategic direction. But the day-to-day operations of the company are left in the hands of the CEO. So this CEO ought to be a person who has the required skills, the required expertise, the necessary experience in order to steer the company to the desired end. And therefore, the board of directors should appoint the chief executive officer. And we know the chief executive officer does not work as an individual. No, there's a team of management, the management team. So the board of directors should at least participate in the appointment of senior management to ensure the motivation and protection of intellectual capital that is intrinsic to the corporation. So that is appointment, but that's not enough. The board of directors should ensure that this team of managers, these senior managers, are continuously trained. They should have continuous training, continuous training, so that they discharge their functions effectively. Appointment of the CEO and the senior management. So we can go on and on, candidates, and mention roles like that are related to technology. We can say that the board of directors ensures that technology and systems used in corporations are adequate to properly run the business. All right? So that such technology can help the company to maintain what we call competitive edge. The board of directors, you can also say, that has a role in relation to risk. The board of directors have a role to identify key risk areas. Identify key risk areas. Identify key risk areas. Identify the key risk areas and also the key performance indicators and key performance indicators. Key performance indicators of the business. And the board should not just identify, but should also do what we call monitoring. They should monitor the key performance indicators of the company. Yet another role is in relation to going concern. Going what? Concern. The board of directors should ensure annually that the corporation will survive, the corporation will thrive, and the corporation will continue as a viable going concern. As what? As a viable going concern. So these are 13 roles of board of directors in corporate governance. We are going to discuss the last stakeholder, C, the government. The first role that the government plays is legislative and regulatory. Now, government through parliament makes public policy, it legislates, and also makes what we call statutory instruments. The government creates a conducive environment for business to operate. The government regulates and comes up with what we call the statutory frameworks. And the government, through the courts, also interprets and enforces the legislation that is done through the courts or the judiciary and other national enforcement agencies. So legislative and regulatory role. Government through parliament, I've said, makes legislation, makes statutory instruments. The government creates a conducive environment for business to operate, and through making regulatory and statutory frameworks, the government can also the interpretation and the enforcement of legislation is done by the courts and other national enforcement agencies like the Kenya Police and other such bodies. So legislation ensures fairness, legislation ensures a level playing field, legislation ensures transparency in business dealings, and that is very important. It's an important tenet of corporate governance. Transparency, disclosure and transparency is a key component, is a key tenet of good corporate governance. Through legislation, we know the government can, for example, determine what kind of financial records are to be published, right? We know candidates that the company law provides for the financial statements that the public limited companies ought to make public, to disclose. That's a legal requirement. And transparency and disclosure, those are important tenets of good corporate governance. So the first role is legislative and regulatory. To legislate and to regulate. And by legislating and regulating, the government creates a conducive environment for business to operate. Is that clear, candidates? The second role of government in corporate governance is a monitoring role. Monitoring. Monitoring what? Monitoring. The government ensures that there is fair play in business through monitoring. How does that happen? The government oversees and monitors organizations such as the Securities Exchange Commission, the Stock Exchange, and other financial institutions. Another role that the government plays is an overall role, or what we can call an overarching role. The government provides an enabling environment within which the private sector can thrive. The government is responsible for example, for providing basic what I call basic security. The government, through the public law, maintains order. The government ensures the protection of private property. And it also has an obligation to protect the vulnerable members of the society. All right? Overarching role. Let me call it overarching role. The government has an overarching role. It provides a general basic security, it provides law, it provides order, it helps in the protection of property, and so on. The fourth important role that is played by the government is that one of solving disputes. Solving disputes, and when disputes are solved, then justice is ensured and ensures justice. And where there is justice, candidates, there is most likely to be peace. So the government helps to bring justice in corporate leaders. Because you know corporate leaders who are from time to time involved in scandals. The government does what? Solve disputes among the corporate leaders, disputes between companies, disputes that may arise because of financial scandals, because of fraud. And the government can also help gather enough evidence against the corporate leaders who are involved or who are involved in scandals. The government can gather enough incriminating evidence against such individuals, and that is a very important role in corporate governance. Justice. The government does what? Ensures justice. So these are four roles that are played by the government in corporate governance. And that will mark the end of our today's lesson, where we've discussed the role of stakeholders in corporate governance. The syllabus restricted us to study the three stakeholders, that is the shareholders, the board of directors, and the government. Today we have learned that the shareholders ensure only competent and reliable persons are appointed to the board. We also learned that shareholders ensures that the board of directors are constantly held accountable and responsible for the effective and efficient corporate governance of the company. Efficient, good corporate governance of the company. The third role played by shareholders is that they help change the composition of the board that does not perform to expectation. In case there are directors who sit on the board who do not perform their duties as expected, then the shareholders have a role to remove them from the board. There is also the role in relation to confidentiality. Shareholders are under obligation to maintain information that is considered secret. The company secret should be protected by the shareholders of the company. We went ahead in this lesson to discuss the role that is played by the board of directors in corporate governance. We saw that board of directors exercise leadership, they bring independent judgment, they determine the corporation's purpose and the value, they monitor and evaluate implementation of strategies, policies, and management performance. The board of directors also ensures compliance to various laws, regulations, and calls of best practice. The board of directors communicates with stakeholders efficiently. Number 7, they serve the legitimate interest of the shareholders. Number 8, they regularly review processes and procedures. They also have a role to appoint the chief executive officer. And number 10, they identify key risk areas and key performance indicators. Then there is a role in relation to going concern. We've also discussed the role that the government plays in corporate governance. The first is the legislative role and regulatory role, the monitoring role, the overarching role, and the role of solving disputes and ensures justice. The government helps to bring justice in corporate leaders who are involved in scandals. Who are done what? Who are involved in scandals. So candidates, I'll leave you with an assignment based on what we have studied today. Discuss the role of the following stakeholders in corporate governance. A, shareholders. B, board of directors. C, the government. Thank you for taking time to attend today's lesson. When answering this question, close the notes, close the video. Try and see if you can recall what you have learned in today's lesson from your memory. God bless you. Bye-bye. Hello and welcome back to the lesson. Today we are going to distinguish between auditing and accounting. Auditing and accounting. These are both essential components of the financial reporting process, but they serve distinct purposes and have different roles. We all know that accounting is a process of identifying, summarizing, reporting, recording, and interpreting of economic information so as to allow the users to make informed decisions. Auditing, on the other hand, is the systematic and independent examination of the financial records of an organization to ascertain the accuracy, to ascertain their compliance with the laws and regulations, and to ascertain the reliability and fairness. Do you understand? So in distinguishing the two, one distinction can be on the basis of definition. Definition. Defining. Definition. You can distinguish auditing and accounting by just defining the terms. And you have said that these are both essential components of the financial reporting process. I've defined the two. Then another basis for distinction is the purpose. Purpose. What is the purpose of accounting? What is the purpose of auditing? Now, the primary goal of accounting is to identify, to record, to classify, summarize, and communicate financial information about a business or an organization. To account is to record, to identify, to classify. In accounting, we summarize information. Then that information is communicated so that the users can interpret it and make their own informed decisions. That is the purpose of accounting. Now, the purpose of auditing, the primary goal of auditing is to provide an independent and objective assessment of the fairness and reliability of an organization's financial statements. The primary goal of auditing is to provide an independent and objective assessment. So an auditor, after the records have been prepared by the accountant, the auditor is required to carry out an independent assessment of such records in order to ascertain their fairness and ability. So that is another distinction based on purpose. The two can be distinguished based on the process. Accounting or accountants maintain financial records. They prepare financial statements such as income statements, such as balance sheets, such as cash flow statements, and then analyze financial data to provide insights to management and the stakeholders. Accounting is a process of identifying, summarizing, recording, classifying, and then interpretation of financial data. You understand? Whereas auditors examine the financial statements and the underlying records, because every financial statements must have supporting records like the invoices, the receipts, the notes, the delivery notes, the bank statements. Those are the underlying records or information. So the auditors examine the financial statements like the balance sheet, the income statement, as well as the financial information or the supporting documents, the underlying documents. They examine the financial statements and underlying records. They also assess the effectiveness of internal controls. They test the accuracy of financial information in order to ensure that it complies with accounting standards and regulations. You understand? That is the difference in terms of the process. The two have different stages in carrying out their functions. The auditors and the accountants, their stages are different. The processes are different. The fourth distinction can be on the basis of focus. Accountants focus on day-to-day operations. The day-to-day operations. They give an account of every transaction on day-to-day basis. When purchases are made, they record. When a sale is made, they record. When they pay expenses, they record. When they pay workers, there is a record. So every transaction that is carried out, every transaction, financial transaction that is done, accountants do so. They record such transactions on day-to-day basis. Accountants focus on the day-to-day operations of the accounting system, ensuring that financial transactions are recorded accurately and they are in compliance with accounting standards. That's a focus day-to-day, all right? Auditors, on the other hand, focus on verifying the accuracy and reliability of financial information, identifying potential errors or fraud, They also assess the effectiveness of internal controls. So their work is not on daily basis like the accountants. The focus is different. They do not record transactions on day-to-day basis, but they examine, they verify the accuracy and the reliability of financial information that is provided by the accountants. You understand? The fifth output. The output of accounting is the presentation of financial statements, which present a picture of an organization's financial position and performance. That is the output of the accounting process. It is a process which begins with the preparation of source documents. It goes on to the recording of the journals, the ledgers. The trial balance is then extracted from the ledgers. Then the financial statements are prepared and presented. So the output of the accounting process is the preparation of financial statements which present a picture of an organization's financial position and performance. Financial position is depicted in the balance sheet and the performance is depicted in the income statement. Do you understand? That is the output. Now for auditing, the output of auditing is the audit report, which includes the auditor's opinion on the fairness of the financial statements and any recommendations for improvement. So the output for accounting process is just the financial statements, the income statement, the cash flow statement, the balance sheets. As for the audit process, the output is the auditor's report, which contains the auditor's opinion. The auditor may also have recommendations to the company where maybe it's identified areas of weakness. So candidates, that is the distinction between accounting and auditing. These two can be distinguished on the basis of the definition, the purpose, the process, the focus, and the output. Okay? So accounting is the process of recording and reporting financial information, while auditing is the process of verifying and assessing the accuracy and reliability of that information. So the accountants do the recording and presenting the financial information. The auditors then come after to assess, to examine, to verify the accuracy and reliability of the information that is provided by the accountants. So both functions are essential for ensuring the transparency and credibility of financial reporting. The auditors cannot perform any task unless they rely on the work that is done by the accountants. And auditors are primarily accountants. For one to be an auditor, then one has, first of all, to be an accountant. So auditors are accountants because you cannot verify and ascertain the accuracy of a process that you do not understand. So auditors essentially are accountants, and both functions are essential for ensuring the transparency and also the credibility of financial reporting. So that is the end of the lesson. Assignment 1. What are the fundamental differences between auditing and accounting in terms of their purpose and focus? 2. How do the outputs of accounting and auditing differ? 3. Describe the relationship between accountants and auditors in the financial reporting process. 4. What are the different skills and knowledge required for accounting and auditing professionals? Thank you for attending the lesson. In our next session, we are going to study the types and classification of audits. Bye.
Hello class, welcome to lesson number 4 of topic number 5, share capital. So in this 4th lesson, I want to talk about the purchase of own shares, by a company. Then I will also talk about dividends, the dividend law in respect to companies. So let me begin on the first of those items where we are talking about by purchase of own shares, purchase of own shares by a company, purchase of own shares by a company, where we are asking ourselves the question, can a company purchase its own shares? Or could a company, by extension, finance the purchase of its own shares? Now, we notice that there is a direct prohibition against companies purchasing their own shares or financing the purchase of their own shares. At common law, this is the rule in Trevor versus Whitworth, where the direction of the court is that a company must not purchase its own shares. A company must not purchase its own shares. Now, this is consistent with the rules that relate to the company's maintenance of its own capital. That the company's capital is the creditor's fund of last resort, and as such should be maintained. And all those matters, all those transactions of the company that go towards threatening the company's share capital, transactions such as reduction of share capital, transactions such as the company's purchasing its own share capital, all these are extremely regulated transactions by law in a bid to ensure the company's share capital remains fixed and known, remains unreduced, that there are measures that have been taken to ensure that the company does not waste its own capital. Now, despite this direction that a company must not purchase its own shares, the Companies Act gives us some special exemptions under which a company may be purchasing its own shares. So these exceptions include exceptions to the rule, that is exceptions to the rule in Trevor versus Whitworth. These exceptions introduce us to circumstances where a company may purchase its own shares. Now, one of those circumstances is during a redemption of redeemable preference shares. During the redemption of redeemable preference shares. This is if allowed by the articles, and all rules relating to redemption of redeemable preference shares have been followed. Rules that we have discussed earlier, such as the shares being fully paid, the shares being redeemed either out of the proceeds of a new issue, or if no fresh issue has been issued by the company redeeming them out of reserves and creating the share redemption reserve fund. We could also have a company purchasing its own shares in case of a valid surrender of shares by a member. This is a rare case, but very much possible, particularly where a shareholder holds partly paid shares, that the shares held by this member are partly paid. The fact that they are partly paid, they present a further obligation on that member to make payments for the balance, for the unpaid part of those shares. in the case this member is unable to make these further payments, in the event that this member is not able to discharge this liability, this obligation to pay for the balance outstanding on their shares, then they can surrender such shares to the company. This surrender, in a way, is to absolve them from that liability to pay for the outstanding amounts on their shares. The other possible circumstance under law where a company would be purchasing its own shares would be following or pursuant, following a court order for protection or for the purposes of protecting minority, for the purposes of protecting minorities. Where we have circumstances in the company, imagine circumstances such as a variation of class rights that is proposed and even voted accordingly, but we have some minorities who are contesting the variation of class rights on the basis that it is prejudicial to their own interests. We may have a court order directing that the interest of these shareholders, minorities actually, these protesting or these objecting minorities be absorbed by the company. In such an incident, the court could be directing the company to purchase the interest of these minorities, which the resulting transaction would be a company purchasing its own shares. So class, in these exceptional cases, they are presenting us to a scenario where we are going against the directions given by the rule in Trevor versus Whitworth, where the direction is a company must not purchase its own shares. However, we are saying in these exceptional circumstances, we can have a company purchasing its own shares. Now, by extension, we are also saying that a company must not finance or provide a guarantee, must not finance or provide a guarantee for the purchase, must not finance or provide a guarantee for the purchase of its shares, must not finance or provide a guarantee for the purchase of its own shares on the basis, on the same premise that we were not to purchase our own shares for purposes of capital maintenance requirements. However, we are also finding ourselves running into exceptions to this rule, that we have exceptional circumstances where a company may finance the acquisition of its own shares. Now, these exceptions include where providing finance or guarantee is part of the ordinary business of the company. So this could be a company in the financial sector where part of their business is the provision of financial assistance, that they're in the business of giving loans. So a loan has been obtained by a customer in the normal circumstances under which normal loans would be borrowed, where such customer also proceeds on to purchase the shares of this company with the proceeds advanced by the company. Then we have a situation, an exceptional circumstance, where a company has financed the purchase of its own shares. The other exceptional case would be where the company has a scheme, to advance, money or funds to trustees, to a trustee or trustees to acquire shares for the benefit of its employees, Now, this exception presents us with a situation where this company has set up a trust fund or has set up a trust for the benefit of the members. And this trust, part of the things it does is investments for the purposes of the members. Remember, these investments could be through the purchase of shares, securities in companies. So we are saying funds have been advanced to the trustees by this company, where the trustees invest for the purposes of the members' welfare. These trustees could proceed on to use these funds in buying the shares of this company, advancing the funds. Now that presents us with an exceptional circumstance where the company is seen advancing funds, which funds are subsequently applied in the purchase of its own shares. Then finally, we have an exception where the company has a scheme. The company has a scheme to advance funds to employees. This is with an exception of directors, except directors to purchase shares in the company, for beneficial ownership. So company law recognizes that companies could have a scheme, an arrangement within the company that they advance funds, they advance money to the employees of the company, with an exception of directors. Directors are excluded from this fund. They are excluded from this scheme, this arrangement of advancing money to employees to purchase shares of the company for beneficial ownership. This scheme is to make the employees of the company feel part of the company, where they have been advanced money for the purposes of owning a stock in the company that they work for. So this is the idea of purchasing of own shares by the company, that it is generally prohibited in the interest of protecting the company's capital. However, we have seen ourselves running into exceptional circumstances where companies can directly purchase their own shares. We have also seen circumstances where companies are allowed by law to finance the purchase of their own shares. Let me now look at dividends. Dividends. We are describing a dividend to be a member's return. This is a member's return for their investment. A member's return for their investment in the company. A member's return for their investment in the company. It is also seen as a share of the company's profit, that is paid to the members. The share of the company's profit that is paid out to the members. Now, the Companies Act presents us with certain rules relating to the payment of dividends to members, relating to the sharing of profits or paying of this return to the members. Rules of paying dividend. Rules of paying dividend. Now, as part of this continuing story of maintaining the company's capital, one of the paramount rules relating to the payment of dividend is that dividends can only be paid out of profits. Dividend can only be paid out of profit. Dividend can only be paid out of profit. That unless a company has realized a profit, then this company cannot pay dividend. And by the way, inherently, companies are not under obligation to pay a dividend. It is financial year end, we have made profits. The company is not under obligation to pay dividend to the members. But we are saying, should we be paying dividends? dividends must always be paid out of profit. It is unlawful. It shall be wrong. It shall be against the law to pay dividends where the company is not making profits. It shall be seen as paying dividends out of capital. Now, what will be considered profits? The company has what we call the realized profit, the realized profit of the company. Now, from the company's realized profit, it may create some part of this realized profit as the profits available for distribution as dividend. Now, in arriving at the company's realized profit, it could be considering any gains. We talk about realized gains. Any realized gains from revaluations. Any realized gains from revaluations of assets can also be considered as the company's realized profits in this year, including the exclusion or the deduction of any realized losses from revaluation of assets that this company has done during this year can be excluded from the company's annual realized profit that year. So from the company's realized profit, the directors will designate part of the company's realized profit as profit available for payment of dividend. Profit available for payment of dividend. The other rule is that dividend is recommended. Dividend is recommended by the board. Dividend is recommended by the board of directors. Dividend is recommended by the board of directors. These are the persons charged with the day-to-day management of the company. So they are best placed to know how much this company can afford to pay as dividends. So it shall be their responsibility to recommend how much dividend is to be paid. Still relating to the payment, we are saying that dividend is approved. Dividend is approved by members. Dividend is approved by members at a general meeting. Dividend is approved by members at a general meeting. Now, this meeting could be the company's AGM, at which dividend is usually approved by the members. So the directors have recommended a dividend, then we have a meeting of members where that dividend is approved. Relating to the approval, we are noting another rule that the members cannot recommend. The members cannot, let me withdraw the word recommend and replace it with the word approve. The members cannot approve a dividend above the rate, cannot approve a dividend above the rate recommended, above the rate recommended by the board. Above the rate recommended by the board. So the board's recommendation on what dividend is payable shall be final. That in the GM's, the general meeting's approval, they cannot approve an amount beyond that which is recommended by the board. We are also noting that the company cannot pay dividend. The company cannot pay dividend if such payment will result to inability to meet its financial obligations. A company will not pay dividends to be unable to pay its salary to employees. A company will not pay dividends to be unable to pay rentals. A company will not be paying dividends to be unable to pay such expenses as are necessary for the running of this company. Now, once a dividend has been declared, something also happens that declared dividends, declared, let's add the approval, declared and approved dividends, declared and approved dividend shall not bear interest, against the company if there is a delay, in payment, that the board has recommended a certain rate of dividend, which has subsequently been approved by the members at a general meeting. Now, the usual practice is that once the dividend has been declared and approved, within 42 days of such approval, the dividend should be payable. If there is any delay in payment of such dividend, the suffering members shall not claim interest against the company for delay in paying them the dividends due. The other rule, still relating to payment of dividends, is that the company may deduct any amounts. The company may deduct any amounts owed to it by a member from the dividend payable. That the company can deduct any amounts that they are claiming from a member from the total amount they are to pay them as dividend. For instance, imagine a case where we have borrowed some money from our company and we have been unable to pay them. We have not repaid such borrowed amounts of money. So this company has some claim against us. So this rule is empowering them to deduct such amounts that they are claiming from any dividend that is payable to us after the declaration of the dividend. Now, from these rules, we can start imagining a procedure that companies follow in the payment of dividend. What procedures do we follow when we are paying dividend as a company? We will begin from a board meeting being held to recommend a dividend. After a board meeting has been held to recommend a dividend, the company will prepare and update the company's register of members, because it is on the basis of the register that this dividend is payable. Then we shall proceed on to convene a meeting of members where this dividend payment is to be approved. So once the dividend has been approved, then we have a preparation and closure of the register of members so that we have no more additions to the register after the approval of the dividend. Then the company can proceed on now to prepare the dividend warrants, which are to be counter-checked against the company's register of members. Then checks can be prepared and sent to members in respect of the dividend payable to them. So class, that brings us to the end of our lesson number 4. If we can recap what we have looked at so far, we have looked at the purchase of own shares by a company, where expressly such purchase has been prohibited, including the financing of the purchase of the company's own shares. But we have also looked at exceptional circumstances where such purchase can be done and the financing for the purchase can also be done. We have also looked at dividend, what it is. We have looked at the rules relating to payment of dividend, and we have also made a mention of the procedure to be followed by companies when paying dividends. I now want to send you to the revision partner questions, just to show you some of the questions that we have had from this particular topic. We have a question here asking candidates to advise shareholders on the distinction between nominal capital and reserve capital. We have a question asking candidates to explain 5 ways in which a company might alter its share capital. We have also a question here asking candidates to discuss the actions and omissions that are considered to contribute to criminal behavior in relation to preparation and issuing of prospectuses. So there are many questions here that I would wish to refer you to help you in the revision of the content in this topic. Thank you.
Hello and welcome back to the lesson. The subject is public sector governance, policy and administration. We're still on topic number 1, the administrative theory. This lesson we're going to cover concepts and principles of public administration. By the end of this lesson, you should be able to explain the concepts and principles of public administration under the topic administrative theory. The topic is administrative theory. And we defined administrative theory as a body of knowledge that seeks to understand and explain the processes and structures involved in the management of public organizations. That's the meaning of administrative theory. It provides a framework for analyzing how these organizations operate, how they make decisions, and how they can be made more effective and efficient. So it is a field that encompasses a wide range of topics, including organizational behavior, decision making, leadership, public policy, and ethics. That's the meaning of administrative theory. In today's lesson, our focus is on concepts and principles of public administration. So the first concept is bureaucracy. Bureaucracy. Now, bureaucracy refers to a system of organization that is characterized by hierarchical relationships or hierarchical authority. It is also characterized by division of labor. It is characterized by the formal rules and procedures and impersonal relationships. Those are features of a bureaucracy. And while often associated with the inefficiency and red tape, bureaucracy can also provide some level of stability. You understand? It can provide a level of stability within public organizations. So that's the first principle or concept of public administration, bureaucracy. It is a system of organization that is characterized by hierarchical relationships or hierarchical authority and so on. Bureaucracy. Now, the second concept is public interest. Public interest. Public interest. Public interest is a second principle of public administration. Public interest. Now, this principle emphasizes that public administrators should act in the best interest of the community as a whole, rather than serving their own personal or private interests. It requires them to prioritize the welfare of the citizens and to make decisions that promote the common good. So that's the second principle of public administration. Public administrators are required to prioritize public good over their own personal interests. That is the second principle or concept. The third principle is known as efficiency and effectiveness. Efficiency and effectiveness. Public decisions or public administrators are expected to utilize resources wisely. They are required to achieve the desired results with minimal waste or effort. When carrying out their functions, public administrators are required to be efficient and effective. They are required to avoid wastage. They are required to ensure that they use minimum effort to achieve maximum results. Efficiency refers to the ability to produce maximum output with minimum input, while effectiveness refers to the extent to which an organization achieves its goals and objectives. And therefore, efficiency and effectiveness is a third principle of public administration. Number 4, accountability and transparency. Accountability and transparency is the fourth principle of public administration. Public administrators are accountable to the public for their actions. They are accountable to the public for their decisions. And they are expected to be transparent in their operations, providing information about their activities, and explaining the rationale, the reasons behind their decisions. And this principle ensures that public officials are held responsible for their actions and that citizens can trust the government to act in their best interest. Accountability and transparency. 5, equity and fairness. Equity and fairness. Public administrators should treat all individuals and groups fairly and equitably, regardless of their race, gender, religion, or other personal characteristics. And this principle ensures that everyone has equal access to public services and that decisions are made based on merit. Decisions are made based on need rather than on personal biases or prejudices. Equity and fairness. 6, we have participation and collaboration. Participation and collaboration. Public administrators should engage citizens and stakeholders in their decision making. You understand? The members of the public are to be incorporated in the process of making decisions. Public officials are required to seek the input of the citizens, to seek the citizens' feedback. And this principle recognizes that citizens have a right to be involved in decision making or in decisions that affect their lives, and that their participation can lead to better and more sustainable outcomes. Public participation and collaboration is a principle of public administration. 7, professionalism and ethics. Professionalism and ethics is a principle. Professionalism and ethics. Public administrators are expected to uphold high ethical standards. They are required to act with integrity, to act with honesty, to act with impartiality, and they should be knowledgeable about their field. They should be committed to lifelong learning and also dedicated to serving public interest, professionalism, and ethics. Professionalism and ethics. Then lastly, innovation and adaptability. Innovation and adaptability is the last principle. And here, candidates, public administrators should be open to new ideas, should be open to new approaches, and they should be willing to adapt and to change depending on changing circumstances. And this principle recognizes that the challenges facing public organizations are constantly evolving, and that administrators need to be innovative and flexible in order to address such changes effectively. So these are 8 concepts and principles of public administration, and by adhering to these principles, public administrators can ensure that they are serving the public interest and fulfilling their responsibilities effectively. And these principles should provide a foundation for building trust between the public administrators and the members of the public. And the principles can create a more and equitable society. By adhering to these principles, then the public administrators can create a more just and equitable society. So this is the end of the lesson. I'm going to give you today's assignment. Question 1, describe the principles of accountability and transparency in public administration. Why are they essential and what are the potential consequences of their absence? 2, how does the concept of public interest guide decision-making in public administration? Discuss the challenges in defining and prioritizing this concept. Explain the core differences between the concepts of public administration and public management. How has the emphasis shifted over time? Please answer the questions. In our next session, we will progress with the study of the topic administrative theory. Bye-bye.
Hi there, my name is Patrick Kamau. You are lecturer in advanced taxation. So I welcome you today to the lesson where we look at a topic called tax investigation. And under the tax investigation, we are going to look at the back duty and in-depth investigation. So when we talk of the back duty, we are talking about the tax that is in arrears or that was in arrears. Back duty, you know, the tax, the duty that is backward, the one that was supposed to be corrected by the KRA from the taxpayer, but it wasn't corrected. So what the KRA normally do, they normally come and look at your books of account and they do a thorough investigation in order to determine your tax position. So in this case, we want to see how is that investigation usually done. In this case, what you also need to understand is that when you talk of the back duty or the tax that is in arrears, and in which case an in-depth investigation is usually done, so in this case, what normally happens is that KRA usually have to come and look at your books of account and determine the taxable income. The taxable income of each of the years. So taxable income in that, if for example you are under investigation for 5 years, so they have to determine what is the taxable income of the first year, what is the taxable income of the second year, third year, fourth year, and the fifth year. And once they determine the taxable income of each of those years, then they multiply by the tax rates. If it is a company, 30%, and then they can be able to get the tax that you are supposed to pay. If you are an individual, then it is graduated, because we know that individuals, it is usually on graduated scales. So it is graduated to determine now the tax that you are supposed to pay. So in this case, we should ask ourselves then, what normally costs the tax that is in arrears? What normally costs the back duty? It is usually as a result of majorly 3 things. One, non-declaration of taxable income, where the taxpayer didn't declare the taxable income for those particular period at all. So the KRA would have come and now determine the taxable income for each of those years. 2, under declaration of the taxable income. It means that you didn't declare the correct amount of the taxable income. For example, you have been earning, let's say 100,000 per month, but instead of declaring that, and remember we normally declare when you are filing the returns, instead of declaring the 100,000, you declare 50,000 every year. So that means that the KRA will tax you on 50,000. So the 50,000 that you have not declared, that would amount to the back duty when it is taxed. So another one we have where the taxpayer have been over declaring the allowable expense of the business. So remember, expenses normally reduce the taxable profit or income of the business. So if the expenses are overstated, then the taxable profit automatically will come down. So in that case, that means that if the profit is less, then the KRA will come and investigate. Why have you been under declaring the over declaring the allowable expense or under declaring the taxable profit? So in this case, then that means that when they do the investigation and determine the correct amount of the expense you are supposed to deduct, because now you have been over deducting, then that means that this would amount to the tax in arrears, or what we call the back duty. Now, when the in-depth investigation is usually done, the KRA normally use one item to do that. We call it the capital statement. And capital statement, as we are going to see, it is used when we have more than 1 year. The taxpayer has not been declaring their taxable income for more than 1 year, and we are going to see how that capital statement is used to determine the taxable income of the taxpayer. So before we go very far, I'd like us to write something on that. That back duty refers to the tax in arrears. In arrears, that is the tax that was supposed to be paid in the past years. But it was not paid. The tax in arrears is usually determined using by the KRA, determined by the KRA by doing an in-depth investigation. In-depth investigation is where KRA take a look at all books of account of the taxpayer to determine correct tax position. Another point is that back duty stroke tax in arrears can be as a result of the following. One, non-declaration of taxable income. Number two, under declaration of taxable incomes. Number three, overstating of allowable expenses of the business. And the last one I want to add here is claiming expenses, or relief one is not entitled to. One is not entitled to. So another point that you need to know is that when determining the tax in arrears, stroke back duty, the commissioner will determine the taxable income of each year from where the tax in arrears will be computed through computation of taxable income and tax rate applicable for the years of income for the taxpayer and the year of income. We say another one is that determination of taxable income where investigation involves several years is done using capital statement. So it's good to know we have talked about capital statement there. And we say capital statement is used where no proper books of account have been kept by taxpayer. It involves comparison of assets and liabilities of business to determine the capital or net assets or net assets after which growth in capital or net assets is used to determine taxable income. Capital statement which is used to determine the taxable income has the following format. So I already have explained to you what that means. However, we are saying now, where no proper books of account have been kept, the taxpayer normally use the capital statement, or KRA will use the capital statement to determine the taxable income of the person. Now, once they get the taxable income, then they'll just compute the tax payable by multiplying with the corporate tax rate or the graduated scale rates for the taxpayer, in case it is an individual like those in sole proprietorship or those in partnership. So we are saying that capital statement is usually prepared by comparing assets and liabilities to determine the capital or the net assets, after which the growth in capital or growth in net assets would then be determined, and from there now the taxable income would be determined. So capital statement, we are saying, has the following format. So I'm going to draw for you the capital statement there, see how it is used to get the taxable income. So I leave this space because of the structure of the capital statement, and utilize the space on the other end. So this is how capital statement look like. We have the capital statement. We have the items, and then we have years, which we have year 1, year 2, year 3, year 4. So this will be writing the figures . And so we usually start with the total assets. Total assets. For the total assets, let me write them this way. We start with the total assets. Total assets. So total assets of the business, which we list them here. Year 1, year 2, year 3, year 4. And then we less total liabilities. Total liabilities we have for each of the year. Year 1, we less. And that will give us capital. Will give us the capital at end of the year. Capital at the end of the year, we have this for each. Then we less capital at the start of the year. Of the year. And that will give us the growth. Let me write in short. Growth in capital or net asset or net accounting profit. Net accounting profit, which will have the amount. Then we add non-allowable expenses. Non-allowable expenses for each of the year. And then we less capital allowance and non-taxable incomes. And that will give you, it will give you the net accounting profit there. So that is how the capital statement look like. We have the name, and then this where you can see we are listing the item, and we list the years, year 1, 2, 3, 4. So what we usually do, we start with the total assets of the business. And when we talk of the total assets, take note we are talking about all the assets of the business, both private and commercial. So not that we may say that because we are looking at the taxable income of a business, we only take for the business only. No, we take the business and the one that are for private, non-commercial. Why are we considering the private? Because it's assumed that this person got the money from the business to finance his private asset. So that's why you take all the assets of the business. And then you raise the total liabilities of the business. Why are we minusing total liability? Which means both business and non-business liability, because this is the owner of the business, and what he's doing is that he cannot be able to differentiate the business, the income, the money that he borrowed for the business and the one he didn't borrow for the business. He can borrow not for business and bring the money into the business. So that's why we consider all the liabilities. So for each of the year, then when you compare the assets minus liability, it will give you the capital at the end of the year. So what we mean is that these assets must be at the end of the year, liability at the end of the year, so that it will give you capital at the end of the year for each of those years. And then you raise the capital at the start of the year. So when the year was starting, how much was the capital? So you come and post it here, post. Now when you say the capital at the end of the year minus capital at the start, it normally gives you the growth in capital or net assets or net accounting profit. Because if, for example, at the end of the year you have 200 million, let me use another current so that you can be able to see. Let's say you had 200 million here, and then that is at the end of the year. At the start of the year, you had 150 million. So it means that now the capital grew by 50 million to 200 million from 150. So the 50 million is the growth in capital, which we normally post there. Now, once you get the growth in capital or net assets or net accounting profit, then you know this net accounting, you know, an accounting profit where now you can use the net profit method to get the taxable income. Net profit method means that we add non-allowable expenses. So non-allowable expense for each of the year, and then you raise the capital allowance. So here you should have added non-allowable expense. One of the non-allowable expense we have run so far is the depreciation. So depreciation you should have disallowed, but now in taxation we allow capital allowance. So we deduct it here. And also if there is an income that is not taxable. And when we talk of taxable, we talk of non-taxable, we mean those that are investment and the operating income, the ones that are not taxable. So like now, dividend and interest from abroad are exempted from tax. Interest from a bank for an individual, withholding tax is final. So those that are final and exempt, don't tax them, so we should remove them. So when you take this figure, net accounting profit, add non-allowable less the capital allowance and non-taxable income, it will give you the net taxable profit. So in this case now we can go ahead and tax those particular profit on that particular person or business. So that is how we prepare the capital statement to determine the taxable income. However, it's also important for you to note that if you are given the capital at the end of the year, then you don't have to compare the assets minus liability. You just take the capital at the end of the year, and then now you continue from there at the end minus at the start, and then you continue at the end. So I want us to look at a question to see what we are talking about, the back duty using the capital statement. So I'll have to rub what I have written here so that we can have a space to do the question. This is what the question says. Johnson Shauri has not been maintaining proper books of accounts since the inception of his business in the year 2019. The following balances were obtained from the available business records for 4 years period ended 31st December 2022. So we have the years 31st December 2019, 2020, 2021, and 2022, which we have leasehold property, motor vehicle, furniture, a bank overdraft, loss on sale of investment, account receivable, mortgage loan, inventory, computer, bank account, personal clothes and effects. The following additional information was obtained. Drawings of goods and provision for taxation for the year 2019 were 600,000, 360,000 respectively, and had been accumulating at the rate of 10% annually. A capital allowance were agreed at a total cost of 920 for each of the 4 years. Donation to a political party in the year 2020 amounted to shillings 142,000. Gifts from relative for the year 2021 were 840. Contingent liability in respect of a pending court case in the year 2022 was 1 million. Rent paid on behalf of a close friend was 605,000 in the year 2022. Living expenses were estimated at 800,000 in the year 2019 and had been increasing at the rate of 15% cumulatively each year. We are required, number 1, compute the taxable income or loss of Johnson Shauri for the year ending 31st December 2020, 2021, and 2022. Summarize 3 specific actions that the tax practitioner could undertake upon discovery of an irregularity in the client business. So first we want to get the taxable income, and in this case you can see we have been given several assets of the business, several liabilities of the business, and we are given them the years. There are several years, so we are supposed to get the taxable income for them for the 3 years. So that is 2020, 2021 and 2022. However, now we are also given the column for 2019 because we haven't given the capital at the beginning of 2020. Actually, if you are given the capital for each of the year, in that case we should now start from the capital, and now we continue from there. But we are given the assets and liability, so we need the capital at the beginning of 2020, which is the first year of determination of the taxable income. So we need a column for 2019 where we take the assets minus liability to get the capital by the end of 2019. Once you get the capital by the end of 2019, then we can be able to use it in the 2020 as the capital at the beginning of 2020. So this is how the capital statement should look like. So we'll start with the total assets. We list them. The leasehold property is the first one. Which we have 11,760. 11,760 across the board. Motor vehicle. We have 50/40. Furniture. Then we have the loss, bank overdraft, that's a liability. Loss on sale of investment, that is an expense. Account receivable is another. Then mortgage loan, that's a liability. Inventory is another. 620, 572, 482, 520. Then we have computers. 620, 720, 840, 720. Bank account is another. 240, 268, 272, 286. Personal close and effects, those are supposed to be asset as well. Personal effects. Personal close and effects. $60, $80, $100, $120. So we need to get the total. Before we do that, we also need to look for the total liabilities. total liabilities, which we have the Roysod No Motor Vehicle Furniture Bank overdraft, where we have 1288, 1400, 1210, and 15. The other one is mortgage loan, 2080, 1840, 1620, and 1500. And those are the liabilities that we have. So we need to get the total. Except there was one more liability, sorry. In the point number 5, there was a contingent liability. Already you are told it's a liability contingent one. So contingent liability, which we have 1,000 in 2022. And yeah, those are the one that we have. So we'll get the total. We will add them starting from here. So we have 11,760 plus 5040 plus 864 plus 432 plus 620 plus 620 plus 240 plus 60, 19,636. The other one is 11,760 plus 4720 plus 864 plus 544 plus 572 plus 720 plus 268 plus 80, 19,488. The other one is 11,760. We add 9360. We add 864. We add 48. We add 482. We add 840. We add 272. We add 100. 24,086. Go to the last one, 11,760. We add 10,760. We add 864. We add 600. We add 520. We add 720. We add 286. We add 120. We have 25,630. Then we come here, 1288. We add 2080, which will be 3368, and then 1400, and we add 1840, which will be 240, 1210 plus 1620, 2830, Then we have 15 plus 1500 plus 1000. That's 615. So now we get the capital at end of the year, which will be now the asset minus liabilities. So for the first one, it will be 19,636, and then we minus 3368, which give us 16,268. The other one will be 19,488 minus that 240, which gives us 16,248. The other one is 24,086, and we minus 2830, 21,256. The other one is 25,630, and then we minus that 615, 22,015. So with that capital we less, and we are calling the capital at the end because these figures are at the end. So we less capital at start of the year. So for the first year, remember, the question was asking we get the taxable income from 2020. So capital for this one, we just required, the end of 2019 mark the beginning of 2020 so that we can come and bring it here. 16,268. Now, the end of 2020 mark the beginning of 2021. So it will be 16,248. This one comes here, 21,256. So this will give us now the growth in capital or net accounting profit. Which will be now this minus this, 16,248. And then we minus 16,268, which gives us negative 20, a loss. The other one will be 21,256. 21,256. And then we minus 16,248. It will give us 5,008. The other one is 22,015. And then we minus 21,256. It will give us 759. And then now this being the net accounting profit, we adjust it by adding non-allowable expenses. Non-allowable expenses. So we go through the question to look for non-allowable expense, starting with whatever has been provided in the list of the item. Leasehold property, motor vehicle. In the middle, there is loss on sale of investment. We don't allow loss on selling of the investment, so we add it back. Loss on investment, which happened in 2020, so it will come here. So dash from here, 100 here, dash, dash. Then we go to the additional information because there is no other fixers, there is no other expense up there. Then additional information, number one, the drawings of goods and provision for taxation for the year 2019 was 600, 360 respectively, and had been accumulating at the rate of 10%. So in this case, we are told for the year 2019, it was 600. That is drawings. And the tax was 360 and had been accumulating. So those are not allowable. Tax drawings are not allowable. So we have the drawings where they should be growing by 10%. So we have 10%. So it means that now, since that was for 2019, for 2020 we'll have 110% of, we take the drawings for the first one, 600. For the other one, if it is for the tax, yeah, not for the tax, so we have tax provision, which we have a 110% of 360. So we'll have 110 of 600, which give us 660. So here we should be having 60. Remember 2019 we don't need anything. So 660. The other one would be 110 of 360. 396. And then this one will again multiply by 110 because they are growing by that, times 660. It will give us 726. We multiply again by 110, which gives us 798.6. We come back here, 396 times 110, which give us 435.6. And then the other one, the same, times 110, which gives us 479. We round off 1602 to one decimal place. Then we continue. Capital allowance, that is not, it's allowable, not non-allowable. Donation to a political party in year 2020 amounted to that. That's not allowable. So donation, political party. Political party, of which case we have a 142 in 2020. The other one is gifts from relative. That's not an expense. Actually, it's an income. So we'll consider it an maybe non-taxable income. Contingent liability, that we had already accounted for under the liability here. The other one is rent paid on behalf of close relatives in 2022. That is not allowable. Rent for relative. Rent for relative, which you have 605. 605. So I like us to continue here. So I'll have 2019, 2020, 2021, 2022. A continuation. Then living expenses were estimated to be 800 in the year 2019 and has been increasing at the rate of 15% cumulatively each year. So we'll have living expenses. So we do the same. For the year 2019 was 800, and then you multiply by 115% to know how much would be for 2020. So that will be 800. Then you multiply by 115, giving us 920 times 115, which gives us 1058 times 115, which gives us 1216.7. So we are done with the non-allowable expense. Now we go to the non-taxable income and capital allowance. So we less capital allowance and non-taxable income. So we need the capital allowance and non-taxable incomes. So we are given the capital allowance already in point number 2. Capital allowance were agreed at a total of 920 for each of the 4 years. So we'll have capital allowance. Which we have a 920 920, 920. The only thing that remains is to look for non-taxable incomes. So non-taxable incomes, in the list up there, there is none. Additional information, number 1, there is none. Number 2, none. 3, none. 4, gift. Gift are usually not taxable income, so we need to remove them. Gifts. The gift which came in 2021, 840. Then liability, no. Number 6, rent paid on behalf of close friends, no. Living expense, nothing. So from there we can now get here net taxable incomes. So net taxable incomes, which will start from the loss, so negative 20, and then we add 100, then we add 660, and then we add 396, and then we add 142, and then we add 920, and then now we minus 920, which give us 1278. The next one, 5008, we add 726, we add 435.6, we add 1050, and then we minus 920, we minus 840, which gives us 59.6. The last one, 759 plus 798.6 plus 479.2 plus 6 of 5, and then plus 16.7, and then we minus 920. We have 2938.5. So this, remember, it is a point. Yeah. So that is the taxable income, and we have already answered the required number 1, where we were supposed to compute the taxable income or loss of Johnson Shauri for the year ending that 1st December 2020 and 2020, 2021, and 2022. So then you are supposed to summarize 3 specific actions that the tax practitioner could undertake upon discovery of irregularity in the client business. So here, so you can do this. This was for Roman 1. Now we have Roman 2. One of the things that you can do is not to notify the client. Notify the client of the irregularity. That is one. Another one is put measures to prevent further irregularity. And the last one, that when you discover there is irregularity in the client business, is to put measures. You can also put measures to prevent recurrence of the irregularity. So that is what you are supposed to do. Discover that there is irregularity in the client operations. So that is how you answer such a question. I'd like us to look at another question, same or about capital statement and back duty investigation. This is what the question says. Peter Chawawa started a retail business on 1st January 2012. He has not been filing income tax returns for the 6 years to 31st December 2017. Now, an investigation of his affairs revealed the following. 1. The balance sheet of the retail business as at 31st December 2012 was as shown below. So we have the fixed fixed assets, which consists of premises 2,000, furniture and fittings 1,000, motor vehicle 500, current assets given, debtors, bank balance, cash in hand. Then total assets. We have the capital as at January 2012, net profit for the year, drawings, mortgage loan, creditors. Number 2, he constructed an extension to the premises in the year 2016 at the cost of 625,000. The following accounts balances were outstanding in the respective years as shown below. So we have the trade debtors, bank balance, trade creditors, cash in hand, stock. He withdrew goods worth 5,000 per month per annum from the business for his personal use. The principal repayment on each mortgage loan amounted to 250,000 per annum from 31st December 2013. The mortgage interest paid in each of the 4 years ending that 1st December 2013, 14, 15 and 16 amounted to 100,000, 75,000, 50,000 and 25,000 respectively. His wife opened a saving account in a commercial bank in the year 2012. The balance in the account after crediting the interest earned were as follows. 2013 all the way to 2017, we have the saving account interest earned. Then his living expenses and wear and tear allowance were agreed with the Revenue Authority as follows. So we have the living expense, the wear and tear. So we are required to compute annual income of Peter Chawawa from 2013 to 2017. So here again we see that we have been given several assets and several liabilities, and we are required to get the taxable income. So the first thing that we normally take, we note which years are we getting the taxable income. It is from the year 2013 to the year 2017. So now we have to determine if you are given the capital by the beginning of 2013. Yes, it is given in additional information number 1, because we are given the balance sheet as at 31st December 2012, which obvious the balance sheet has the capital, the assets and liability. So if you look at the capital, we cannot talk of 3,000 because that is capital as at January 2012. So we want at the end, which was now that at the beginning capital, net profit for the year less drawings, you get 2,800. That is the capital now at the end of 2012, which marked the beginning of 2013. When the time comes to use it, we'll use it. So the rest we have to now, since we are not given the capitals for each of the year, take the assets minus liabilities. But if you look at the ones that are for each of the year, they are in point number 3, that the following accounts balances were outstanding in the respective years as shown below. So where we have trade debtors, the bank balance, creditors, cash in hand and stock. But if you look at the characteristics of those assets and liability, they are current one. We don't have fixed assets and fixed non-current liability. So we have to confirm if we had them. Yes, we had them. If you look at the balance sheet of December 2012, there are fixed assets, 3 of them. Those must be carried in the subsequent years automatically. And when it comes to the premise, as per additional information number 2, we have an addition in 2016. So we just add. Otherwise, the others will be the same for those years. When it comes to the non-current liability, we can only find one, the mortgage loan of 1,000 as at 31st December 2012. So that should be in the subsequent years, except that in additional information number 5, we are told that the principal repayment on each mortgage loan amounted to 250,000 from 31st December 2013. So it was being paid 250 every year. So we'll be reducing by 250 every year. Otherwise, we post them as they are. So we'll have Peter Chawawa capital statement. So we have the years that we are required to get: 2013, 2014, 2015, 2016, and 2017, as per the required in the computation of taxable income. And I want us to convert them to shillings thousand. We start with total assets. So first of all, we bring forward the non-current assets, which we have premises, 2,000, 2,000, 2,000. But now in additional information number 2, there was an extension in 2016 of 625. It will be 2625, 2625. And then now the other fixed assets, furniture and fitting, 1,000. Then motor vehicle, 500. Then we now bring forward the point number 3, trade debtors, 173, 190, 28, 230.5, 253. Bank balance, which we have 109, 194, 281, 281. Now for the last year is an overdraft, so we put a dash. We have cash in hand, 10. Stock, 255, 302.5, 332.5, 366, 402.5. Now there's still another asset in point number 6. His wife opened a saving account in commercial bank in 2012. The balance in this account after crediting the interest earned was as follows. Although they are the wife, it is the wife the account, but we are not told that it was a separate or she was not getting money from the business. Because that is not clear, we have to assume she was getting money from the business being given by the husband. So it should be considered here. Remember we said we consider all assets, both commercial and private. So you'd have saving account, 300, 900, 100, 725, and 750. With no other, we'll get the total. And then we come to the total liabilities. So we start with the non-current liability in the balance sheet on number 1 as at 31st December 2012. We have mortgage loan, so in additional information number 5, we were told that there was a payment of 250 every year. So here 1,000 minus 250 give us 750, minus 250 again 500, minus 250, 250, minus 250, dash. And then now we bring the current liability. In point 3, first we have the bank overdraft. A negative bank account represents a bank overdraft. So which was in the last year here, 32. And then the other one is the creditors, trade creditors. Trade creditors which you have to 30.